Open a minute to go until the start of cash equity trading. I'm Tom McKenzie in London, and these are your top stories. House Speaker Kevin McCarthy says there is still no deal to avert a US default. A top Republican aide adds no more meetings are planned. Asia stocks and futures are in the red. Fears of US slowdown hit LVMH and Hermes, wiping out $30 billion from the sector. The fortune of Bernard Arnault, the world's richest man, tumbles by $11 billion. Plus, UK inflation comes in hot once again, with core prices rising at the fastest pace in over 30 years. The pound jumps on speculation the BOE will need to keep raising rates. Let's check in on these futures then, pointing down by 0.8%. Risk off on the back of a lack of movement when it comes to the debate, the conversations about the debt ceiling. There are no meetings planned. That is weighing on risk assets. Let's see how things are opening then as we weigh up the inflation data out of the UK again, coming in hotter than the estimates. It's the core that is concerning. Yes, we're not in double-digit territory anymore when it comes to the headline number, but core of 6.8%, higher than expected and an increase from the previous month. Markets now and traders starting to bet in a peak rate of 5.5% from the BOE. The FTSE 100 currently down 0.8%. That is a sharp drop of 60 to 70 points, now down 0.9%. So some pretty decent selling that's going off in the FTSE 100. Here in the UK, the CAC 40 over in France down by 1%. Again, part of the risk-off moves in terms of the sentiment that is coming through from DC. The Spanish IBEX also in similar territory, down 0.9%. JP Morgan's Kolanovic, by the way, after the falls of yesterday, down around 1% on the NASDAQ and the S&P, saying, put money into cash, cut your holdings in equities because of the risks around the debt ceiling, because of the risks around recession and further hikes from the Fed. Speaking of which, you're going to get the FOMC minutes out later today. Let's switch it on and see the play across assets then, with a particular focus, of course, on the pound, on the back of the gains that we've seen on that inflation print, gaining 0.2%, 124. We're going to check in on gilts just in the next couple of seconds. We're touching on the China story as well. The CSI 300, it's the benchmark over on the mainland, erasing almost all of the gains year to date. Again, on the concerns about the growth trajectory of that economy and geopolitical risks, currently down 1.4%. Is the PBOC, the finance ministry, are they going to come to the rescue with a rate cut in China? It hasn't come yet. Futures in the States pointing lower by about 0.1% after the selling of yesterday. And Brent, $77 a barrel, the pickup there coming through on the back of the comments from the Saudi energy minister to Bloomberg, gaining 0.9% on Brent, saying short sellers, be warned. Let's have a look at gilts then and see if there is much movement as they open on the trade on the back of that stronger than expected inflation print. There it is, big moves in terms of these gilt yields, 22 basis points, 435 on the 2-year, 436. Look at that flat curve then between the 2s and the 10s here in the UK, 436 on the 10-year. That's a move of 20 basis points. This selling pressure is in focus, yields up on UK debt on the back of that higher than expected inflation print. Now, to the politics of the US, which still dominates in terms of this risk sentiment globally. Speaker Kevin McCarthy left the US Capitol late Tuesday afternoon, saying the two parties had yet to reach a deal to avert a first ever US default. For more, let's bring in Bloomberg's Bruce Einhorn. Bruce, the clock then ticking. Where are we on reaching a resolution to this standoff?
Well, Tom, there's some good news. The good news is that Kevin McCarthy's deputies said that there was some progress made in closing the gaps in some areas, said that they were very close in some areas. That said, they're still very apart in other areas, and at the moment they don't have any new talks set up. The key areas of disagreement have to do with things like spending caps. The Republicans want to have a reduction in spending and want to have that apply to everything except the military. The Democrats want to have a freeze in spending rather than a cut, and they're saying that any restrictions in spending should include spending on the Pentagon, something that Republicans oppose. Another area of disagreement has to do with work requirements for things like Medicaid and food stamps. Those are things that Republicans are calling for, Democrats are opposed to. So there's still quite a lot of distance there. We still do have some time before the X date, which Janet Yellen says could be as early as June 1st. One thing to keep in mind amid all this is that there's Senate Minority Leader Mitch McConnell, head of the Republicans in the Senate. He said, I think everybody needs to relax, that regardless of what may be said about the talks on a day-to-day basis, the president and the speaker will reach an agreement. So a little bit of optimism from the Republican leader in the Senate. Whether others share that, we will see in the days ahead, Tom.
It's getting very close to the wire, isn't it? Running down the clock, as many had expected as well. Bruce Einhorn, thank you for the latest and the details on what is happening, of course, in DC around the debate and the conversation on the debt ceiling. Let's bring in, for the market reaction then, Bloomberg's Christine Aquino. Christine, what do you take then? To some extent, this was expected. They're going to run it down to the wire, but the volatility that many of the strategists we've been speaking to, it's coming back, and the selling pressure clearly pronounced across U.S. equities yesterday, and that's been felt in Europe today.
Absolutely, Tom. I mean, I think that is the situation at the moment is that it's coming down to the wire, and markets are aware that it was always going to be like this, as it had been in the past the episodes of the debt ceiling saga. But, you know, I think we're coming down to it. Markets are kind of putting it more squarely on their radar. But again, markets are terrible at pricing political risk, and so this will be something that would really come to fore, perhaps once we get really close to that X date that Janet Yellen highlighted. The one thing that we are observing in terms of the market reaction is definitely a move away from that duration play. This is something that you really don't want to be exposed to, the longer end of the curve for treasuries, just because the idea of a U.S. default, however unlikely, is definitely not going to be great for those longer term bonds, and therefore a lot of movement toward the shorter part of the curve as we come closer to that date.
Well, you can clip a 2% coupon on T-bills maturing May the 30th versus 6% on June the 6th. Of course, that after the date, the X date that Janet Yellen has flagged. We have the FOMC minutes out later today. Where are we in terms of the debate around the pause? Can we lock in the pause in June, given the comments from Jay Powell, or do we have to weigh up what Jim Bullard had to say about his views on a further 2 hikes?
Yeah, it's very interesting. I mean, you can tell that there is definitely still this internal debate within the FOMC. I mean, we did get a very definitive signal from Jay Powell that a pause is quite likely at the next FOMC meeting. But, you know, your resident bulls, Jim Bullard, one of them, of course, still arguing that the Fed has more to do on inflation before they really get a handle on that. And so, you know, it's going to be interesting how that debate prevails. We do know, of course, that Bullard, not necessarily a voter this year, but of course, markets in particular pay attention to what he says, as well as some of the more hawkish FOMC policymakers who have voiced similar concerns over what the Fed still needs to do when it comes to reining in inflation.
Okay, excellent. Christine Aquino setting us up for what the markets are focused on today ahead of those FOMC minutes. James Bullard, of course, not a voting member, but someone who is prescient in terms of the need for the Fed to go early on rate hikes. Coming up, it's possible there may be no US debt deal. That is according to Roubini Macro Associates CEO Nouriel Roubini. Wait a minute, he's sounding bearish. Shock horror. We spoke to him a little earlier at the Qatar Economic Forum. Don't miss that interview next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
We don't know yet. They may get to the last agreement, or it's possible they don't reach an agreement. If that doesn't happen, then the market is going to crash, and that may force an agreement in the next few days.
Does that erode the credibility of the U.S., of the dollar, and American financial markets?
Well, there is a lot of talk these days about de-dollarization. The Chinese definitely want to increase the role of the RMB. If the U.S. were to have a real problem with debt, with a credit event and so on, that's going to increase the likelihood that people are going to diversify over time away from dollar assets. That's a possibility, of course.
Nurul, there's so many stories here about, of course, big Wall Street titans arriving here and waiting for 3-4 hours to get an audience with the Sovereign Wealth Fund and other decision makers. Is this region going to dominate economically for the next decade?
Well, certainly we've had recently an energy boom. Is going to stay here even if there has been a correction of energy prices, and therefore this country are building up massive reserves, assets that they have to deploy, and therefore every asset manager in the world or banker is here because there are lots of opportunities of investing within the region but also outside the region as well.
And we hear, of course, about diversification, wanting to get into other asset classes. Where does this Middle Eastern money, what does it change? Is it private markets? Is it other parts of the market? Is it credit?
Probably private markets. Public equities have been maybe somehow overvalued. There are still opportunities in private markets. There's lots of technological innovation. Everybody, of course, is talking about AI, machine learning, quantum computing, robotic automation. The future is still in technology. There are lots of people raising money, and therefore investors in the region want to be part of that upside as well.
That, of course, Rubini Macro Associates CEO Nora Rubini, sporting something of an undertaker look there. Speaking to Bloomberg's Francine Lacqua a little earlier this morning. Francine is in Doha, of course, at the Qatar Economic Forum. To what extent then, good morning, Francine, to what extent is the debt ceiling dominating the conversation there? What else is standing out to you?
Well, Tom, it's interesting. When you speak to a lot of investors here, they talk about the debt ceiling, but it's not something that they see looming, largely because this region has so much money, especially since the Saudi and the Qataris made up. We had an energy panel, and the first thing that the Saudi oil minister came and said was, I am so happy to be with my friends in Qatar. This was really a kind of bromance between a lot of the ministers to show that this is a united front. And so when you look at the debt ceiling, they almost see it as a U.S. problem as they're trying to maybe get closer to China and other parts of the world. So yes, we had a conversation also with Steve Mnuchin, the former secretary of Donald Trump. He says, look, they'll find an agreement, but if there's a kind of a credit event, which is what Nouriel Roubini was explaining, if there's anxiousness in the markets, then it could lead towards longer and more pronounced de-dollarization of the world. Again, it would take time, but it's certainly something that is underlying some of the conversations here in Doha. Now, a little bit later on, we'll also focus on the region economically. The IMF managing director will join us for a panel with the Saudi investment minister and the Qatar central banker. And then a little bit later on, also a conversation with Steve Schwartzman. Now, that's a conversation not only on private equity, on investment, but also on politics and the debt ceiling.
Okay, excellent. Thank you, Francine Lacroix, on the ground for us in Doha at the Qatari Economic Forum. Lots of more big-name interviews coming up, of course, in the hours ahead. Let's get the Bloomberg First Word News now with Alex Morgan. Alex.
Tom, good morning. UK inflation was hotter than expected last month, with services and core prices rising at over the fastest pace in over 30 years. CPI hit 8.7% in April. That's exceeding all estimates in a survey of economists. Well, the pound climbed as pressure intensifies on the Bank of England to keep raising interest rates. Russia's Prime Minister has kicked off a two-day visit to China as Moscow looks to deepen trade ties with Beijing. Mikhail Mishustin reportedly told a business forum that in Shanghai that China trade had helped Russia decrease its dependence on the dollar. Well, according to the Russian news agency Interfax, he also said Russian farmers are ready to significantly increase their agricultural exports to China. And Bloomberg has learned that the Florida governor, Ron DeSantis, will announce his 2024 presidential campaign in a Twitter Spaces live stream alongside Elon Musk. Sources say DeSantis will speak with Musk at 6 p.m. Eastern on Wednesday, and the campaign will release a launch video. Well, that announcement will set up a confrontation with the Republican frontrunner Donald Trump for the party's nomination. That is Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan, and this is Bloomberg. Tom.
Alex Morgan here in London. Thank you very much indeed. Let's check in on some of the individual corporates on the move. It's a big win in terms of the earnings picture for M&S, and the stock is up on the back of the news that earnings came in better than expected. Revenue, sales, both higher, and M&S saying as well they're going to restart their dividend. Modest dividend is what they described that in November. Yes, costs were an impact in terms of wages, about £100 million for the year. Energy prices about 50 million, but they can offset that, they say, through cost cutting and investors rewarding M&S on the back of those numbers. SSE also coming in with a big beat, returning money to shareholders and upping their investment in green energy after doubling revenues on the year, gaining 1.6%. Oh, look at that. A very different picture for Embracer. This is the maker, it's one of the biggest games makers here in Europe. It's the maker of Tomb Raider, and they had to cancel unexpectedly a partnership that would have borne in about $2 billion worth of revenue. Investors punishing that stock. Lara Croft needs to come to the rescue of Embracer, currently down 37%. Let's get to another big story crossing the wires just in the last hour or so. The Competition and Markets Authority has said traders at 5 major banks colluded in chat rooms to swap sensitive information on UK bonds. Joining us for the details is Tom Metcalf, who leads our coverage on UK and Middle East finance. Tom, what exactly is being alleged?
Yeah, so the CMA has come out here with its preliminary findings, so the probe is still ongoing. But basically saying that those 5 banks, on a one-on-one basis, some traders were swapping sensitive information, which may have got, been anti-competitive behaviour. I think the thing I'd emphasise, look, it's preliminary. You've had Deutsche Bank, who kind of whistle blew on this, admitting guilt, and Citi kind of also sort of accepting the sanction. But HSBC, Morgan Stanley, and RBC are all saying, look, we're cooperating with the CMA, we disagree with their findings, and we're going to contest them.
So I guess the big question is then for investors, how bad could it get, or could it be for these banks?
Yeah, look, no sort of delta on there, any fines, for example, that could come through out there. I mean, if you look at what the CMA traditionally does, we're talking like low millions of fines. So, perhaps a useful sort of comparison is a while back they fined, I think it was 10 construction firms for anti-competitive behaviour, and those total fines, were about 60 million for all 10 firms. So we're not talking like hundreds of millions, it's more like, obviously not great, looks-wise, but I don't think it's going to materially hit the kind of the bottom line.
Okay, still a bit of an evolving story. Tom Metcalf with the latest on that decision by the CMA, of course, heading our EMEA finance coverage. Thank you. And the UK, of course. Talking of the UK, coming up, UK CPI shows a sharp drop, but inflation is still stronger than expected. Core is looking painful for the BOE, and you're seeing the markets reacting to that. We're going to break the numbers down for you after the break. That is next.
Person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very carefully.
Nobody covers business like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I mean, we've been, the politicians in Washington have been playing with the debt ceiling for decades. And, so far there's not been an accident. Of course, every time it happens, we wonder, given how crazy the politics is in the U.S. right now, is this going to be the time? But the fact is, the treasury markets are behaving well, credit markets are behaving well. So the market is not pricing in a bad outcome here.
Standard Chartered CEO Bill Winters on the US debt ceiling. Welcome back to the Open. 21 minutes into the European trading day. You're seeing losses fairly pronounced across these European equity markets. Across the benchmark, selling and currently down 1.2%. Similar picture on the FTSE 100. Over in France, the CAC 40 off by 1.4%. We continue to focus on the luxury story and the turnaround that we've seen in the last couple of days there as well. In terms of your sectors, the biggest losses coming through for real estate. That sector down 2.8%. Basic resources also being hit. Iron ore, copper are down. Brent and WTI, though, a bit of a recovery for oil on the back of those comments from the Saudi energy minister to Bloomberg yesterday, saying and warning against short selling of the commodity. Telecoms is the least badly performing sector, currently down 0.5%. And the futures in the US, S&P E-minis pointing down by 0.2%, building then, it seems, on the losses of yesterday on Wall Street, on the concerns that we are now at an impasse between the Republicans and the team around the president on this debt ceiling. Let's get to what's happening here in the UK then. And again, the FTSE 100 down 1.2%. It's all about inflation, though, today. The pound is high. Gilts are selling off. UK inflation drops into single digits, but the numbers still exceed all estimates as core prices continue to surge. Let's get the details with Lizzie Burden, Bloomberg's UK correspondent. Lizzie, how do we interpret this data then?
So we're down from 10.1% to 8.7%. As you say, back in single digits, but economists had expected 8.2%. The Bank of England itself had expected 8.4%. So it comes back to questions around the Bank of England's economic forecasting, its modelling, which the chief economist Hugh Pill actually raised himself in Parliament yesterday. Governor Andrew Bailey said it's partly because of the assumption that inflation would fall as fast as it rose, and it hasn't. The fall is almost entirely accounted for by base effects. So this near 50% rise in household energy bills that we saw last year effectively fell out of the annual comparison. But you've got annual food price inflation still at near historic highs, even if it ticked down. So that's going to hurt the poorest Brits the most. Remember, Andrew Bailey's talked about grocers, food producers trying to protect their margins. And what's also worrying is if you strip out food and energy and you look at core inflation, that was expected to hold steady, and yet it rose. So that's what's really worrying for the Monetary Policy Committee. And as a result of this print, traders are now pricing for the peak rate to be 5.5% instead of the 5% they saw beforehand.
Yeah, that core inflation shocker. And you've been having a really important conversation with the Shadow Chancellor. Labour, of course, Rachel Reeves. And let's be frank, on the polling, the current polling, this person, Rachel Reeves, has a very good chance of being the next UK Chancellor within the next 12 to 24 months. Talk to us about the key takeaways from this conversation.
Yeah, the polls say she's the Chancellor in waiting, and she says that she wants to have a more activist, interventionist state, what she calls securonomics. So in contrast to the government's approach, Rishi Sunak has been warning about setting off a subsidy race among G7 nations in response to Joe Biden's Inflation Reduction Act. This is her plan. She's setting it out today in the US, which is an interesting location, isn't it? She says that she wants more cooperation with international partners. She says Britain's too closed off after Brexit because of the economic barriers that have been set up. So we asked her, are you planning to rejoin the single market and the customs union? She said no, that it's about other things that they can do, like mutual recognition for professional qualifications. You have to ask whether that's just tinkering, whether it will really boost economic growth. But why take it from me? Take a listen to Rachel Reeves herself.
Securonomics is an approach that builds on the contributions of more people in more parts of Britain, and with a more secure national economy, taking advantage of some of the big opportunities, but also ensuring our resilience, our strength and our security to give families that security that they desperately crave right now.
So you can listen to that full interview with me and Bloomberg Radio's Caroline Hepker on the UK Politics podcast today, this afternoon.
Really important conversation. Tune in, download the podcast, the Bloomberg UK Politics podcast, for that full interview with someone who's been described, of course, as the Chancellor in waiting. We'll see if that holds up, of course, but nonetheless, a really significant figure within UK politics. Let's check in on gilts right now, because the sell-off is pronounced. Ven Ram of our MLive team saying this is bringing back reminders and not comfortable memories of that UK mini budget turmoil that we saw. Look at that, 28 basis points move higher in yields on the sell-off at the front end. 441 on the 2-year, 432 on the 10-year, a move higher there by 17 basis points. But the selling pressure coming through to the front end. Ven Ram of our MLive team saying that is likely to continue. Let's check in with the Qatari Economic Forum now. Live pictures of Manus Krani sitting down with Georgia's Prime Minister at that panel, and of course you can keep across everything coming out of the QEF, and we already had market-moving conversations on, of course, the live TV, live go, and on your terminal. Stay with us. This is Bloomberg.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies, and I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg.
Welcome back to the Open. We are 30 minutes into European trading day, and here are the top stories. House Speaker Kevin McCarthy says there is still no deal to avert a US default. The top Republican aide adds no more meetings are planned. Stocks and US futures are in the red. Fears of US slowdown hit LVMH and Hermes, wiping out $30 billion from the sector. The fortune of Bernard Arnault, the world's richest man, tumbles by $11 billion. Plus, UK inflation comes in hot, with core prices rising at the fastest pace in over 30 years. The pound jumps on speculation the BOE will need to keep raising rates. Let's check in on these equity markets then. The sell-off is pretty pronounced now across the benchmark, down 1.3% on the risk-off moves as a result of the caution and the deadlock that's coming through out of Washington. The concern that there are no more meetings as the clock, of course, is ticking down towards that ex-date of June the 1st, according to the US Treasury Secretary. Over at JP Morgan, Kalanovic is saying you want to be putting your money into cash and cutting your exposure to equities on these risks. The DAX is down 211 points. The FTSE 100 bleeding as well, down 1.4%, a loss of 106 points. And of course, we weigh in the inflation data out of the UK. Let's have a look at these sectors, though, before we break down the details there. Core inflation, and that shocker as markets now start to reprice a terminal rate here in the BOE of 5.5%. And the sell-off in gilts is pronounced. Telecoms, the least badly performing sector, down 0.5%. But there's bloodletting in real estate, down 2.6%. Basic resources also taking a hit. That ties into the China story. Iron ore is down again. Copper is off as well. The concerns about the growth prospects also filtering into the equity markets of China, erasing essentially all of the gains year to date across the benchmark CSI 300. That's the check in your sectors here in Europe, though. Let's get to what's happening in the luxury goods space. That's another area of pain on the back of the concerns around the US. A blistering rally in luxury goods stocks this year. It's taken a hit, wiping out more than $30 billion from the sector on Tuesday. As we mentioned, shares in LVMH, Hermes and Gucci owner Kering all slumped as analysts flag slowdown in the US as a growing concern. For more, let's bring in Bloomberg's Caroline Connor in Paris. Caroline, explain to us then what happened with luxury stocks on
luxury sector on Tuesday. That's because, this sector was priced for perfection. That's what one colleague from the stocks team told me this morning. So basically just one little cloud in the sky, just one shadow on the ball can actually create this market rout for luxury stocks, where you've seen a very high valuation since the beginning of the year. So on Tuesday, you had two analysts actually saying there might be some doubts on the US consumer. One note from Deutsche Bank calling to be more selective in the luxury sector, and Morgan Stanley analyst at this luxury conference in Paris also flagging a more subdued US demand, and also saying that there might be a weakness, quote, in the aspirational consumer in particular. So these entry-level, younger luxury shoppers, and that sparked this market rout from the luxury sector on Tuesday.
Yeah, and as you said, the rout continues. So is this the end then of the rally for luxury stocks, or does news out of China in the next couple of months support this sector?
It might be a little too early, Tom, to say this is really the end of the rally for the luxury sector, because if you look at the share prices since the beginning of this year, for example, LVMH is up more than 20%, Hermes is up 30%, even Kering, the owner of Gucci, which has suffered from the transition with this new designer, is also up 11%. A lot of the luxury stocks are outperforming the Euro Stoxx 600 in Europe, but definitely there might be clouds in the sky with the concerns over the US consumer that might slow the rally. You also have a lot of American shoppers benefiting still from the strong dollar and actually shopping abroad, shopping in Paris, buying their Louis Vuitton handbags in Paris rather than the US. So that is also, of course, weighing on the US demand. And as you mentioned, you have the China story, the concerns over the rebound in China. The first quarter earnings season for this luxury company, especially LVMH and Hermes, was all about the rebound in China, the buy-and demand for luxury in China. And now, of course, you have the idea that we could see as many as 65 million COVID cases a week in China by the end of June. And that would, of course, weigh on the Chinese consumer and the Chinese luxury shopper.
Okay, Bloomberg's Caroline Corner in Paris with the latest on the travails, at least for now, of this luxury sector. Let's just bring you up to speed on what's going on in Doha at the Qatari Economic Forum. Our very own Jen Dabasaja is sitting down, as you can see right now, with Ghana's president for a conversation. Of course, you can go to LiveGo to keep across all of these interviews, all of these panels. And again, we've already had some market-moving interviews, so keep across this. This is Jen, our Africa correspondent, sitting down with the president of Ghana. Now, talking of QEF, the CEO of TikTok has slammed the American state of Montana over its ban of the popular app. Joel Chu has been speaking at the Qatari Economic Forum in Doha. Have a listen.
We believe that the Montana bill that was recently passed is simply unconstitutional. And as you pointed out, we very recently filed a lawsuit to challenge this in the courts. And we are confident that we will prevail. I think, ultimately it is about providing value to these users and making sure that, we continue to provide them with a great service that benefits them. And that's, our key focus at this moment in time.
Expressing oneself, was that quite hard to express yourself most recently when you were in Congress, when you were having to try and tell your story of why TikTok is important to the United States?
I think it was a very important process, and I'm very grateful for the opportunity to show up and to tell our side of the story.
Could you tell your side of the story?
Throughout the 5 hours, I believe I had time to do that. Yeah. And I think it's a good opportunity for us to explain ourselves, because there are some myths and misconceptions about our company out there. Now, beyond that, we have built over the last 2 years something we call internally Project Texas. And what it really is to ensure that American data is stored on American soil by an American company and overseen by American personnel. And this is truly an unprecedented project that none of the other companies in our industry have ever attempted. And we believe that we have taken steps that are above and beyond what our industry has done to protect the safety of US user data, which is very important.
Where are you with Project Texas? Because there's been some reporting, and I know that you've come out and said very soon Oracle will have the unprecedented access to our data, or indeed to the ways in which of your source code. But that's not now. When will Oracle be able to enact this sort of unprecedented overseeing and transparency of your company?
Project Texas is a very complicated project, and a lot of the elements of the project is already in place and operational. For example, today, by default, all US data is stored in the Oracle Cloud servers already, in the Oracle Cloud infrastructure, and no longer in our own servers in Virginia and in Singapore.
You've already done that transfer?
It's already done by default, correct. Separately, Oracle has begun the review of the code, although it's, as you can understand, a complicated project that will take time for us to finish the details. So it's on track. Oracle and ourselves are working together with the US government to finalize the details of Project Texas.
The CEO of TikTok there speaking to Bloomberg's Caroline Hyde at the Qatar Economic Forum. Coming up, China's new ambassador to the US says the relationship is facing, quote, serious challenges. We get the view from Ke Yu-jin, the author of the new book, The New China Playbook, on the world's second largest economy and the prospects going forward. Stay with us. This is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Seeing the power of what the internet did and what communications and information technologies did to our economy, I think this is even more profound than that. And it's at a global scale to transform an energy system that is huge, incumbent, and it's got to happen fast if we're going to have a planet that's livable and have a secure future for our children and grandchildren.
That was John Podesta, White House senior advisor, who features in the first episode of the new series of Leaders L'Aqua Goes Green. Now, China's new ambassador to the US says the relationship between the world's two biggest economies is facing, quote, serious difficulties and challenges. Relations have been derailed amid disputes over spying allegations, Taiwan's sovereignty, and US technology export controls. My next guest says America's understanding or misunderstanding of China's economic growth keeps the two nations in unnecessary conflict. Ke Yu-jin is author of the new book, The New China Playbook, Beyond Socialism and Capitalism. She's also an associate professor of economics at the London School of Economics, LSE, of course, and advised the World Bank and the IMF. This is the book. Ke Yu-jin, welcome to the studio. It's a really important read for an understanding and as well to dispel some of the myths around China, whether it's the myth that China can't innovate, whether it's the myth that there are all these white elephant projects that stand out in the countryside of China that have been not filled up with people and commerce, or the myth that this is a Marxist theology state, or indeed, on the flip side, a state that is just rampant capitalism with the overtures of Marxism and communism. Talk to us about what you see as the key misunderstandings of this economy.
Well, people assume that it's a centralized approach dominated by an almighty state, but really the characterization is political centralization, but economic decentralization, where you have all these mayors around, innovating and breaking rules and really galvanizing creativity from the ground up. 40 years ago, 70% of the wealth belonged to the state. Today, 70% of wealth belongs to the private sector, which is really the main driver of the economy. So that's a key misunderstanding.
I remember that. I remember being in the city of Guangzhou and a local mayor saying, and being really ambitious around competing with Shenzhen, and that rivalry was real. You talk about the fact that this is a system that has political centralization, but economic decentralization. I just wonder if that held up until 2012, or at least up until recent years when President Xi Jinping took over. Because that held up under Hu Jintao, Wen Jiabao, held up under Jiang Zemin and, of course, Deng Xiaoping. But does it hold up now as the state increasingly pushes its way into the private sector under Xi Jinping?
Well, that's the feeling we get from looking outside, but really this model is going to stay into the future. If you look at technology, the distribution of unicorns around country are everywhere in second-tier cities, not just concentrated in Beijing and Shenzhen, and the local mayors are pushing them. Hundreds of EV companies, thousands of autonomous related all over China, and there's local competition. And that's how they're going to protect the environment, that's kind of how they're going to push reforms, and that's the key model that will stay.
There is that appetite around risk-taking, and you talked about it. I'm going to quote from the book. One big factor in the success of China's economy is its ability to embrace change, innovation, and risk, qualities we don't typically associate with politically centralized regimes. Again, I've got to push you on this. Is the risk-taking being curtailed? When we look at the technology crackdown, the crackdown on education startups, the crackdown on the real estate sector, the build-out of party cells within the private sector, that risk appetite has been diminished.
Well, reforms started from breaking rules. So they were definitely more entrepreneurial and risk-taking in the past, the local mayors, and certainly has curtailed. But let's just say we need to separate the hype from the reality. On the ground, the local governments need to fill their coffers, need jobs. Where does it come from? It comes from the private sector, and there's still a lot of autonomy. If you look at what's happening in China today, they're still pushing to build industrial clusters, many Silicon Valleys running around, going to business, even foreign businesses. That's what's happening on the ground.
And I'm speaking to foreign businesses and foreign investors, people who've had long-time exposure to China. I was speaking to a venture capitalist just a couple of weeks ago. He said he was in Beijing and he's never seen such aggressive outreach to foreign investors. So that's happening on one side. On the flip side, you're getting this crackdown. You're getting the anti-spying laws that are coming through. You're getting the crackdown on consultants like CapVision. And that, again, is sending shockwaves across the foreign investor base. How do you square those two positions?
Well, what seems as irreconcilable paradoxes to the Western eye can actually coexist in China. So there's the macro and the micro, and they will happen all simultaneously. But let's just say that China, or the leadership's approach is, let's not become an American style in equal capitalist society, singing to the tunes of capital, but politics is always going to be above capital. And China's going to try to balance between security and economy going forward, and swing between pillars like the economy and social stability.
Is security trumping the economy right now?
Well, it will depend on what time we're talking about. Right now, it's economic pragmatism full on. But then who knows what's going to happen in the next few months.
Talk to us about the financial sector. I remember when Wall Street was clamoring at the doors, they managed to get more exposure, more of a footprint. The big banners, JP Morgan and others building out in Shanghai, increasing their footprint. Now there is deep caution and concern about pushing into that market. And part of the rationale from the Chinese officials' perspective was you want to rationalize this market. You want to be able to educate investors. You want to be able to get those domestic players up to par. What do you see as the future for that financial sector in the capital markets of China?
Well, I think the financial system is the last dinosaur, the last place to be reformed. Even today, only 10% of aggregate credit comes from direct financing for firms, so a majority is still state bank, and it's kind of antiquated. But the real question is the government ready to cede control? And as my title of my book, The New China Playbook in the New Era, they're going to have to. They're going to have to manage expectations, sustain confidence, which is today's economic problem, and they're at the same time opening up to foreigners, inviting them in, but they're spooking investors because they can't sustain that confidence. So it's going to be very difficult to kind of to instill that level of confidence.
Okay, so the financial sector is one of the last dinosaurs. I really like the way you phrase that. But in the book as well, you talk about the successes that this unique model has provided for China, the people of China, and businesses and households in China. One area, of course, is technology and innovation. Again, the myth that China can't innovate, let's put that one to bed. There's plenty of innovation in China. But we look at the semiconductor space, and we had a reminder of that this week with the ban on Micron. And one expert came onto the show saying, China can ban Micron because these are chips that are easily replaceable. When it comes to processors and AI chips, it's a very different story. China has a long way to catch up. The model is not providing the dividends that China have hoped when it comes to that catch-up in core tech.
Well, I think, the state, China has a whole of a nation approach, which means unlimited funding for key sectors, and that's going to be one distinctive feature. But also, China has a very important proximity between the downstream demand like AI chips and the chips themselves upstream. And that closed circle, that proximity is going to boost demand. And now a lot of the demand is redirected back to domestic companies, something that we haven't had before. So unexpected things might happen.
Okay, unexpected things might happen. I have 101 other questions, but we've run out of time. Ku Yijin, really appreciate you coming to the studio. Read the book. It's a myth buster on China and really important in terms of developing a deeper understanding of this all-important economy, of course. Ku Yijin, the author of the new book, The New China Playbook, and a professor of economics at LSE. Coming up, the Saudi energy minister warns oil short sellers just over a week before the OPEC Plus alliance is due to meet. More on the commodities picture next as oil rallies, at least in the session today. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Speculators, like anything in any market, they are there to stay. I keep advising them that they will be ouching. They did ouch in April.
Okay, that was the Saudi energy minister speaking to us at the Qatar Economic Forum in Doha with a warning for short sellers on oil. For more, let's get to Bloomberg's Stephen Stupczynski. Stephen, why is the market watching Saudi Arabia so closely? We're seeing Brent up on the day, up 0.9%, $77 a barrel.
You know, when we're about a week away from the next OPEC Plus meeting, there's a lot of expectation that they are going to probably, to some degree, cut supply. That's what I think after the comments we got yesterday, a potential implication. You know, we are in a softer market environment. Yes, we're up the last few days, but we've dropped a lot from where we were earlier in the year and last year. There are a lot of things happening. One, the potential recession, the weak rebound in Chinese demand. There's also strong output from Russia, despite EU and US sanctions on and price caps on Russian oil. A lot of that is still finding its way to the market, essentially adding a lot more supply into the market that folks didn't expect would be there. So that's been pushing down prices over the last few months. And perhaps OPEC Plus, when they meet, will decide to cut production again in another round. It's still unclear what they're going to do. But the comments yesterday from Saudi Arabia, the de facto leader of OPEC Plus, does look that they might do something that could potentially provide some ouching, something that would make short sellers unhappy.
Yeah, the technical term of ouching is really important to focus in on. Yeah, maybe a bit of a nod then, maybe a bit of a nod to the OPEC Plus cut coming up, if indeed it is. On copper, Stephen, is China going to come to the rescue of Dr. Copper?
It's not looking that bright, and that's why you're seeing prices for copper fall, below or towards $8,000 for the first time in many months. And I think a lot of people in the market, it's not just oil, but also for copper. A lot of people were expecting this Chinese rebound, and copper is so important. China is so important for copper. That Chinese demand really is what underpins, and we're seeing month after month consistently weaker data coming out, economic data, building data. There's also not that economic support, that stimulus for building, for industries that maybe a lot of the traders were expecting for China. And so because of that, those copper prices and iron ore and a lot of other sort of metals have been declining because of that.
Okay, Bloomberg's Stephen Stupczynski, thank you for the latest on copper and oil. Let's get back to the Qatar Economic Forum Doha, where John Micklethwaite is speaking to David Petraeus, KKR's partner and KKR Global Institute chairman, and of course someone who's been substantial in terms of forming modern Pentagon and military doctrine in the US, saying that so far, at least at this point, Chinese invasion of Taiwan is unlikely, being asked, of course, about the geopolitics of the region, saying that decoupling between the US and China is not possible. You can watch that live conversation by typing live go on your Bloomberg terminal. UK assets in focus, home builders tumbling on the back of expectations. Rates will have to go higher. The market's now expecting a terminal rate of 5.5% from the BOE after CPI and core came in hotter than expected. Gilts selling off, yields up. That is it for the European market open. Surveillance Early Edition is up next. This is Bloomberg.
Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
The top names in business are on Bloomberg.
America and China have a lot of common interests: climate, nuclear proliferation, anti-terrorism, global stability, and we have differences. We're capitalists, they're not, and it's okay. We can sort it out, but we need to keep the Western alliances together, not just around war and Ukraine, but around strategic economic relationships, including trade.
Nobody covers business like Bloomberg, your global business authority.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Debt ceiling impasse. House Speaker Kevin McCarthy says there's still no deal to avert a U.S. default. A top Republican aide adds that no meetings are planned. Inflation nation. UK CPI comes in hot, with core prices rising at the fastest pace in more than 30 years. Traders add to BOE rate hike bets. The pound pairs gains. Plus, it is day 2 at the Qatar Economic Forum in Doha. We're going to be speaking to global entrepreneur and former SoftBank executive Marcelo Claure and Sebastian Bazin, the chair and CEO of hospitality group Accor, this hour. For some breaking lines on the IFO business survey out of Germany, it comes in lower than expectations, 91.7. The estimate had been for 93. That is some disappointing data after we got PMIs in Germany yesterday that did show we're still not quite at that recovery. Some of the data came in better, but again, we're still looking at manufacturing weak. So the business survey coming in worse than expected. When it comes to these markets overall, though, it is UK inflation which has rocked them. Let me show you what's going on, because we are looking at equities that are sinking ever lower. It potentially is that tension of inflation. S&P 500 futures, they were higher to start the session, the future session. Now those are down 0.33%. Look at what's happening in the 2-year yield. The front end of the gilt curve is getting hammered this morning. Again, inflation coming in higher than every single expectation. It's not just about energy. Fears of this being entrenched. Look out for 4.67%. That is the word from Athela over at Saxo Bank, who says that is the level where we need to be worried that potentially the BOE needs to step in. Meanwhile, sterling can't hold on to its gains. It's that fear of the EM type dynamic where higher yields means a weaker currency. Red across the board when it comes to the European equity trading. That is map markets go on your terminal. Red basically everywhere. So yes, UK bonds plunged across the curve, especially in the front end after inflation data from April exceeded all estimates. It's prompted traders to ramp up bets on the Bank of England's peak interest rate. Joining me now is Bloomberg Markets Managing Editor Christine Aquino. Christine, is this LDI redux. Is that how bad the sell-off seems to be this morning?
Well, Danny, we're certainly getting to levels that we last saw during that whole fiasco that will forever mark Liz Truss's administration. So it is quite worrying this morning. But, you know, I think it is very much squarely an economic reaction to the data that we saw this morning, primarily that inflation shock, even though that number, the nominal rate of inflation, did fall back down as was expected. It still exceeded, as you mentioned, all the expectations, again proving that we've just completely underestimated the level of inflation in this country.
And it does go beyond energy, right? Because it was the headline figure that was troubling. And so, I mean, what does that mean for a BOE at this point? A BOE where Andrew Bailey at the start of this year said, inflation looks like it might be starting to turn a corner.
Absolutely, Danny. I mean, it definitely doesn't mean great things for the BOE. Their credibility was already being questioned, especially after they changed their economic forecast to something slightly more rosy at the latest Bank of England meeting, and then get hit again by an inflation shock. They have been repeatedly been surprised just by how persistent inflation has been, and today has been no exception. And so even yesterday, you know, when Andrew Bailey spoke to members of parliament, he did signal that the BOE was perhaps slow on the uptake in reacting to inflation, and today's numbers really just drives home that point.
Gotta say, there's gotta be some irony with today the RBNZ saying mission accomplished, not those words exactly, but saying that they're going to pause. So is the UK just, not pause, sorry, they're going to finish and potentially even cut next year. Does the UK increasingly look more like an outlier in terms of not being able to get a grips on inflation?
Well, it's certainly an outlier in terms of that nominal rate, right? It is the highest among major economies, certainly higher than what we've seen in the US and the Euro area. And again, like that contrast between that high level of inflation and Bank of England policymakers repeatedly signaling prior to this number that, oh, they may be nearing the end of their rate hiking cycle, only to be repeatedly proven wrong yet again by the data. And so it certainly is an outlier in terms of just kind of that messaging gap that we've heard from the BOE versus what we've seen in the hard data.
Well, what do you make of cable at the moment? It did spike higher initially on that inflation report, but basically gave up all the gains.
Yeah, very interesting dynamic in cable. I mean, in theory, right, more rate hikes should mean a stronger currency, but I think traders are now kind of trying to weigh up the implications of more rate hikes, especially when it comes to the economic impact. I mean, we know what we've seen from the Fed's experience that eventually, when it gets to a certain level, markets will start pricing in potential recessions, or at the very least an economic slowdown. And I think that is the dynamic that we're seeing in a pound at the moment. Gains in the short term because of those rate hike bets, but longer term pain because of the potential economic slowdown as a result.
Stepping back a bit into risk markets, yesterday, when there were, again, more concerns about debt ceiling drama, U.S. stocks sell off more than 1%. We get these U.K. inflation numbers. European stocks sell off more than 1%. How fragile is sentiment right now?
Very fragile, Danny. I mean, just looking at the volatility that we've seen, we've been swinging from gains to losses depending on the headlines. There is a lot of that at the moment, I think, that sort of headline trading feeling. I think just because there's really not kind of like one single catalyst that's moving global markets at the moment. I mean, as you mentioned, there are different narratives depending on which region that you look at, and so and all of that can kind of play out very differently and go in all sorts of directions. And so I think there's a lot of catalysts that markets are trying to digest right now. We're also heading into summer markets, which tend to be thinner, and so a combination of that really could make for quite a volatile summer coming up.
Yeah, if liquidity wasn't bad enough. Speaking of volatility, just want to end on this point, Christine, because it was driving the markets before the UK drama. The debt ceiling debate. You have Republicans saying that potentially June 1st, they're questioning whether that's actually the X date. Does it look like markets are finally waking up and paying more attention to the likelihood we might get a 2011 type event where we just come right up to that deadline and it causes still a sell-off even though an agreement is reached?
Yeah, it certainly does feel that the debt ceiling topic is more squarely on the market's radar. I wouldn't say that it's the only thing on their radar, but definitely as we approach that X date, as highlighted by Treasury Secretary Janet Yellen, it feels like that is the case. And, you know, we're already seeing a move away from that duration trade. That's definitely not something you want to be in, especially when you're considering the prospect of a U.S. default, however unlikely, and seeing more movement into those short-term Treasury bills as potential, shall we say, winner of this sort of debt ceiling debacle.
Yeah, exactly what we were just looking at with those charts, those T-bill yields moving up above 6% for some of those June dates. Christine, thanks as always for joining us. That's Bloomberg Markets Managing Editor Christine Aquino. Now, coming up, Francine Lacqua is live in Doha, hence why you're seeing me instead of her at this moment. She's going to be speaking exclusively to the IMF's managing director, plus the Qatari and Saudi finance ministers this hour. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Debt ceiling deadline closes
Back and forth on the debt ceiling debate. Kevin McCarthy says it's going to be on the floor next week.
Keep it tuned to Bloomberg for up-to-the-minute reporting.
Movement from the White House walked out of this meeting saying the White House was being unreasonable.
And first-hand analysis from the political and business leaders who matter.
The debt ceiling is potentially catastrophic.
We will not pass a clean debt ceiling. They should just simply do their job.
Both political parties are guilty.
For continuing coverage of the debt ceiling standoff, keep it tuned to Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to your first word news. With that is Alex Morgan. Alex.
Danny, good morning. Well, Bloomberg has learned that Florida Governor Ron DeSantis will announce his 2024 presidential campaign in a Twitter Spaces, that's a live stream, alongside Elon Musk. Sources say DeSantis will speak with Musk at 6 p.m. Eastern on Wednesday, and the campaign will release a launch video. Well, that announcement will set up a confrontation with the Republican frontrunner Donald Trump for the party's nomination. A British regulator said 5 banks colluded to swap information on UK bonds. Deutsche Bank, Citigroup, HSBC, Morgan Stanley and Royal Bank of Canada shared sensitive information between 2009 and 2013, as according to the Competition and Markets Authority's provisional findings. Well, fines could be issued for some of the lenders. Morgan Stanley said it's cooperating with the probe, but will contest those allegations. The 4 other banks didn't immediately respond to requests for comment. China's new ambassador to the US has acknowledged challenges in the relations between Beijing and Washington as he arrived to take up his post. Xi Feng says he intends to engage extensively with the Americans and properly handle sensitive challenges, including over Taiwan. Well, Xi had served in several roles at the embassy in Washington and was Beijing's top representative in Hong Kong.
At present, Sino-US relations is facing
serious difficulties and challenges. We hope that the United States will work together with China to increase dialogue, to manage differences, and also to expand our cooperation so that our relationship will be back to the right track.
And Netflix is bringing its account-sharing crackdown to the US. It's alerted customers that they must pay an extra $8 a month if they want to share their passwords with people outside of their household. Netflix began its password-sharing crackdown last year as part of a strategy to generate more revenue from its users. That is global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan, and this is Bloomberg. Danny.
Alex, thank you so much. I fear I still use my parents' Netflix account, so I, for one, am worried about that. Anyway, something many more people are worried about. The UK's inflation rate has remained much stronger than expected, with the fastest increase in services and core prices in more than 3 decades. The figures have fueled a flurry of bets on more Bank of England interest rate rises and a sell-off on the front end. 2-year UK gilts now up more than 26 basis points. Let's get to our Bloomberg UK correspondent, Lizzie Burden. Lizzie, it seems like the market isn't so pleased with this data. Just what did we see exactly in it?
Well, yeah, it's bad news for the Prime Minister, Rishi Sunak. His #1 priority is halving inflation by the end of the year. More importantly, it's bad news for households and it's bad news for the Bank of England. Doesn't look like they can take their foot off the gas. So we are in single digits, but this headline print is way above economists' expectations, including the Bank of England. So it came in at 8.7%. The BOE had seen 8.4%. And it points to problems with the Bank of England's modelling, which the chief economist Hugh Pill himself pointed to in Parliament yesterday. And the governor, Andrew Bailey, said, you know, there's a problem that they saw inflation falling almost in the same way that it rose. It has not. If you break it down, a lot of the reason inflation has fallen is because of base effects. So that 50%, nearly 50% rise in energy bills that we saw last year has fallen out in the annual comparison. But on the other side, food price inflation is still near historic highs, even if it's ticked down. So that's really going to hurt the poorest Brits. And then if you strip out energy, strip out food, and just focus on core inflation, that was expected to hold steady, but actually it rose. It's risen from 6.2% to 6.8%. And that points to the stickiness of this inflation, which is what the Monetary Policy Committee will be really concerned about. And this is why traders have increased their bets for BOE peak rates from 5% to 5.5% now. And it would be significant, wouldn't it, if the Bank of England breached that 5% mark, because that's what they've warned about households seeing as a dangerous level.
Yes, I mean, the point you make about forecasts is so great. I know the BOE got a lot of ridicule in some of the charts they put out, just the wide bands where they see GDP. Speaking of growth, speaking of business, you also spoke to UK Shadow Chancellor Rachel Reeves yesterday. What were some of your main takeaways from that conversation?
Yeah, I mean, the polls suggest that this is Britain's Chancellor in waiting, so really significant that she's setting out Labour's economic plan today in the US. We got to catch up with her for the UK Politics podcast. She spoke to Caroline Hepker and me, and what she was saying was that she wants to go for secureonomics. Well, what's that? That is Labour's idea of trying to be the party of business through a more interventionist, activist state approach, which contrasts with Rishi Sunak's response to Biden's Inflation Reduction Act. He has warned about triggering off a race in state subsidies, but this seems a bit more in line with Bidenomics. She wants to boost growth in, for example, life sciences, green energy. She also, it's significant that she's announcing this in the US, wants more cooperation with international partners. She says that Britain's become too closed off after Brexit. So we asked, would you rejoin the single market and the customs union? The answer is still a clear no from Labour. What she wants to do is try to reduce some of the trade barriers. So, for example, more mutual recognition of professional qualifications. that may to many seem like tinkering around the edges at a time when Britain is clearly desperate for economic growth.
Right. And of course, we can listen to the full interview on the podcast. Remind me of the name where folks can find it.
UK Politics Podcast. It's out this afternoon.
Love it. Looking forward to that. Lizzie, thank you so much. That is Bloomberg's Lizzie Burden. And we, of course, cover all things UK every week on Thursday at 9:30 a.m. London time in our half-hour special. So that's tomorrow. Won't you listen to that? Now, coming up, much more from the Qatar Economic Forum. We're going to hear from Marcelo Claure, the founder of global investment firm Claure Group, as well as Sebastian Bazin, the chair and CEO of hospitality group Accor. This is Bloomberg.
Person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
At the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
Seeing the power of what the internet did and what communications and information technologies did to our economy, I think this is even more profound than that. And it's at a global scale to transform an energy system that is huge, incumbent, and it's got to happen fast if we're going to have a planet that's livable and have a secure future for our children and grandchildren.
That was John Podesta, senior White House senior advisor, who features in the first episode of the new series of Leaders with LACWA Goes Green. Standard Chartered CEO Bill Winters says he's heard reassuring comments from Washington on resolving the debt ceiling tug of war. He spoke to Francine in Doha.
Of course, we're worried about the debt ceiling, but I heard the reassuring comments both from President Biden and
Speaker McCarthy yesterday. I have to think these guys know what they're playing with, so I'm okay on that. I think this the structural resistance of inflation to come back down. That's the biggest concern. Not right at this moment, but just as that plays out over time, what's economic growth look like? I've been very impressed by the resilience in the U.S., in Europe, and of course this region, the Middle East, is booming. Asia is booming. India is booming, despite higher interest rates. So things feel okay.
Bill, if you look at the debt ceiling, even if we have resolution, are we playing with fire? Does it actually put the U.S. as reserve currency, as leader of the free world, at risk?
Look, I mean, we've been the politicians in Washington have been playing with the debt ceiling for decades, and so far there's not been an accident. Of course, every time it happens, we wonder, given how crazy the politics is in the U.S. right now, is this going to be the time that... But the fact is, the Treasury markets are behaving well, credit markets are behaving well, so the market is not pricing in a bad outcome here.
There's a lot of money in the Middle East. Do you think they're after a bank like yours?
Look, I think everybody in the world would love to own a piece of Standard Chartered Bank because it's a strong bank, we're doing well, we've got this super interesting footprint across Asia, Middle East, and Africa.
So you're a takeover
and we're
target.
Cheap.
So you're
and we're
a takeover target.
Like I say, if somebody wants to come and say, we can add more value to this bank than what you're doing today, where you're growing at double-digit growth rates, profits at substantially higher, you can have an idea on how to do something better, please let us know. We'll come in. But is there, the fact is we're a global bank today. We're adequately scaled for the environment. We're growing quite nicely. That's all I'm focused on.
Okay, if you look at regulators in the UK and elsewhere, would they be ready for a takeover of a large systemic bank by Middle Eastern money?
Well, I noticed that there was a takeover of a large systemic bank in Switzerland a few weeks back, and it happened in a weekend. So I guess that means
that's domestic.
In the right circumstance, regulators can get things going. I think it's very impressive to see how the various investors in the Gulf. We're sitting here in Qatar today. I just had a panel discussion with the head of the Qatar Investment Authority. This is a very impressive investor with a truly global perspective, a lot of experience investing. And I think the various countries in the Gulf, of course, they're accumulating savings right now, and they're diversifying their economy. So that's why we're here. That's why we're investing so much capital into the Middle East, because we see these huge opportunities to connect that capital with all the opportunities in Asia and vice versa. So do you need to have a bank to do that? No, you need to have a bank like us that's prepared to play that bridging role.
Standard Chartered CEO Bill Winter speaking to Bloomberg at the Qatar Economic Forum. The market at the moment still reeling from inflation numbers in the UK that were above all the analyst estimates. That showed it's not just energy, it is core. It is sticky inflation. This is what it looks like over the 2 days. You can see that jump at the open, a gain of more than 30 basis points in the front end of the curve. I was talking to Thea Spinoza over at Saxo Bank earlier, who said 4.67. That is the level to watch out for when the BOE starts to get worried, when it looks something more like an LDI crisis. Elsewhere, you are still seeing strength in sterling. It did jump, but it's come back in. It is weakness across stocks, partially in reaction to these inflation figures. You also had the dampening effect of concerns over the debt ceiling agreement in the U.S., whether we would actually get one, and we continue to see weakness in European luxury stocks. Coming up, we are back at the Qatar Economic Forum. We're going to be hearing from the founder of global investment group, Clare Group, as well as the chair and CEO of hospitality group, Accor. This is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's take you live now to the Qatar Economic Forum in Doha, where Bloomberg's Francine Lacqua is hosting a special panel discussion with Kristalina Georgieva, the managing director of the IMF, as well as the Qatari and Saudi finance ministers.
In the World Cup, we are very proud of it in the region, as much as I'm sure the Qataris are. I can tell you we are very proud of how they organized it and showcased the capabilities of Qatar and the region. Going back to your question, I think this region, and we've said this before, and I'm not trying to sell, although I am to some extent selling, this region is a very bright spot in a very difficult world today. And this did not come by coincidence, really. I mean, it came through a very strong, rigorous execution of long-term, coordinated, well-aligned plans to diversify the economy, to make sure that your people are ready, so your training, your education system is up to speed with what's happening in the world. You are investing in technologies, you are investing in infrastructure, you are making sure that you think through what would make you more competitive in the global stage and set these policies. I'm sure the same across. What distinguishes this region, and I'll cover Saudi very quickly, is first of all, you are in a very unique location, in the middle of cross-trade routes, where you are connecting Asia with Africa, with Europe. That gives you a competitive advantage. And you are actually seeing it in the number of ports that on the top 10 worldwide are actually in the Gulf region. King Abdullah Economic City Port is actually #1 and 22 by the World Bank ranking on container ports. And the same actually in multiple ports in the region. This region have possibly one of the busiest airports worldwide in international passenger traffic. So this is an investment. This is long-term plans being executed. You could see a lot of efforts in investing in infrastructure. And these also long-term plans. And we are not keeping it to ourselves. Actually, we are trying to make sure that the wider region, not only the GCC, but the wider region benefits and see a role model in the countries of the region in terms of reform, in terms of taking long-term approach to their diversification drive, in terms of actually looking at their people and their prosperity. Saudi, and I'll close.
Bloomberg's Francine Lacqua there in conversation with Kristalina Georgieva, the managing director of the IMF, as well as the Qatari and Saudi finance ministers. You can watch more of that conversation by heading to LiveGo on your Bloomberg terminal. All right, let's take you to elsewhere at the Qatar Economic Forum, where political and business leaders are discussing the latest economic trends. Bloomberg's Caroline Hyde is also there, and she's joined by a global entrepreneur and former SoftBank executive. Caroline.
Marcelo Clare is with me, of course, Danny, founder and CEO of the global investment fund Clare Group. Of course, family office, billions under management, looking to expand. But what's so fascinating is you're stuck here right now in the Middle East, but really focused on Latin America, but bringing money, international money, into Latin America. You're now an executive with Shein, one of the most fast-growing fashion companies. Why Latin America? What are the growth opportunities there? What do you do to convince the money?
So I always wanted to go back. I've been very lucky, as you know, to run several global companies through my tenure at SoftBank and others. And I always had a special part of my heart being Latin America, since I'm from Bolivia. And the more I've traveled in the region, what I've learned is that Latin America is one of those few spots where I believe opportunities are greater than capital that's available today. So therefore, I look at a region where, because of what is going on in the geopolitical world, there is a lot of nearshoring or offshoring factors that are moving to Latin America, and you're having an investment boom in places like Mexico, where I don't think we would ever dream to have semiconductors being made in Mexico, electric cars being made in Mexico, and so on. So, from that part. And then secondly, commodities play a very important part of the economy going forward, especially as we start to electrify the world. And when you look at countries like Bolivia, Argentina, and Chile, 2/3 of the world's lithium sits there. Most of the copper in the world is being mined in basically Latin America. So I look at a combination of commodities, a young and thriving workforce, plus nearshoring, makes it, I think, an ideal place where opportunities will be great. And I've decided to dedicate the next 10 years of my life to putting everything I've learned to Latin America.
Okay, so let's talk about, first and foremost, the opportunities there. You're expanding, for example, manufacturing for Shein in Brazil, 100 factories, I think it is already. You're looking at Mexico as well. How do you think about, there are some ethical concerns around the ways in which some of these clothing were manufactured. You've done a tour of Shein's manufacturing. You feel comfortable with that? How do you want to see that growth be executed in Brazil and Mexico?
So the first investment after I've left SoftBank, my first family office investment was in a company that I've always been fascinating, and that's Shein. And what makes Shein different than any other company in the world, the ability to design, manufacture, and ship product in less than 7 days. Nobody else can do that. It takes traditional fashion companies 3, 6, 9 months to come up with new products. So I was fascinated by that. And the fact that there's no waste, because everything is manufactured on demand. So that was one. But before I invested and before I took an active role in the company, I decided to go to China and go visit the manufacturing facilities and go visit their employees, really get a sense, as an operator that I am, get a sense of how can this be possible? How can you design and manufacture so fast? And I came back extremely happy with the quality of the workforce, with the quality of the factories, and with one of these companies that's in high growth mode, full of young and energized employees. And this is why today this is one of the fastest growing companies in the world.
And one that could go public as and when the markets start to be more opportune for that. Do you have a timing, a sense of when you think companies will start to be able to become publicly traded companies and you can really make the most of some of the private money you've already put in?
Yeah, well, as you know, nobody can comment on the status of public markets or when and if Shein will go public. But what I can tell you is, having been around many companies throughout my career, this is one of the most fascinating companies that I have ever been part of. And this is why I've decided to be part of the executive team of the company, and a special focus on Latin America as probably one of the fastest growing regions for them in markets like Brazil and Mexico. where the demand for a great product at a great price with a large selection is such an important piece. So super excited to be part of Shein and super excited to be part of growth and probably one of the most disruptive companies that exists today.
You've already mentioned electric vehicles as well and some of the infrastructure around that. You must be thinking about artificial intelligence. How are you thinking about the companies you're already working with, adopting that, using it, becoming more productive, or indeed investment opportunities there?
Yes, so, we've been big fans of the AI world since our tenure in SoftBank. We made it the entire investment thesis behind all the investment we did at SoftBank was based on AI companies that are going to disrupt traditional business model. Well, I think AI is now in our hands. I mean, we see it all today. You can have ChatGPT or you can have Gen AI in your iPhone or in different phones, and people are starting to use it. For the first time the other day, I was shocked, and I have 6 children. I will not tell you which one, but I got a call from the teacher telling me that one of my daughters was using ChatGPT to basically get an extra help on their homework. And as a father, first it was a shocking moment because this has arrived to our family, to our house and all that. But I didn't know whether to be upset at my children for getting that help or actually being proud for enabling technology. I think AI is here to stay. I think we're going to see every single business model, industry, vertical disrupted through the use of AI. And this is not something that's going to happen in the far future. This is happening now. It's happening today. And all you have to do is, use ChatGPT to understand the power, what is happening in content, how are our elections going to be affected. There's so many fascinating things that are going to happen through the true introduction of AI into every single vertical. So we look at the next 5 years as the years where you should invest in AI companies.
Startups, it's not all going to be dominated by the big players such as OpenAI, them teaming with Microsoft or indeed a Google's Bard.
I mean, those are the foundational layers that are necessary, but the beautiful thing is disruption is going to happen in the application level, meaning you have so many different startups that are going to choose specific verticals, specific workflows to basically disrupt what happens there. Obviously, they're all going to have to be connected to one of the big foundational layer, but this is, to me, the internet at an exponential phase. I mean, when have we seen any application have 1 million customers in 5 days? That had never happened before. And the more you use it, the more it becomes part of your everyday life.
A lot of VCs I speak to want to talk about artificial intelligence because it's basically a silver lining amid some economic clouds right now. I know you can't speak much about the work at SoftBank and Vision Fund, but ultimately it was an area that they went big into startups, but we've seen valuations hit hard, unsurprisingly, by the economy we're in. Do you think we're at the end point now? Have we now seen valuations become at the level they need to be to vindicate the growth that we're seeing in these companies, or is there more to go?
Valuations are an indication of time, and I think people are confused between innovation, disruption, technology, and valuation. If we focus on valuations, the reason why valuations were so high because there was an unlimited amount of capital that was free. So when you have so much capital, there's a problem of quantity of capital. So obviously, capital is going to be deployed at an accelerated pace, and those companies, so therefore valuations are going to be high because it was a very competitive market. As interest rates rose, to where the levels that were today, those companies are going to generate less cash flow in the future, and therefore, logical thing is valuations are going to be different. But that doesn't mean the world has stopped. The technology companies have stopped innovating and disrupting, so that has not stopped. And what we're going to see now is valuations, to me, are an indication of the price of money and the availability of money. And today, there's less money than there was before. Money is more expensive, and therefore, valuations are going to be lower. And as interest rates, in the future will continue to drop, then you will see adjustments in valuation. I don't think we're ever going to get back to the times where money was free and there was almost an unlimited amount of money. But I think we're going to be getting to a point where, public markets have repriced to 50% below. Private markets have started to reprice, as you see in the next new round. And I think as long as there's innovation and disruption, there is going to be sufficient capital for those great companies. Not all companies qualify because when you have higher cost of money, not all companies will become profitable, so therefore it's a smaller pool of investable companies that we will have, but they're great companies in the making.
The capital, is it here in the Middle East? Are you raising funds? Are you able to hint at anything that you're currently doing? Because I know you want to expand from the family office base that you have.
So what we're doing is we're partnering. I'll tell you, it's the brightest spot to come visit the Middle East. I call it very similar to the new Silicon Valley from a capital availability. You see tremendous amount of capital outflow from both Qatar, Saudi Arabia, the Emirates.
And you'd take money from all of those countries?
I think what we're doing right now, as we're finding these great companies, we're finding individual partnerships with different sovereign funds, and they are incredibly active. But it's so nice to come here, young people, a lot of optimism. It's like a bright spot in a complicated geopolitical world that we live in today, and it's great to come, and it's great to see the level of energy and the level of positive people wanting to make an impact on the world.
And they're fans of soccer too, or football as I call it, and I know you are too. He was up at 3 in the morning watching his own team, Bolivian team,
Yes.
win.
They won, and now we're in the next round of the Champions League of Latin America, which is great. And for a country like Bolivia, that's a big deal because it moves the whole country.
We didn't get to talk about football investment. We'll do next time, I hope. I'm going to be on a panel a little bit later. Tune in for it. Marcelo Claure, who's founder and CEO, of course, of the Claure Group. Back to you.
Caroline, thank you so much. I can see why he was in such a good mood now. Caroline Hyde there at the Qatar Economic Forum. Now, I want to take you to elsewhere at the forum. Francine Locke was in conversation with the IMF Managing Director and the Qatari and Saudi finance ministers. Let's listen in.
In a fast-changing world, you cannot sit on your successes. You have to work for the future.
Thank you so much, Mr. Al-Jannah. How are you planning? How are you planning to spend Saudi Arabia's budget surplus?
First of all, let me just follow up on Kristalina's last comment. I think we take this very seriously. We are not complacent. We are not going to stop. We are actually looking at every opportunity and using every ammunition that we have to continue this journey. This journey is not going to end in 2030. This is an ongoing journey. There are a lot of opportunities that you could really capture and harness. Surplus is the nature of an economy where you have a fluctuating commodity and your economy dependent on that commodity. So you'll always have deficits and surpluses, and you use your deficits to grow your coffers and use your coffers when the cycle is down so that you could have a sustainable expenditure and not fluctuate, which hurts the economy. So that's really the short answer. The longer answer is you need to make sure that you utilize your reserves to produce more. By that, you need to make sure that it is invested properly, that if you increase your investment, you need to make sure that it increases in a return that is higher than your investment return. Because you are either investing or borrowing, and you need to make sure that the outcome of whatever you are spending as government will yield better economic results. We are doing that, and I'm sure the GCC countries are moving in that direction, making sure that really you are spending wisely, you are not spending on sticky expenditure that is very difficult to remove, and you are improving the quality of life of people. You need to make sure that you provide better services to have people enjoy their life.
Yeah. There's new research, economic from Bloomberg Economics, that suggests that the true break-even level for Saudi Arabia for the price of oil is $95 a barrel. Is that the case?
I don't think in Saudi, definitely we don't discuss actually oil price for a reason. We are a market makers. It's very dangerous really to start talking about specific oil price.
Understood. Minister, how are you spending your budget surplus? And actually, are there any plans to issue debt?
Yes. Well, I mean, first of all, I should thank, Kristalina for the nice words. And, again, I will say, yes, we take the work seriously. When we are doing good, it's worrying us more than when we are doing, bad. So because when you are doing good, because it's how we maintain it. But I want to say something. Yes, we have a vision 2030, but there is one vision. It has no end date. This vision is to provide quality for generations, and I think this is something we have to always. Sustainability of financial system, sustainability of economics. This is an endless goal, and this is a challenge always for us. So what we did, here in Qatar, we have developed a long-term fiscal policy framework with a very clear mandates how to deal in case of surpluses.
Bloomberg's Francine Lacqua there in a conversation with Kristalina Georgieva, the managing director of the IMF, as well as the Qatari and Saudi finance ministers. You can watch more of that conversation about the Gulf's global competitiveness on LiveGo on your terminal. Now, from energy to the travel industry, it's building back up after the tough years of the pandemic. That's one of the key topics at the Qatar Economic Forum. It's one that our very own Manus Cranny has been concentrating, and he's there with a guest. Manus.
Danny, I am indeed the CEO, Sebastian Bazin, the chairman, the CEO of Accor, in one of his pretty amazing hotels, the Fairmont. Next door is Raffles. I haven't got the budget for either. Good morning.
Good morning.
Afternoon.
How are you?
I'm grand. Listen, this place is full.
Yeah.
Emirates is full to the brim in business class. So too is Qatar Airways. Are you full to the brim, and are you charging to the max for luxury?
No, I should be charging even more. But I guess it's been a good, solid 7 months. Again, I've been in the mud for 2.5 years, so I'm finally smiling. But it is true that I guess prices went up almost 30% for luxury properties, 10 to 12% for mid-scale properties. But I think we can go more, provided we have the service up to it. So one of my discussion is labor shortage, but we may go back to this.
If I'm paying 30% more, or perhaps my employer is paying 30% more for me to stay in one of your hotels, what am I getting extra? Am I asking for more? What are you giving me for the 30% extra?
Experiences, curation, guide. One of the things we changed in the industry, for 20 years I wanted to kidnap you within my property, not for you to go out, for you to have breakfast, dinner, lunch with me, which was foolish. Now I want you to go out. So I'm going to be your curator when you go to Doha. That way you go to National Heritage Museums. And I'll be your eyes, and you'll be very happy that I get you to remember that Fairmont Raffles have done this for you. So curation.
That means a very different kind of staff, doesn't it? It's not just one concierge on the front desk. Have you got the talent pool? Do you hire locally? What's the biggest thing to deliver on that product for you?
It's the best thing to deliver on it is to turn upside down your thinking. Whatever you build, you design in any new location, build it for the local community. Get them engaged with you from the outstart. If they are engaged with you, they're proud to be part of the adventure. All of a sudden, they become the artisan, craftsmanship, the baker. They want to be part of you and the journey with your client. So make it for them as opposed to make it for the travelers. And then it's a win-win scenario.
Where's your RevPAR at the moment? Where's your strongest RevPAR? Of course, it's the benchmark the market is going to look at. They're going to listen attentively.
Singapore. So Singapore is very strong. Middle East is extremely strong. Surprisingly enough, Sao Paulo is very strong. It's been strong for the last 1.5 years. Don't ask me why, I don't know, but it's been very robust. And then likely south of France, we're looking for a great summer in 4 months from today.
Le Côte d'Azur and Le Voile Rouge, I remember them well. But do you have enough properties in that max luxury segment? Have you got enough capacity?
Yeah, we had very little 7 years ago. Now we're number 2 in the world after Marriott. We have a solid 500 luxury, ultra-luxury properties. So we're catching up, and I think we're going to be the leader in a matter of time. So in south of France, I need more of them.
So there you've heard it. Anybody with a large chateau for Sebastian, get in touch.
Because I'm a French guy. It's embarrassing.
Okay, well you should know your market then. Where is the strongest and heaviest demand? Are we traveling again to Asia? It's reopening. Akbar al-Bakr in the seat yesterday. China. What's your biggest problem in this scaling up and the reopening in China and Asia?
No, labor shortage, I think we're fixing it as we speak because we're giving a sense of purpose for people to come back. And there's no much bigger market than America. People didn't watch out for what's happening 20 years ago in China. They've been accelerating like 8 times greater and faster than America. So it's going to be a large market. China is reopening, so which helps me in Southeast Asia, Laos, Cambodia, Thailand, Burma. That is good. And the rest, my only question is the western north of Europe. So Germany, Holland, Scandics, those are today...
Sluggish?
Yeah, a bit sluggish because of all geopolitical problems, of course. So we're going to have to respond to this. The rest is just fine.
When we caught up a couple of years ago, you said, "Man, I'm going to hire back everybody that I let go in the pandemic." Have you done that and surpassed that? Where are you on the employment trajectory?
I'll give you a number, which is I didn't even know myself. For the last 12 months, Accor hired 123,000 people. That probably makes us top 5 in the world of having hired over 100,000 people the last 12 months. The good news, we hired 123,000 people, and we give a chance to many of them to find a job in life, and I'm super happy about it. Bad news, that means I've lost 100,000 people that I had to replace, because Accor today is 300,000 people. So 33% turnover, it's challenging.
Are you prepared to give them a pay rise?
It is true. We've been increasing payroll by 7% overall, and in some cases well above 10%. It is true. And you know what? We've been blind. We probably should have done it a long time ago. So the question of being get a pay for better service, for less constraint, one of the things we have to do, my business is human capital. So if I don't take care of my own people, they won't be able to take care of others.
Commercial property is about to take a hit, they tell me.
Yeah.
What does that present for you? Is that an opportunity to grab commercial property and convert it?
Well, I don't want to grab them, I don't want to lease them, and let alone I don't want to own them.
Okay.
But as an asset-light operator, I can tell you there's enormous millions of square meters in the world which is today unused, where probably not great optionalities for the next 24 months. I think we're going to be able to sneak in and offer hospitality kind of actually product within those commercial facilities for a while. So we don't have time now, but I guess we have a concept which is a flat pack, and we built a room within 48 hours, and we can remove it within 48 hours.
Is Noel Quinn knocking on your door? Who's the biggest bank that's talking to you? Break news.
It's actually the big JLL and Colliers as well. So it's actually done through brokerage houses.
So we're sitting in the Fairmont. It's on fire.
In between Fairmont and Raffles.
My apologies, everybody.
No, it's fine. You are exactly in between.
Come on. Where's your most expensive suite, and is it full all the time?
Probably Raffles, Singapore, as we speak. Yeah, but it could be probably, as of last night, it could be actually here.
How much are you getting for Raffles in Singapore?
For a suite?
For the big suite?
Probably $35,000.
I'm always open to invitation to view. We're not allowed to accept gifts. It's been great to catch up with you. A full conversation. Come back and talk to us soon, because of course the Middle East is on fire. Part of the reason why you're in Qatar. It's always great to catch up with you. Sébastien Bazin, Chairman and CEO of Accor Group here at the Qatar Economic Forum. Danny, I can tell where our next trip is. Sebastian will give us a list, and I'll share it with you on IB. Danny.
Perfect. I'm just saying, you and I would do a great job broadcasting a live show from, Raffles, Singapore. I think we could really do something there. Manus Cranny.
Sebastian has officially invited us to the opening of the super yacht, which is in 2026. You have, haven't you?
As you bet it is. It's under construction.
We're on that list. There you go.
2 yachts.
2 years.
So if you miss it in 26, you'll have it in 27.
We're free. Okay.
Sailing yacht.
I fear that
sustainable yacht.
Sebastian.
I fear that might violate a few Bloomberg clauses, but good to get the invitation regardless. Manus, thank you so much. Bloomberg's Manus Cranny there, speaking to the chairman and CEO of Accor. All right, as we get closer to about 2 hours of cash equity trading here in Europe, it's still the UK gilt market that is underpaying this morning. That is the big mover. Here's the jump. You can see that jump right at the open of the market. It was all about inflation coming in hotter than expected. We're seeing 2-year gilts. Those yields are higher by about 26 basis points on the day, 34 if you're looking there across 2 days. At what point does this look something more like the LDI panic? It's a bad news day for stocks. That inflation picture really just feeding fuel into the fire of turning more pessimistic. Certainly debt ceiling impasse is not helping in the U.S. All right, that's it for the early edition for this hour, but it continues the next hour with Kriti Gupta and Anna Edwards. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority. This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Debt ceiling standoff. House Speaker Kevin McCarthy says there's still no deal to avert a U.S. default. A top Republican aide adds that no more meetings are currently planned. UK inflation comes in hotter than expected, with core prices rising at the fastest pace in more than 30 years. The figures escalating bets on further rate hikes from the Bank of England. And we're live once again at the Qatar Economic Forum in Doha as the US debt drama and China concerns loom large. Coming up this hour, though, an interview with the CEO of Sotheby's. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And Kriti, two things driving sentiment for European stocks right now: the debt debate and the debt ceiling standoff over in the United States, and the UK inflation impulse, neither of them providing much upside.
Yeah, I would say something that is kind of bleeding into the American session as well, Anna, this wait and see kind of dynamic. It's interesting that we're kind of seeing that stagnation, because I wonder when we do get a result, if indeed it is a positive one, if we do start to see the market surprise to the upside or perhaps plummet even further, there is going to be a lot of debate about simply what the relief rally is, or what that even looks like if it indeed is a rally at the end of the day. Because remember, we are still dealing with issues like how tight monetary policy should be, the geopolitics of it all, and of course, the growth story over in the Asia-Pacific region. We're going to get to that in just a moment. But for futures at the moment, unchanged, which is essentially, Anna, the sentiment that you were talking about. We are in wait and see mode. 41.56 on futures, and really it's a significant level because we are kind of bouncing from that 4,200 level day in, day out. You see those technicals really kind of factoring in the absence of any real fundamental development to the positive or to the negative. The two-year yield is getting more interesting as well. 427, you're starting to see volatility creep into the bond market. And of course, as we get closer and closer to that X date from the Treasury, that's really where you're going to see the bond volatility, whereas it feels like equity investors are kind of sitting back and saying, you know what, we're just going to wait this out. Bond markets more actively trading the day-to-day developments. 427 on the two-year yield, 3 basis points lower when you look at the front end of the curve. As you see the yield drop, the dollar follows as well. And right now, it's kind of, once again, a tug of war between some of those commodity-exposed currencies, the Canadian dollars, the strength you're seeing there, for example, pulling the dollar in one direction, the euro, the weakness there, pulling it in the other end. Basically, net-net, Anna, 1240 on the Bloomberg Dollar Index, essentially unchanged so far in the session. NYMEX crude as well, 74 handle, creeping higher just a little bit more and more, higher by about 1.7%. But again, not something I would write home about just yet. Before we get to the European check, I want to get a quick check on the Asian markets because, like I said, the idea of the debt ceiling drama kind of taking over Asian and European, American and European markets. Well, in Asia, it's a little bit of a different story. They're going back to the growth story, specifically in China. The CSI 300 down 1.4% overnight, Anna, wiping out their 2023 gains. This comes off worries about that economic recovery in the second largest economy in the world. The idea here simply being that the weaker yuan and some of the debt issues with property holders is going to weigh down the Chinese economy. A similar sentiment, by the way, weighing on copper as well. This trading on the LME, remember, not futures, the LME contract. It did drop briefly below 8,000. Again, 8,000 at the level it's flirting with. 8,005 is where we're at right now, but still down about 1.2% in the session. Moving to a different part of the region, we have to talk about the dovish hike coming out of New Zealand. You are starting to see some weakness in the Kiwi here, down about 1.7% on that. What's important to know is that, look, they hiked rates, but they say, we might not hike again. And the reason for that is simply waiting to see how much of a lag there is when it comes to that monetary policy. Will it catch up in time to really cool inflation, or are they going to have to go further? They're willing to sit back and watch, Anna, rather than be a little bit more aggressive, something we're not hearing necessarily on this side of the Pacific.
Yeah, well, a really interesting line coming from the central bank governor saying people are cooling their jets. And as they do that, it seems there's less need then for interest rate hikes. Let's have a look at the European picture then, away from New Zealand and the developments there that certainly were interesting overnight, and the weakness in China. This is the European picture. Weakness once again, though, driven by those two factors, really. You can add in China and a little bit of concern there because we are seeing that some of the basic resource stocks are under pressure as a result of the weakness in metals that, Chrissy, you were just talking about there. So there's that. There's also the debt debate over in the United States, and there's the inflation story here in the UK. So all of that adds up to negativity, in particular in Italy, down by 1.9% on the Italian markets today, quite volatile there. So this is what we see on a range of UK assets, actually, and also the basic resource stocks. So I'll start at the bottom. That's the mining sector, selling off 1.6% weaker as a result of the weakness we're seeing in some of those underlying commodity prices. And all of these three assets have to do with what we've heard on inflation today. So the inflation print, it fell from a double-digit number down to 8.7%. So that is better than the inflation prints we have been seeing here in the UK, but it was higher than had been anticipated, and the core number giving a lot of people reason for concern. More on the specifics with Lizzie Burden in a moment, but this is the market reaction. We've seen a big jump, 25 basis points higher in the two-year yield as the market increasingly starts to hike up expectations of where the terminal rate is for the Bank of England. The pound did actually spike up on that sentiment earlier on and then drop back down. It's actually been in negative territory. So despite the fact markets are pricing in more hikes, the market then starts to ask just how heavy will the Bank of England have to come down on the UK economy to rein in inflation, and that has a negativity for the pound, it seems. And Taylor Wimpey, just an example of one of the house builders, Chrissy, that is under pressure today, down by 5.2% as a result of those rising expectations of just how high rates go here in the UK.
An interesting dynamic, so many things to factor in, but it still feels like the debt ceiling debate really kind of overshadows all of them. Anna, House Speaker Kevin McCarthy, for example, left Capitol Hill yesterday saying the two parties had yet to reach a deal to avert a first ever U.S. default. Here's what some of our guests had to say at the Qatar Economic Forum about the current standoff.
I think both sides knows there needs to be a bipartisan deal. It will be a compromise, and I think we'll get the debt ceiling raised.
No deal gets done until everybody walks away from the table at least once. And so we're doing that in a global environment with a lot of media. But I do think sooner or later the debt ceiling will be yesterday's news.
Of course, we're worried about the debt ceiling, but I heard the reassuring comments both from President Biden and Speaker McCarthy yesterday. I have to think these guys know what they're playing with, so I'm okay on that.
My hope is, like the other 4 times that we were in this situation in my lifetime, that we actually stop playing games. If we are doing that, I'm not saying that we are, but I do believe that there's a solution in here, and the longer we take to get to it, the worse it's going to be.
Joining us now is economy and government editor Jill Deeses. Jill, just a day ago, these two sides were saying the talks were productive as Biden returned to Washington. What happened? Where's the hiccup?
Yes, well, I think that what we've been seeing is we've been discussing this over the past couple of weeks is that this conversation often whipsaws between, what we saw just the other day as Biden was returning to Washington from Japan, where you've got him and McCarthy saying everything's productive, we're making some progress. Maybe the tone has shifted a little bit there to what you're seeing today, which is not dissimilar from what we saw over the weekend, where these major negotiators are getting together and saying there's still some major impasses that we've reached that we have to go over. I do think that what is notable, and you mentioned this earlier in this program, but there's no current meetings that are scheduled to line up after this 2-hour meeting at the Capitol between negotiators on both sides. So we're going to have to continue to see what's happening there, but it's looking more and more like we might not have anything until sort of an 11th hour deal as we're approaching that June 1st deadline.
Yes, the 11th hour deal. It's just some people are not entirely sure where midnight is, are they? So that's difficult. Is there any room then, with that in mind, Jill, for a compromise? I mean, a lot of things need to happen even after agreement is achieved between the leaders.
Yes, Anna, well, look, I think that at this point we still know that there is a lot of daylight between these two sides. Republicans don't want any cuts to defense spending. That's obviously where the Democrats are. What the Republicans want is they want to consider trims to social services programs, domestic spending. So this is, sort of a time-old argument when it comes to these two sides, and they're going to have to work out some kind of compromise as we get closer. But yes, as you mentioned, there's still a little bit of debate over where exactly that 11th hour, that midnight deadline is. You had some Republicans question Treasury Secretary Janet Yellen's assessment that it's really June 1st. So ultimately, I think we're going to continue to see this develop as we've seen every day we wake up to some new kind of development in terms of whether there's progress, whether there's not. So we'll just have to see what the coming days have for us.
And some even arguing that then you have to bake into the idea, the lag of just how much the actual wording is going to take to write it. So perhaps is the X date actually way earlier for markets than we previously thought. Bloomberg's Jill Deeses, we thank you as always for walking us through that story. From the Washington drama to perhaps the UK drama, UK inflation was hotter than expected last month, with services and core prices rising at the fastest pace. And get this, over 30 years. Let's dig deeper with Lizzie Burden, our UK correspondent. Lizzie, how do we interpret the data? What's the BOE thinking here?
Well, Kriti, it's bad news for the BOE, just as it is for households and the Prime Minister, Rishi Sunak. Yes, inflation in the UK is back in single digits, but it beat all expectations from economists, including the Bank of England. So it raises questions about their models, their economic forecasts, which the Bank of England chief economist Hugh Pill himself raised in Parliament yesterday. The Governor, Andrew Bailey, said the problem's been assuming that inflation would fall as fast as it rose, and it hasn't. If you break it down, the fall is almost entirely accounted for by base effects. So this time last year, you saw energy prices, energy bills rising by nearly 50%. That is stripped out in the annual comparison. Then if you look at food prices, yes, they tick down, but they're still at a near record high, which is especially harmful for the poorest Brits. And then if you put food and energy price inflation to the side, and as you say, look at core inflation, that was expected to hold steady, and yet it rose, which is really the signal of the stickiness of this price growth. That's what's going to worry the Monetary Policy Committee. That's why traders are now pricing for peak rates of 5.5%. And you have to ask, will the Bank of England actually breach that 5% ceiling?
Yeah, so a lot of people thinking just how high will rates go now in the UK with the stickiness of inflation. Now, away from the very here and now and thinking about the future of UK politics, Lizzie, you've been speaking to the UK Shadow Chancellor. Many would think of her as a Chancellor in waiting, given the latest electoral polling in the UK suggests that the Labour Party are doing pretty well. So what were your main takeaways from your conversation with her?
Yeah, it might seem counterintuitive, but in order to become the party of business, which is what the Conservatives like to call themselves, she wants to take a more activist, interventionist approach, what she calls securonomics. Take a listen.
Securonomics is an approach that builds on the contributions of more people in more parts of Britain, and with a more secure national economy, taking advantage of some of the big opportunities, but also ensuring our resilience, our strength and our security to give families that security that they desperately crave right now.
So that contrasts with the government's warnings about getting into a subsidy race with other G7 nations in response to Joe Biden's Inflation Reduction Act. But this is Labour setting out its economic plan in the US. Significant that Rachel Reeves should choose to make this announcement there, but perhaps significant, signifying how she wants to work with international partners.
So that's, of course, on the government front. Let's stick with the anti-regulatory, or I should say anti-antitrust, whatever you want to call it, piece of the equation. In the UK, the CMA accusing traders at 5 major banks of colluding in chat rooms to swap sensitive information on UK bonds. What exactly are the allegations here?
Well, Kriti, the banks involved are Citigroup, Deutsche Bank, HSBC, Morgan Stanley and RBC. Each, the CMA says, unlawfully shared details on pricing and trading strategies in chat rooms between 2009 and 2013, specifically about gilt and gilt asset swaps. Now, the problem is, by sharing sensitive information with competitors, the banks could have prevented the full benefits of competition with anyone they traded with. So that could be pension funds to taxpayers. In terms of the punishment, Deutsche has owned up to it first, so they're not going to be fined. Citi admitted to the collusion, so it's getting a discounted fine. And for the rest of the banks, they haven't admitted any wrongdoing. So at this point, important to say, we cannot assume that any of them have broken the law.
Lizzie, thanks very much. Bloomberg's Lizzie Burden with a host of stories making the headlines here in the UK. Now, it is day 2 of the Qatar Economic Forum. It's underway in Doha. The chairman of Rubini Macro Associates, who is best known for his predictions of economic doom, has been speaking with Bloomberg and with Bloomberg this morning. Manus Granny joins us now on the ground in Doha. Manus, Rubini warned that talks to avoid a US default could drag on, but that wasn't all he said.
No, it wasn't. I mean, it's almost like Brexit talks, Anna, isn't it? We're going into the tunnel. We are in the tunnel of the debt talks, and the risk is that there is a misstep, and that could be toxic for the dollar. It could lead to de-dollarization. That is what people are talking about. But of course, we're so far away from that being a reality. I bumped into him a little bit earlier on, and I said, are you still spreading the doom, gloom, and bust? He said, no, man. He said, I'm talking about reality. And the reality is that geopolitics at a global level, he's just come back from Israel, Iran, but of course, it is about the West's ganging up on China. That's perhaps top of the agenda for Nouriel.
After the G7 Hiroshima summit, I would say there's not going to be any thaw between US and China. The Chinese reaction to this G7 summit is that European, US and Japan and others are ganging up against China. So this Cold War between US and China is going to get colder.
And that Cold War, that ganging up, is only going to become a little bit more toxic now. And that has got ramifications, both in terms of the commodity market. Just think to yourself, Israel-Iran, if there was a conflict, China-US, if the conflict mounts, that's a trade angst along with commodity angst. And those are the two biggest warnings that came out of that conversation a little bit earlier in the day. And if you're hoping for rate cuts, jog on, I think, would be the message from Nouriel Rubini. That is an aggressive paraphrase on his overall arching theme on rates. Anna, Kriti.
I'll take it from here. Manus, all-star lineup at the Qatar Economic Forum. What else do you have coming up?
A little bit later on, we're going to catch up with the CEO of Sotheby's. We've just come off the New York art sales, Kriti, as you know there. Were there cracks in the wall there? How much is your watch collection worth? We know that on Poshco, on your Bloomberg terminal, you can sell your average Patek Philippe, but there's some pretty special pieces coming up for auction. Charles Stewart joins me on TV and on the podium. I'll also debate the future of capitalism with the CEO of MasterCard. I bumped into him in the hotel last night. He was on his way out the door. We had a brief moment together. I said, I hope you've schooled up on capitalism and the definition of that. We just heard from Al Jadam, the Saudi finance minister. We're going to continue those conversations through the afternoon here at the Qatar Economic Forum. I got to say, the atmosphere here is pretty electric. The group of people they've brought together, just like Sebastian Bazin. Anna, Kriti, you'll be glad to know we're off on a super yacht in 2026. Good morning from Qatar.
Oh, I already heard you invite Danny, so we're not coming, Manus. Thanks very much, Manus Karani, with us from Doha. We'll all go. Wonderful. We will be back with Manus later. Just to get some headlines to you, where a red headline across the Bloomberg terminal says that EU banks are said to sail through an early round of stress tests. And diving deeper into this story, many large European banks, according to our colleagues, are emerging from early rounds of key stress tests, prompting some regulators to question whether to push harder at a time when investors are focused on the industry's resilience. We had headlines around this yesterday as well, suggesting that the ECB is still considering whether it wants to make further, for example, liquidity requirements of banks. So interesting to watch all the ways that the regulators are keeping the banking sector safe in Europe. Coming up on the programme, Lenovo posting its first quarterly profit miss in more than 6 years as the industry struggles with slowing PC demand. We will speak to the CFO of Lenovo next. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Now, shares of Lenovo had their biggest drop since 2021 after the company posted its first quarterly profit miss in more than 6 years. Joining us now, I'm pleased to say, is Wong Wai Ming, the CFO and Executive Vice President at Lenovo. Wai Ming, nice to have you with us. Thank you for joining us. It seems then that you've missed estimates in terms of quarterly profit in the fourth quarter. How sluggish is demand? How subdued is demand for PCs right now?
I think, well, two things I want to clarify. I think in terms of the, market estimate, the market obviously do not make any estimate on the provision of our restructuring expenses. And hence, if you actually put the restructuring expenses that we actually I think we reported back, and then you will see that we're actually, I think, well within range or even maybe above the average. Now, on the revenue, I think we are within range and we are just about, I think, at the market estimate. So that's really one point of clarification. Secondly, in terms of, I think, the market demand, I think we, based on the market data that we have, meaning that apart from looking at the shipment data, which obviously provided by third party, we also look at the underlying market demand, meaning that when a customer is actually, some of the sort of products that we sell to distributors, the distributor put it in the channel,
put it in the warehouse, and when there is a demand, they actually sell it to customers. The real demand, and therefore when customer buys a PC, they will activate, and what we call the activation rate. We actually have, I think, based on our own data, I think our activation rate, I think, is actually even higher than the pre-COVID level. Now, why would I think the shipment data or the shipment volume is lower than the activation data? Is because during the COVID period, many channel partners, because of COVID-19, because of supply, I think the uncertainty of logistic, supply component shortage, they actually buy a lot more. And now the market obviously softened. I'm not suggesting the market has been growing. And therefore, this is the period we see that I think the channel are digesting the inventory. And based on the activation rate, I think we are reasonably confident that the market will actually, I think, come back.
Okay, so important to get your take on how you've performed against your expectations. Thinking about where the shipping rate is and the activation rate then, Wai Ming, how long will we be dealing with this inventory overhang, if you like, in the full supply chain?
Yeah, I think we actually see the sort of inventory digestion, not just Lenovo, but the industry, probably happen maybe 2-3 quarters. We actually reasonably confident that I think the channel inventory, I think, will probably be clear, probably by most players, or the market will clear the channel inventory, I think, by another, well, I think in the second quarter of our fiscal year, meaning that I think our quarter 2. We are at the moment, our view is in the second half of the year, we actually will see a slow growth of the business. Now, I think 2 things that you should bear in mind when you actually look at growth rate, because you're actually comparing the year before. Now, Q1 and Q2, meaning April to June quarter, April to September, the 2 quarters last year, I think the PC is still growing very, very, very much, because I think if I remember, I think we still continue to see hitting, I think, historic, I think, record, I think, business in those 2 quarters. And then the market actually come down significantly starting from the October quarter and obviously the last quarter. So we actually see the decline, like sort of 20-something%, I think, happened in the October to December quarter as well as January to March. So the second half of this year, we obviously will be comparing with a more reasonable base and looking at the activation data, and that is where we actually derive our confidence that the market will get back to more normal, because, as I said, the fundamental belief of the fundamental issue, that the fundamental data that we look at is really the activation data. I think the activation demand is even higher than the pre-COVID-19 level.
Well, Wai Ming, one of the key themes in the last couple of quarters, as you mentioned, is the development of OpenAI specifically. Now, talk to us a little bit about Lenovo's plans, especially when it comes to perhaps boosting server sales, or is the focus, on the other hand, more in the smartphone business? How do you square the 2?
Well, I think 2 things. The AI obviously is the technology that actually give, I think, the world, in fact, I think the more consumption of IT, no matter this is a device or this is infrastructure. Sometimes the market actually think that AI will actually benefit just the infrastructure. I think our view is I think customers need to have a device to leverage the AI. And smartphone is really part of our devices. I think that's the whole philosophy that we did our restructuring 2 years ago by really putting all the device called IDG, intelligent device, so that the device will interact, I think, with the end customers and then be able to leverage the new technology such as AI. And then that actually will require a lot more compute capability, and that also benefit, I think, the other activity of our group. So I actually would not look at just a smartphone or PC. It's really the intelligent device. And today, when you actually look at Lenovo, I think our PC business only account for maybe like 60% of our revenue. I think we actually been diversifying not only on the device side, but also in terms of, I think, the non-device side, accounting for nearly like 40% of our business.
Certainly something we're going to be keeping an eye on. Lenovo's Wong Wei Ming, we are thrilled to have you. Thank you, as always, for your time and your insights. Coming up on the show, we're going to speak to Janet Mui, head of market analysis over at RBC Brewin Dolphin. A lot to digest here. How do you price in the debt ceiling? How do you price in the geopolitics and, of course, the Chinese growth story as well, which seemingly in this side of the Atlantic and Pacific is kind of getting overshadowed by what's going on in Washington. We're going to dive into all of it. Stick with us. This is Bloomberg.
going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The debt ceiling standoff. House Speaker Kevin McCarthy says there's still no deal to avert a U.S. default. Top Republican aide adds that no more meetings are planned. UK inflation comes in hotter than expected, with core prices rising at the fastest pace in more than 30 years. The figures escalating bets on further rate hikes from the Bank of England. And we're live again from the Qatar Economic Forum in Doha as the U.S. debt drama and China concerns loom large. Coming up this hour, an interview with the CEO of Sotheby's. I'm Kriti Gupta in New York with Anna Edwards in London. Look, Anna, it is all about the debt ceiling. This side of the Atlantic, this side of the Pacific, but it's hard to deny that there are more things hanging over this market, things like geopolitics, things like the China growth story, and then, of course, kind of reverting back to the inflationary story that has really dominated markets for the past 2 years.
Yeah, the sticky inflation story is still front and centre here in the UK, but all of those other things in the mix then, Chrissy, and all of that adds up to a weakness on European stocks, down by 1.5%. So actually weakening as we go through the session. All sectors in Europe are in negative territory, and many of them, nearly all of them, down by 1% or more. So we do see weakness across European equity markets, and it is pretty broad-based. We have the debt ceiling debate, we have the US inflation concerns, we also have China slowdown, all of that taking its toll. Onto the UK side of things, and we've got that inflation print that, yes, came down from above 10% to somewhere in the mid-8, 8+, but that, so it is single digit, and that's the positive side of things, coming in at 8.7%, but still the core inflation number jumped, and that was unexpected, and that just shows how sticky, how pervasive the inflation impulse is in the UK, and the hard job that the Bank of England might have ahead of it. So we saw, as a result, a repricing of expectations around the terminal rate, so the two-year yield jumps by 25 basis points on UK gilts, so that makes sense entirely. The pound also jumped in early trade, and that seemed to make sense if you're pricing in more rate hikes from the Bank of England. But what toll will that take on the UK economy? Just how much will those, how far will the Bank of England have to go to bring down inflation? And that was weighing on traders' minds, perhaps, as they saw that spike in the pound and then sold it down back to 124 and into negative territory. This is the impact of the China story then. So basic resources, not the worst performing sector today, but it is linking into that global theme. Weakness in commodity prices is weighing on some of those basic resources, those mining stocks here in the UK. Actually, the weakest performing sector, though, travel and leisure, as we see those energy prices go higher, Chrissy.
And I think that weakness that you're seeing in the European session, Anna, 100% seeping into the U.S. session. You're already seeing in the last 30 minutes, futures stateside have come down a little bit. Look, they're not selling off with a massive momentum or massive conviction just yet, but you are seeing futures worsening a little bit. We were unchanged about 30 minutes ago, now down about 0.2%. So you can really see how that global sentiment is, again, seeping into the U.S. session. The two-year yield at 4.28, though, interesting to see that that's really where things stay stagnant. The narrative you were hearing overnight, the kind of stagnation in those debt ceiling talks, it's showing up in the bond market, lower by about 3 basis points on the front end of the curve, taking with it, by the way, the Bloomberg Dollar Index in the absence of any positive or negative fundamental news for the dollar specifically. Again, as we wait for those debt ceiling developments, you do see it kind of in a tug of war between the Canadian dollar and the euro right now, the largest and kind of weight and tailwind on both ends. So again, a tug of war for the greenback there. NYMEX crude, though, is trading with a 74 handle. This is interesting because even as you have sentiment worsening and the idea of Chinese growth worsening, NYMEX crude actually higher on the day, which kind of brings into question what kind of dislocation is in the commodity market right now if they're not all trading the same. A 74 handle, Anna, higher by about 2% there.
Okay, let's talk about the deliberations that we're seeing taking place in Washington and what impact that could have on the market then, Chrissy. Nouriel Roubini is warning that talks to avoid a US default could drag on, with failure to agree on a debt ceiling likely to hit markets and damage confidence in the dollar. He spoke earlier at the Qatar Economic Forum in Doha.
The Chinese definitely want to increase the role of the RMB. If the US were to have a real problem with debt, with a credit event and so on, that's going to increase the likelihood that people are going to diversify over time away from dollar assets. We don't know yet. They may get to the last hour before there's an agreement, or it's possible they don't reach an agreement. If that doesn't happen, then the market is going to crash, and that may force an agreement in the next few days.
Let's get the perspective now from Janet Mui, Head of Market Analysis at RBC Brewin Dolphin. She joins me on set here in London. Janet, good to speak to you this morning. So Nouriel Roubini says if there is no deal, we get a market crash, that focuses minds. Are you bracing for that to be the way that things play out?
Hi, good morning, Anna. Thanks for having me. Well, we think it's very hard to predict what will happen, but we still think that the chance of a US default is very slim. We still think that there's a path to a deal before the potential event. But what we think is that the market is currently pretty complacent. We have seen that play out a decade before. You know, there has to be some market pressure for a deal to be through, but we don't see that yet. You know, equities are pretty sanguine at the moment. Right. So we think that there could be more market volatility going into next week sometime, but we think eventually a deal would be pushed through.
Right, and we did see a bit of negativity yesterday in European stocks and in risk assets. But yes, your point is of course longer term. It does seem as if stocks have been pretty complacent, whereas maybe short-end treasuries, T-bills have reacted. With all of that in mind, if we get a deal, do we get a bounce in stocks? Because some people say, yeah, of course course we will, because it removes a key question. Others will say no, because some liquidity will come out of stocks and go into T-bills, and actually it'll be a sign that we're getting fiscal retrenchment in the United States. How does all that play for you?
I think, first of all, as market is complacent, I think most people actually ultimately expect a deal. So I think there may well be a relief rally because this is a removal of uncertainty, but I don't think it will be a huge rally because I think this is somewhat expected. To your point about increased supply in T-bills, yeah, potentially that actually could withdraw liquidity from the system. And I think, you know, if we do get a deal, ultimately some form of spending cuts will be involved, right? It's a matter of which part they're going to cut. So there would be some cuts which will be negative for the economy overall. So if you throw in the stress of the banking system, tightening credit conditions, and you throw in some more additional spending cuts, we think ultimately that will be negative for the economy. So that actually could put pressure on the equities.
Janet, talk to us a little bit about the debt ceiling debate in the context of weakness you're seeing in China. I want to say about a year ago when the property sector story in China really developed, it tanked markets globally. We're seeing it kind of rear its ugly head again, and it's not having the same effect. Is this a dislocation?
Well, first of all, I think that the China reopening story, I think everyone appreciates now that it is a consumer-driven recovery. So the things that are traditional growth drivers like the fixed investment, the property, manufacturing, they're really lagging. So I think now markets appreciate it's not broad-based. It's not as good as people have previously anticipated. Certainly not any more stimulus expected from the authorities for now. I think monetary policy, fiscal policy, pretty conservative because they are very likely to hit the growth target. So I think it is probably right the Chinese market is not advancing because there's still so much structural concerns for investors. So that puts a lot of people on the sidelines.
Well, in the absence of that stimulus from China and in the absence of the relief rally that you suggest after this debt ceiling debate is over, what kind of downside risk are we looking at? Put some numbers on it for us.
Yeah, so right now we're defensively positioned. We have been cautious because we expect a U.S. recession. We do push back the date of that U.S. recession now to 2024, but we think that's inevitable given the tightening in credit conditions. Primarily, the interest rates will stay high in the U.S., contrary to what the market is currently pricing. So I think that itself is negative for the economy, negative for corporate profits. I mean, so far corporate profits holding up pretty well, but eventually corporates will face more margin pressure. So we think ultimately this will drag the equity markets lower. And of course, we had this rally already year to date. As I said, equities are very complacent at the moment. If you throw in a bit of extra stress, I do think that the markets will be a bit more vulnerable.
Okay, thanks very much, Janet. Thanks for joining us. Janet Mui of RBC Brewin Dolphin. Coming up on the programme, we'll get back to Qatar, to the Economic Forum taking place there in Doha. We'll be joined by the Sotheby's CEO, Charles Stewart. He'll be talking to Manus Granny on the ground. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but, we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
People have to just listen to themselves and what they respond to, because art can be anything. It doesn't require anything. You don't have to know about anything. You just have to come to it with your past experiences.
That was the acclaimed American artist Jeff Koons speaking with Francine Lacroix at the Qatar Economic Forum. Welcome back to the programme. Let's get back to Doha with Bloomberg's Manus Cranny, who's joined by the Sotheby's CEO, Charles Stewart. Manus.
Anna, thank you very much. We have Charles Stewart in the seat. I'm going to kick off with a tangent. We've got Louis Vuitton tanking along with, Hermes and these super luxury brands. They're really concerned about China. Have you anything that you can add to this story in terms of the auction house? Are you seeing cracks in global luxury, or is it just a different part of the market you deal with? Good morning.
Good morning. I think it's a different part of the market. We're actually seeing Chinese buyers emerging post-pandemic to participate in our global sales, but also in Hong Kong. In fact, last month in Hong Kong, we had our largest sale of Chinese works of art in 9 years, which I attribute to Chinese coming back to the global markets. Also, remember that we are at the very high end of the luxury markets as well, which is perhaps a bit more insulated.
You're just coming off the New York art sales. I am far from an aficionado, but there were some stunning pieces that went out. People are saying that overall, $1.7 billion was done in the art sales in the week. Now, that was materially less than we saw last year. What does that drop in value of sales say to you about your market?
Well, actually, I thought the markets and the sales were quite resilient. 1.7, 1.8 billion is pretty good by any sort of historical comparison for a week of art sales. There were many artist records set. For sure, we're feeling to some extent the uncertainty and the macro outlook weighs a bit on the markets. But I think overall what we saw were real money, real collectors, and very strong overall sell-through rates in the art sales.
You meet the super rich, you talk to them, they come in quietly, discreetly to look at things that they want to buy. Are they becoming more discerning, if that's the right word? Are they becoming more judicious about the pieces that they will go for? Is there a shift in any way?
Well, one thing I think we did see last week was a bit of differentiation between what I would call the very fresh, very rare A+ works. They did exceptionally well, and works that maybe are less rare or have traded more recently or are B+ or lesser works by a given artist, those did less well. But absolutely, our client base was incredibly global, incredibly sophisticated, and I think there's a high degree of confidence in art as a store of value, of course, in addition to people's collecting passions.
Switch over to hard luxury. I mean, I'm at the much lower end of the market, so I just sort of troll through the website and have a look at the odd watch that I might be able to afford. But on that point, I mean, the crypto crowd have taken a bruising. The second-hand watch market is on fire, but it's coming off in pricing. What can you tell me about that market? Our audience are watch fans. They troll for watches, they build collections. Where's the pricing?
Right.
And where's the secret sauce in watches?
Yeah, where we saw the effect of all of the stimulus and perhaps a crypto effect, faster money coming into markets, was at the very new end of certain luxury markets, be it watches or certainly cars, hypercars, supercars, and the prices have adjusted there. They're still meaningfully above the primary market prices, so good luck queuing up for the really hot Patek Philippe and getting it primary. That's not happening. It's the same in handbags, same in watches, same in cars.
Are they just constraining supply? Is that bolstering the market? Do you feel that that's underpinning the market?
I think that scarcity is clearly a key driver of a lot of these markets, including art, by the way. But in hard luxury, the manufacturers, in my view, have been very judicious about trying to calibrate that supply and demand equation.
Look, we have 1,000 directions that we can go in, and time is limited. You'll be with me on a panel a little bit later on. We can talk about Generation X and how you're hooking them. But I am absolutely transfixed by Freddie Mercury's sale. It's coming up later in the year. I look back, David Bowie, the first night of his sale for art was $30 million. Tell me this, what's going to fly from Freddie's collection? What is it that just stands out here? What do you think we're going to make on Freddie's collection?
You know, it's hard to say. The audience reaction to the announcement on our website and our traffic and anticipation for the physical exhibitions has been extraordinary and overwhelming. We're incredibly excited. The sales are in early September in London. There are hundreds and perhaps thousands of personal effects belonging to Freddie Mercury, including many, many iconic bits of things he wore in special moments, instruments that were quite important in the music he wrote. So yeah, it's going to be a cultural phenomenon.
You know, and I'm just curious, that is going to take place, as you say, in London. Do you think post-pandemic, for this auction, for example, coming up, or the ones that you've just seen, are we seeing less online and more physical, or no man is actually, the online is resilient, it's strong, I've not seen any material shift in the bidding at the global auctions?
You know, before the pandemic, about 40% of all of the bids that we took were placed using our app or our website. Now it's over 90%. And that was a phenomenon of the pandemic, as well as our investment in innovation and technology, and that has stuck post-pandemic. So for our biggest live sales, people are bidding in person or on the phone. But for most of our sales, certainly including the Freddie Mercury sales, I expect to see very heavy bidding online and on our app as well.
So you're in a very rarefied world. What's the most gorgeous thing that you've treated yourself to at auction? Come on, Spill. How much have you spent? What's the maximum and most beautiful thing you've bought at an auction?
Well, I must say, coming to work every day, I walk up the stairs, and you fall in love every day with something you didn't quite know. We had an Aboriginal art sale, Oceanic Art, last week with some absolutely beautiful pieces in it. Luxury Week this week, there's a 55-carat ruby, as well as a 10-carat pink, vivid, fancy pink diamond, which is quite extraordinary. Many of the things that I love the most, I can't afford, and one of the rules of collecting is you have to love it, you also have to be able to afford it, and you have to have done enough work to understand its significance and importance.
At $35 million for the pink diamond, the eternal pink diamond, I think I might be waiting a long time before I can even countenance thinking about it.
You never know. You're doing well.
Charles, we'll see you inside. We're going to talk about how to keep Gen X on side in the auction world. Ladies of London and New York, there you go. The Sotheby's CEO. He's got a couple of diamonds and the odd ruby on sale in the next month. There you go. The bidding starts here.
Manus, thank you very much. Manus Cranny with Sotheby's CEO Charles Stewart at the Qatar Economic Forum in Doha. You know, so whatever happens with the debt ceiling and T-bills, there's always art, watches and diamonds. Coming up on the programme, retail earnings continue with coal set to report before the US market open. We'll get a preview next. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence. for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Now let's take a look at some of the things that are ahead for us today. Bank of England Governor Andrew Bailey is speaking at 9 a.m. Eastern Time. We've already got a few headlines from what he's going to be talking about on the climate today. US Treasury Secretary Janet Yellen speaking at 10 a.m. That'll be crucial in the debt conversations, of course, the debt ceiling. Then we'll hear from Fed Governor Christopher Waller at 12 p.m. noon. And that will be followed by remarks from ECB President Christine Lagarde in Frankfurt. And finally, FOMC meeting minutes come out at 2 p.m. We haven't mentioned that yet. Chrissy, something is amiss.
I wonder how much of, again, all of these other geopolitics, the Fed, et cetera, it just kind of falls behind when it comes to the debt ceiling. It's just overtaken everything, even some of the key kind of micro market stories, Anna, which brings me to some of the stocks that we're watching in the pre-market this morning because, look, earnings are still afloat. We're going to get to that. But one of the major movers in the last couple of sessions has been Moderna shares. A little bit of deja vu here. We're talking about this global pandemic being over, but it's not over in every part of the world. China likely to see its COVID wave peaking at about 65 million infections a week toward the end of June. That coming from a senior health advisor in China, pushing those Moderna shares higher by about 2.6%. You also, again, like I said, have those earnings stories seeping back in. Palo Alto, the cybersecurity firm, defying the macroeconomic background. Get this, a triple whammy. They raised guidance on their profit revenue, their billings for the fiscal year, and their full year outlook. So really good news out of there. Shares higher by just shy of 5%. And after the bell, Anna, we get NVIDIA shares, the heavyweight in the S&P 500, already a little bit of pessimism baked into that stock, down about 0.8% in the pre-market after their data center unit could not show whether or not cloud computing companies are splurging on that AI infrastructure. But of course, in the near term, we have a really big retail name reporting. Kohl's reporting its first quarter results later today ahead of the opening bell stateside. Its moves to reduce inventory may not be enough for the retailer. Joining us now to break it all down, Bloomberg's Simone Foxman. Simone, walk us through what we should expect here. Kind of mixed messages from last week's earnings.
Yeah, well, we got a taste of what's happening with big box retail. This is our taste of what is happening with department stores. And Kohl's is one of these high yield names. 2 downgrades last month, mostly on concerns about its leverage overall. 5-year CDS at 846 basis points. It had a terrible 2022. It built up a ton of inventory by 40%. What we're going to be watching for is how it's starting to eliminate that inventory, as you suggested. Yes, it's had higher footfall that we've seen from some of the high frequency data, but maybe that's just because it's trying to discount its products and get its stuff out the door. Analysts have a really mixed message on where we go from here. Can it pull through as it tries to deleverage?
Okay, so that's one of the things we're watching for then. And in terms of inventories, Simone, what are the other trends that we're going to be focused on today when it comes to Kohl's and other retail names?
Yeah, overall, we should look at this as our first taste of what's going to happen to department stores. Macy's, Nordstrom's expected next week, and all of these names have been under a great deal of pressure. Kohl's specifically trying to bulk up its out of indoor mall sort of offerings. But I think, we should reference the luxury story. We've seen that sell-off in European luxury names because we're also going to see how consumers are going to apparel names. And some of the same factors are at play. Do we see the weakening of the U.S. consumer? We're looking at Abercrombie and Fitch this morning, American Eagle and Guess this afternoon. In most of those, we expect to see sales rise just a tad, but we've seen this sell-off in Europe, mainly based on the U.S. consumer. Can Chinese consumers kind of pull things through in some of these brands? I think that's the big question we're going to be asking today and the rest of this week.
Simone, thanks very much. Bloomberg's Simone Foxman there with the latest on the retail space. And Chrissy, thinking about the interesting signals we're getting on US retail, it's having an impact on luxury. Here in Europe, we heard Manus Cranny talking about it earlier. Incredible amounts knocked off luxury names yesterday in Paris as a result of declining expectations for US consumers and the luxury spending.
Yeah, and I think it's a key theme what Simone just said. Can the Chinese consumer make up for the lack of US consumer? That's going to be something to watch for sure.
Certainly is. That is it for Early Edition. Surveillance is ahead. They'll be speaking to BNY Mellon's Jeff Yu. Wells Fargo voices will be with them, as will voices from SoFi. Lots to think about as we get more news lines surrounding the debt ceiling. This is Bloomberg.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
We're in a challenging period right now, an anticipatory period.
The Fed is very, very keen on getting inflation down from 5% to 2%. And as long as that's the case, the Fed will continue to step on the brakes.
We're at a point where we're probably peaked rates.
This whole rate cut talk, forget about it.
This is another setup for a cyclical rally. 4,300 isn't that far away from where we are today.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance alongside Tom Keene and Lisa Bramwitz. I'm Jonathan Ferro. Your equity market softer yesterday, a touch softer this morning on the S&P 500, negative 0.2%. No sign of a breakthrough down in Washington, D.C. This from Speaker McCarthy. He told reporters that Democrats, Tom, still want to spend more money this year than they did last year. Apparently, that's a red line.
I thought we had joy 48 hours ago. Where did it go? And really just skimming it in, our team, Justin Sink and our team, I thought had a superb summary of this. And down at the bottom is the reality. And I'm not sure when the reality is, John, June or July, but Speaker McCarthy may have to find 10 Democrats to support him to get anything that we're not talking about right now through. And to me, that was really the huge thing is he going to be a John Boehner and get kicked out by his fellow Republicans? Maybe that's the June 10th story.
I love the take from Mitch McConnell, the Senate Republican leader, who said, I think everybody needs to relax. Bramo, any sign of panic?
No, actually, there isn't any sign of panic. In fact, House Majority Leader Steve Scalise, or Minority Leader previously, just came out and was like, I don't know if the X date's actually correct. And, like, you know, maybe they're trying to play us in terms of how near this actual, this deadline actually is. And to me, I'm wondering, does it really matter if it's June 1st or June 15th? I mean, technically, yes, but shouldn't you care either way?
They're playing to their constituencies. That's all there is to it. And the only constituency that matters is getting the Social Security checks to Mitch McConnell's crew in Kentucky, and name another state, and not to pick on Kentucky. But, John, to me, it's got to get done, and it's just how you do it through the political mess. And what I would say is we have a president deeply experienced at this gridlock.
Chip Roy of Texas called default warnings, Tom, a, quote, manufactured crisis. Raising questions to your point, Brammer, there seems to be a Republican push yesterday, raising questions about whether that X date really is in early June or not.
Yeah, I don't know. I'm going to defer to really smart people at Treasury looking into flows. You mentioned this the other day. It's not so much about spending. It's about the money coming in, the dynamic of tax receipts, which is, I guess, I'm not knowledgeable on this. I think it's pretty lumpy. Like, they wake up on a Wednesday and they go, are we bringing in $42 billion or $13 billion today?
Unpredictable, very lumpy. Yeah. We'll catch up with Anne-Marie about the numbers a little bit later this morning. Let's catch up about the numbers right now in this market. Equity futures on the S&P 500 just a little bit softer, but elsewhere, let me tell you, plenty of action. Yeah. Chinese equities wiping out gains for 2023. Copper making a new low for the year. A break on copper of 8K. And look at some of the luxury players over in Europe, Tom. Some real weakness yesterday and some weak follow-through today as well.
Yeah, the luxury thing gives back from the high multiples, 60 multiples, whatever. Everybody's going to buy LVMH, Hermes, and the rest forever. But I would look at the suddenness of this. Copper, this is off LME copper. I have to do this, folks, or John will walk off the set. I normally use Chicago copper. But from the middle of April, we have gone from +2 standard deviations to -2 standard deviations. We have a 4-deviation move in weak copper, really over the last 30 days.
We've been on top of this the last few weeks, the last month or so, Lisa. Just signs building that maybe that enthusiasm, optimism around the global growth story is starting to crack.
And I'm trying to parse, yes, and I'm trying to parse the difference between the global growth story and the China story. Are they interlinked the way that they always have been? Because a lot of this is stemming from China at a time when China seems to be disappointing in a pretty significant way.
Two stories are domestic China and foreign China, and I think it's both, you know, a combination thing. What I would suggest is you have an acceleration of the trend, John. I looked at a fancy renminbi chart here out to near 7.07 yuan today, and you have what's called log convex renminbi, which is an accelerative weakness in CNY.
We're expecting Janet Yellen to talk about log convexity weakness in the Chinese yuan. Actually, not at all. Don't worry. 10:05 a.m. Treasury Secretary Janet Yellen is speaking at the Wall Street Journal CEO Summit in London. Very curious to see what she has to say about the X date and some of the pushback that she's been getting from certain Republicans. Today, we also do get a host of Fed Speak, including Fed Governor Chris Waller at 12:10 a.m. at UC Santa Barbara. Earlier in the morning, 11 a.m., we do hear from former Fed Vice Chair Rich Clarida at 11 a.m. That's all kind of leading up to the big event that Tom really makes sure to always pay attention to, 2 p.m., which is the meeting minutes from the previous FOMC meeting. You're going to be reading and parsing through. I actually think this is going to be super interesting because we'll get a sense of how concerned people are about the banking crisis that was or wasn't, and people can debate that for the rest of the year, I'm sure. And today, retail earnings include Kohl's and Abercrombie & Fitch around 7 and 7:30 a.m. Eastern, respectively. American Eagle Outfitters after the bell. But the key is NVIDIA. Can this keep chugging along after 110% gains so far this year, John?
What a run. What a run for that name and for
Are they
Meta
China
as well.
influenced? Like if China slows down, does NVIDIA crash? I don't know.
I don't know.
I don't know.
We can talk to an analyst
What do they
about
do?
that. Can I get to Jeff?
Yeah, sure.
Thank you. Jeff Yu, Senior Market Strategist at BNY Mellon, joins us right now. Jeff, the enthusiasm around the global economy, are you seeing signs of cracks? Some cracks appear in the last couple of days?
Not really. I mean, to be honest, and one of the reasons is I don't think investors are super invested in risk on or risk off right now. There are plenty of cash on the sidelines. Some little bit of enthusiasm coming through in equities. You're seeing that in the price action, and there's a coincident flow between EM and DM as well. But is that due to easiness about the debt ceiling? I think it's just because over the last 4 or 5 months, people have been so underinvested, lack of conviction. They just still need to put some money to work. So it's nothing fundamental right now. You can make a case for longer-term strategic asset allocation, but broadly speaking, people are still watching this on the sidelines.
Jeff, do you aggregate China economics, or do you look at it as a domestic entity and also then the foreign China story?
I think both matter. It's interesting you talk about renminbi convexity. I think PBOC had something to say about renminbi convexity last week, and they're going to be on the other side of the trade. But I just look at Germany's PMIs. The services PMI is heading to 60. The manufacturing PMI is heading to 40. You haven't seen that kind of a spread in a long, long time, if ever. So that just tells you the European consumer is on fire right now, confirmed by the core inflation numbers. Manufacturing still in a weak spot. Which sector is going to converge to the other? I think that's going to be the key question for growth, not just in Europe, but globally up ahead.
Jeff, taking a step back, how unusual is it to see a global synchronized cycle where services are on fire and manufacturing is falling off?
It's very unusual, and I think the reason is, people are still releasing that pent-up demand, and from the pandemic, there's built-up savings, which are still being unleashed as well, but crucially, labor markets, they are strengthening, and I think Europe is starting to realize this could be pro-cyclical. You give people higher wages, they start to spend, they generate new jobs, new economies, which begets, further wage gains. That is self-sustaining. I think that's healthy for the likes of Germany over the medium to longer term, and Japan, but for some other areas, you still need to retrain those in manufacturing in the old industry who may not have those jobs and further up ahead. So I think it's a balancing act, but I wouldn't treat all of this services being on fire and being inflationary as necessarily a bad thing.
Given that backdrop in Europe, how enthusiastic can you be about the European story, given that China does seem to be slowing down and not really that willing to pump new credit into the system?
So I do agree, though, that ultimately, if I had to take a side, who's going to converge to what? The services side will have to converge to manufacturing. You cannot just envisage very strong German growth if the export machine is not picking up. Real terms of exports to China have been weak for a while now. I think they're still going to be weak for some time. And on top of that, we really need to be aware of the luxury goods trader. You've mentioned it already. We saw in our underlying investor flow, there were flows into that segment already over the last few weeks. So that was already in the price. Then people may be taking profit of that. There may be one final wave as tourism from China into Europe and elsewhere picks up, but that's really not going to move the needle. So something needs to be done about manufacturing, not just in the short term, but over medium to longer term, as the EV battle heats up as well.
Jeff, bring your global synthesis back to the United States. Let's say at 2:14 a.m. on a given Sunday, they get the debt ballet solved. What happens? Like, what does 3-month Treasury do? What does 10-year yield do? Do we reestablish a disinflationary trend?
No, we don't. We consolidate the higher for longer narrative. We consolidate the rate staying restrictive narrative. And I think markets will just hope that the Fed is not going to start talking about 6% again. I think that's the bottom line right now, because we're seeing healthy data globally, and the US and the UK in particular, much more services driven, less exposed to the global economy. That's where inflation wage risk remains to the upside. So the next phase of risk, and to be honest, what is the bigger risk for the markets right now if you want to be risk on? It still is trying to chase the Fed. It's misreading the Fed. So I think that narrative is still going to be far more important if we look at the next quarter and beyond.
Hey, Jeff, this was just absolutely brilliant. Thought-provoking stuff. Jeff Yu there of BNY Mellon. That point on the PMIs, if you look at manufacturing, China, Europe, the United States for that matter as well. Look at the PMIs out from yesterday. It looks like rate cuts, global economy performing really poorly. If you look at services, very different picture of things, very different picture.
That was fascinating in that you've got Jeff Yu on the same page as the economist James Dimon, and that nobody's looking for a embedded higher 5% yield, and dare I say, call 5.85%, 6%, getting up near 6%.
But listen to what Jeff said. Listen to what Jeff said. What converges to what? Does services come down to manufacturing, or does manufacturing come up to services? And Lisa, they are two very, very different scenarios.
And he does think that ultimately services will have to converge to manufacturing, because at a certain point, especially if China doesn't come back online, there is something that breaks a little bit. That said, how much do you end up, not with a soft landing, but with something that's a stickier inflation and a two-tier economy that kind of keeps balancing each other out in different kinds of ways?
We didn't mention this, John. I look back at United Kingdom core inflation today, back to 1988. There's no equivalent chart of that in the Western world. It is unique to the United Kingdom. We don't need the chart. It doesn't work on radio. But the answer is core inflation went higher. And like, John, I'm just thinking about like the day you were doing Brexit for 14 hours and I was in Mayfair and Murano was...
I remember it well.
Murano was sold out.
It reminds you pretty much
So I went down Queen Street.
Yeah.
And then Half Moon Street is, you go like this on Curzon, and there's Casa Ferro folks. And I called them up this morning, and Casa Ferro pasta's up 28% year over year, and olive oil is up 46%.
Oh, don't blame the Italians for that. Blame the Spanish.
They're doing 46 pounds.
Most of the olive oil.
Yeah. Because people buy bad olive oil, Bramo. That's
Italian if they import it through there. That's what they do. It's a gimmick.
They're doing 46 pounds for a plate of Emilia Romagna.
For a plate of what?
Emilia Romagna.
Okay, we're not doing
Come
this.
close.
If you do want to talk about this, durum wheat, which is used to make pasta, very expensive last year. Oils, vegetable oils, full stop, more broadly have been really expensive because of Ukraine. Prices are meant to come down, so now the Italians are pushing back quite aggressively. There's talk of a pasta strike over in Italy. This is quite serious stuff. Quite serious stuff that we can talk about later.
Sponsored by Atkins.
Exactly.
Bramo, that
Do
was
they
good.
eat gluten-free pasta in Italy?
You know what? In Italy, they're very accommodating of people with dietary requirements like that. Very accommodating.
Sensitive, Pharaoh, this
There we go. Equity futures on the S&P, negative 0.3%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, a complete U.S.-China decoupling is not possible. However, a selective decoupling is taking place. That today from former CIA Director David Petraeus, who spoke exclusively with Bloomberg Editor-in-Chief John Micklethwaite at the Qatar Economic Forum in Doha.
It is certainly not a partnership without limits, as is declared. We've seen very distinct limits. I really don't think that China, President Xi, doesn't see Russia as an equal. When President Xi went to Moscow, had his summit with Putin, he didn't get what he wanted. China, this is a very transactional relationship at heart. It's not a relationship between two equals.
And we should note the government of the state of Qatar is the underwriter of the Qatar Economic Forum, powered by Bloomberg. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. The debt ceiling deadline closes
Back and forth on the debt ceiling debate.
Kevin McCarthy says it's going to be on the floor next week.
Keep it tuned to Bloomberg for up-to-the-minute reporting.
Movement from the White House walked out of this meeting saying the White House was being unreasonable.
And first-hand analysis from the political and business leaders who matter.
The debt ceiling is potentially catastrophic.
We will not pass a clean debt ceiling. They should just simply do their job.
Both political parties are guilty.
For continuing coverage of the debt ceiling standoff, keep it tuned to Bloomberg, your global business authority.
We could still finish this by June 1st in a timeline. 97 days the president didn't want to meet. So, I mean, we're trying to condense everything in a short time frame. The House passed a bill and the Senate never passed one. So now it's more difficult. What else do you have to negotiate from a lot of different perspectives. But we can still finish in time.
We can still finish in time. We just don't know what time they need to finish. Which is an odd thing to say, isn't it? We can still finish in time, but no one's really been transparent about what time they need to finish, with the exception of Treasury Secretary Janet Yellen, who said early June, and now Republicans in the last 24 hours have poured some cold water over early June.
Okay, I hate to be the realist in the room here, but at what point does it really matter if it's June 1st or June 15th? I mean, at a certain point, we're running out of time.
I'm with you.
So just get a deal done. Do they have to have a certain date in order to actually take action?
This is pretty boring, to be fair, so let's talk about something far more interesting that's taking place a little bit later. Governor DeSantis, widely expected now to announce his run for the presidential campaign over the next 18 months or so, and doing it, Tom, on a Twitter Spaces, I believe, at 6 p.m. alongside Elon Musk and David Sachs. And if you don't know David Sachs, venture capitalist, entrepreneur, really interesting guy, actually, quite conservative, but kind of bizarre, Tom. This is the start of it.
And it's bizarre to me because his victory in Florida was stunning. Why does he need to do this is what I don't get, because his polling in Florida was shocking.
I actually take the other side of this as well, which is, what does this mean for Twitter in terms of social media versus media? If Elon Musk is going to be a platform for some major announcement, at what point is this a media company that then draws the scrutiny and regulation of any kind of media organization?
I will say a couple of things on this. One, I'm not sure how many people we remember the way they started their campaign. I'm sure this will be forgotten pretty quickly. I remember when the former President Donald Trump started his campaign. Wasn't it a Trump Tower? I think it was a Trump Tower.
Going down the escalator?
I think there were odds of about 150 to 1 over at Ladbrokes, a betting office over in the United Kingdom at the time. So these things are quickly forgotten, and things can change over the next 12 months. What's curious about this, though, and I do think it's interesting, that if you're not that well known outside of this core base, which is the incredibly online conservative wing of the party, which David Sachs attracts and Elon Musk does as well on places like Twitter, you'd think there'd be an effort to go beyond that. And I'm wondering what that's going to look like in the next few months.
Did you see this headline?
Sure.
From Reuters? I mean, White House Republicans listen to Abramowitz, expected to resume debt talks. It's like they were channeling Lisa.
Yeah, expected. I wouldn't say that's really news. I think it widely expected that's going to continue, Tom. That's coming from Reuters this morning, just to be clear.
Yeah, I know. So there's the ongoing story. We'll continue to bring you those headlines through the day as we stagger to June 1st. Right now, we stagger to Zach Cohen, Bloomberg Government Congress reporter. Zach, I want to go to the bottom of Justin Sink's important summary today with the team in Washington. And it takes me back to 2015 and John Boehner's survival, which is Kevin McCarthy, and this is your wheelhouse, Zach, is he going to need 10 Democrats not named Pelosi to salvage his speakerhood given the tensions?
I think it's going to be really tricky to get to that point. As you can imagine, Kevin McCarthy, after being elected speaker by the narrowest of margins in early January and after historic rounds of balloting that lasted nearly a week, the idea of then turning to Democrats to salvage his speakership, I think would rebel up a lot of Republicans the wrong way. I think his primary goal here is to bring a deal back from negotiations with the White House that he can sell to fellow Republicans. Democrats have kind of handed this out there as a potential break glass moment, I think one lawmaker put it. And so I think that's probably the least likely scenario, more of a West Wing scenario than something that could actually happen. But it's hanging out there, and it is an option for McCarthy if he decides that he needs a Nixon and China moment and really reach across party lines in order to get a deal done before the X date, whenever that is.
On a Wednesday morning before the next marginal headline, are you presuming something gets fixed in June, or are you getting out the Zach Cohen can to kick it down the road?
I think there's definitely some talk yesterday from some Republicans kind of questioning whether June 1st really is the deadline. They've said, yeah, that's what Yellen has said, but, would missing a couple of payments on it be so bad, which obviously, as our listeners and viewers know, would be a default on the U.S. debt and could have economic consequences far beyond what we imagine. And so I think there is this sort of softening on the Republican position. So why do we need to negotiate with the White House? And so this could drag into, the first week of June 5th, the week afterward, sort of that end range of that early June timeframe that Yellen has given, and before the June 15th date, when Treasury does expect another inflow of cash from corporate tax revenue. And so we could see this bump up, into June, especially given the fact that, the Senate is out now. The House has not passed a bill yet. It's going to take a couple of days, even after a deal is reached, as we talked about yesterday, before Congress actually passes a bill and sends it to Biden's desk.
So we'll have the privilege of talking about this probably with you for many more weeks to come, and we can get the machinations of the debates and the discussions perhaps in the back room. I do want to pivot to this idea of Ron DeSantis announcing his likely run for Republican candidate for president on a Twitter Spaces tonight with Elon Musk and who he's going after. I find this fascinating, especially given that it's going to be very difficult for him to attract Trump voters without alienating them, without alienating the rest of the Republican Party. Do we have a sense of how Twitter plays into that strategy?
Obviously, Twitter was also the place where Trump was banned after the 2020 election, so it's not a space that he's going to be on anytime soon. I know Musk has offered that to him, but he says, nah, I'm going to stick with Truth Social, which is this other social media platform where he prefers to make pronouncements. And so, yeah, DeSantis and every other candidate in the 2024 presidential race, people like Senator Tim Scott from South Carolina, who announced former South Carolina Governor Nikki Haley, these folks are going to need to find a way to not just appeal to Trump's base, but also to differentiate from him somehow. And that's going to be tricky without turning off that same base that did vote for him both in 2016 and 2020, and likely will again in 2024. We've seen the polls that Trump is still the leader of the clubhouse, and it's going to be hard to break away from that. That being said, Trump also was, in the single digits when he started in the 2016 Republican primary. And so I think any of us who forget that our crystal balls were all shattered in 2016 treads a kind of dangerous path.
It's worth remembering, Zach. Thanks for that. Zach Cohen there of Bloomberg Government. I totally agree with Zach. It's easy to sort of say, this is silly, why you're doing this, but ultimately it'll be forgotten very quickly. And it is the start of a primary, right? Not really the start of a presidential run, but the start of a primary. And I think those words, that distinction is important.
Well, especially because there is this bigger question of, can someone who can win the Republican primary win the general election? And this comes at a time where, perhaps President Biden isn't coming from the strongest position either. It just seems like, to Zach's point, the crystal ball could get shattered pretty quickly. It's kind of murky as is.
I await the next adult poll. These guys are way behind Trump. That's my amateur take.
Yeah.
That's the sophisticated
You
summary.
can see that. It's in the numbers, yeah.
Yeah. I mean, I just go to the poll and look at the numbers, and I'm going to listen to what Greg Valliere and Zach Cohen and others think. Both having different jobs, but nevertheless, they're gaming this out. And it's not like the poll. It's not Trump 38%, DeSantis 32%. That's not where we are.
6 p.m. Eastern Time. Looking forward to tuning in. If you are just tuning in, welcome to the program. As Tom mentioned a couple of minutes ago, the White House and Republicans expected to resume debt talks today. That's according to Reuters, that headline out just a moment or so ago, Tom.
Yeah, I mean, when's the next headline? What are they going to talk about? Are we going to get another photo shoot? And that, mostly what we're going to do is get the clock ticking. And Kalen, we sound like a broken record, John. Guess what? Yellen's bringing it closer. We'll find out what tax receipts are. She'll tell us. And I believe is it March 24th today? I don't even know what day it is. Is it the 24th?
It's
May. Yeah, it's not March. Excuse me.
Get the month start.
I got the M right.
You know,
stay with me
that
here.
would be a star, wouldn't it? Welcome, Tom.
Yeah,
to the second quarter.
It's Wednesday.
It felt long enough. I mean, we didn't have to go
You've
back
seen
in time.
mortgage rates, just to throw out a number. Have
Insane,
you seen that?
yes.
7%, back at 7.
Well, and how does that challenge the recovery that we keep hearing about in the housing sector, right? Does that get dampened immediately? We saw yesterday, right? Didn't housing starts or some of the housing data come out at the highest going back 13 months?
I saw the numbers from Toll Brothers as well.
Yeah.
What were they? I missed that.
Doing okay.
Yeah.
Doing okay. Demand for new housing.
Yeah.
You know, it's an amazing situation in America right now, I've got to say. All these different points of tension, manufacturing versus services, rates are like up here and housing's just about holding on. Red Sox not holding on.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Tune in for the Bramo Cam at a commercial break for her real view on the debt ceiling negotiations.
Yeah, we got to go big little on the commercial breaks.
We really do. We've got to sort that out soon.
What would really pop the ratings is do the commercial, and thanks to all our great commercial vendors who make surveillance go. But then the other shot's the Bramo Cam. And that would, then we see us.
Whenever we start the conversation about the debt ceiling, I said this yesterday, the Bramo side-eye.
The side-eye is
something. The side-eye is like piercing. I look down the barrel of the camera and I can still see it.
Right, and the hands get going. I have a better shot. It's true. You know the peripheral thing, but what's really amazing is the hands. It's like she's landing in an airplane at Heathrow. Bring it in. I know, the debt ceiling, bring it over here.
Don't talk to me about it. Don't talk to me about
Wall
it.
Street, everybody just exhausted by this debate.
Couldn't agree more.
Can I go to Jeff Yu quick?
Please do.
PacWest, I just went to them because they're in the news.
Why not?
13-month CD, 5.50. I did not expect that. I thought it'd be lower. And this goes to what Jamie Dimon's saying, and Jeff, this is different than a month ago.
Stock's recovering as well. I'll throw that out there too. It's having a better time of it over the last couple of days. But Tom, they've got to get rates up to compete. They've got to get rates up to compete, and at the same time, what's that going to do to profitability?
She just put her hand out like she's landing planes in Heathrow.
It's true. Yeah. This is exactly the issue. They have to attract money. They're gaining because they're selling assets for something. This is a good thing, but there's a longer-term existential question that has not been answered.
The viability and profitability of these companies?
Correct.
When JP Morgan, Bank of America and others get to attract capital at 0%, basically funding themselves with deposits, offering nothing. That's what you're up against.
And
that's what you're up against. Two-tier banking system in America right now.
And the scale issue, and every day there's 3 or 4. They're not even in the headlines, mergers or whatever. Are taken out. John, futures negative 16. The VIX is almost out to a 20 level.
Equities are soft day. Equities were softer yesterday, and here's some follow through on the S&P 500, negative 0.4%. On the Nasdaq 100, we're down about 0.3%. Yesterday, actually, the biggest one-day loss in about 3 weeks on the S&P 500. Finally, equities started to snap, break in the face of the debt ceiling, whatever you want to call it. In the bond market, 2-year, 10-year, 30-year, yields at the front end. 8 straight days they've been higher. 8 consecutive days. Yesterday, just about higher on the session. Today we come back below 430. We're down a couple of basis points there. 429.32. What's interesting worldwide at the moment, you just look at the breakdown. Chinese equities lower, wiping out the gains for 23. Copper, a break of 8K. New lows for 2023. Even the luxury players in Europe starting to crack. And here's the euro. Break of 108, clean break now. The euro against the dollar, 107.51.
Wow, that really captures it on radio. Wow.
Negative 0.2% on the day, but this has been kind of relentless over the last couple of weeks. Had a little look at 111. Since then, it's backed away, backed up by weaker than expected data out of China and not exactly fantastic data out of Europe.
Technically, you're 107. You go right down to 105, and we're getting to a 106 level pretty quickly. Weaker at euro this morning. It's going to be interesting to see.
Agreed. Let's see what the ECB does about that. They look like they're intent to go forward and hike interest rates once again. Fed Governor Christopher Waller is going to speak later on at noon Eastern time. Look out for that. Fed minutes come out 2 hours afterwards. Rabila Farouki of High Frequency Economics weighing in on the Fed path forward and saying our base case remains that the FOMC will pause at next month's meeting. We think Chairman Powell also signaled a pause last Friday by highlighting that the risks of doing too little versus doing too much are coming into better balance, and the FOMC can afford to look at data and make careful assessments. How they characterize whatever June is, if it's not a hike, Tom, seems to be what the debate will be on the committee going into June 14th.
Yearning for the clarity of a V-shaped bottom. Joining us now, Rabila Farouki, chief U.S. economist, pulling a short straw and working with Carl Weinberg at High Frequency Economics. Rabila, in your note, you don't mince any words. You're looking at 70% of the economy, the consumer. The zeitgeist is January, boom off Christmas. Then we go February, slow down March. Do you have any clue what's going on in April, or dare I say May?
Good morning. That's what we're trying to assess. It's been very difficult to, predict how the consumer is going to respond. We saw 40-year high in prices. The consumer, had staying power, but we did see a moderation in February and March, and our estimates suggest that April will be a soft number. But the consumer is looking at a lot of challenges. in terms of high inflation and in terms, if you look at the confidence numbers. But if you look at, what they are facing high inflation, but they're seeing a gradual improvement in inflation. Right. They're seeing positive real disposable incomes now, and they're still sitting on roughly 500 billion of excess savings. So that may sustain them. So I do expect a slowdown in consumption in the second quarter, but I think there is some upside to that estimate.
If I look at consumption, the basic idea is you look at charge card data and the rest. How do you measure consumer? Do you just look at car sales?
No, I mean, we look at a range of things, right? I mean, we're looking at car sales, we're looking at how consumers are spending on goods, and we're looking at the trend in services. And, services has been the story especially in recent months since the latter half of 2022. And that's where we did see a slowdown in February and March. So that is what the Fed is looking for, that slowdown. It really isn't materializing in the inflation numbers, but consumers are, we're still seeing strong demand for particular services, travel, entertainment, dining out. Those things are still not moderating to the extent that we need to see it, because the labor market is also very strong. Job growth is strong. Wage growth is moderating, but it's still, wages are rising at a pace that is above the pre-pandemic trend. So these are the things that are sustaining the U.S. economy, the U.S. consumer, but it's not really clear to us how long that is going to last.
And this is the reason why the Fed had a very convenient excuse in the banking crisis to basically say, look, we're going to show restraint because banking crisis, and we don't know what's going to happen. Can they make that excuse now? Are they going to try to de-emphasize that aspect of the meeting minutes, given the fact that the market seems to have, at least in large part, moved on?
The banking crisis, we don't think that it was a banking crisis. When the Fed raises rates at such a rapid pace, you would expect to see banking, sector strains. It's just that, the risks were not managed well. But from the Fed's perspective, they have done a lot, 5 percentage points, and the unemployment rate has gone down. So they need to keep an eye on the wall in terms of what's happening with inflation, what's happening with the labor market. But the message that, what we're reading from what they're saying is, at least from what Chair Powell is saying, is we've done a lot and we do need to take a breather. We can afford to take a breather, and we can look at the data and see how things pan out from here. We have underestimated the U.S. economy, the U.S. consumer throughout this period. And now it is, but we still think that there is going to be an impact of 5 percentage points of tightening. And that is what we're waiting to see. I think that's what the Fed is going to do.
Is it breathing space, intermission, interruption, freeze? I'm wondering, basically how they're going to try to categorize this so that we don't end up with some sort of repricing of some of the rate cuts into the market that have somewhat been priced out since what we saw in terms of the turmoil in March.
Right, and I think that's where the challenge lies. So it's going to be a matter of communicating that they are going to take a pause. They're going to, not raise rates in June. But I think what the real message is that if things surprise to the upside, especially inflation and tightness in the labor market, that they are prepared to do more. And I think that is the message that they need to send. And the higher for longer message is still there, right? I mean, they are not going to back off until they see that inflation improve. The only way the Fed, in our view, the only way the Fed actually cuts rates this year is if there is a recession and inflation comes down substantially, right? Or you are seeing a situation where we just see inflation disappear, which is not our base case.
Rubila, I know you had to medicate Carl Weinberg when you were parsing the difference between pause and skip. Help us. What's the difference between pause and skip?
I'm not sure. I mean, it's really semantics at this point. If they pause, if they skip this meeting, it doesn't really say much about, I don't see it as saying much about what they're going to do subsequently. This Fed has said that, over and over again, that they're going to, at this point, they are data dependent. They are going to look at what's happening with the U.S. economy, the labor market, inflation, and they are going to respond accordingly. But, the message from the chair is that they've done a lot and they can afford to step back and take a look at what's happening.
Rabina, thank you. Rabina Faruqi
Great update.
of High Frequency Economics. I know there's a lot of frustration around this. You don't say pause right now because at the moment markets are convinced a pause means something else.
It means a rate cut.
It means that the next move after that is a cut. You take a break from hiking because you're open to seeing what you may or may not need to do in the future, which is why Neil Kashkari, the Minneapolis Fed, is so keen.
Do we have someone to blame?
I don't think the Federal Reserve actually wants to play this game. I just think that's the game the market is engaged with right now. Yeah. And they understand it's important that they've got to play along. So they're trying to play along. I also think the chairman is recognizing that there's other people on the committee, and have a look at the dot plot. We talk about the median dot. There's a spread there. There's a spread there. You're meant to reflect the consensus on the committee. If you start communicating to the market that you're done and there's going to be no more rate hikes when you've got other voting members on the FOMC and others outside of those on the committee who are talking about maybe needing to do more, I don't think you get that through. It makes sense that the chairman is open to maybe tweaking the language because that language is actually meaningful.
Especially at a time when the market has priced in a greater degree of stability into year end. In other words, we saw rate cuts priced out of the market rate cuts priced into the market immediately after the SVB aftermath. And now we've gone up about 1 full percentage point in terms of where we end the year in December with respect to Fed funds rate. So they don't want to go back against that and basically cause an easing of financial conditions by saying a skip or a coffee break or a postponement or a timeout.
I like that, a timeout.
We'll put them in timeout, Lisa. That's what we'll do.
June 14th, a Fed timeout. John, you mentioned something that's really important.
What's that?
And that is Alan Greenspan really wasn't interested in consensus. And I guess Chairman Powell is, or is he not? Does he have a singular voice if they come to making a decision? I'm not sure if that's been communicated.
It certainly gives me the impression that that's a man interested in consensus on the committee. I would agree with that. I'd agree with that. Not Greenspan, not Draghi. Draghi used to be criticised all the time, particularly from the Bundesbank, for pinning the committee, the governing council, into a corner, basically coming out ahead of time and saying, this is what we're going to do, and then getting everybody else to come with him.
In fairness, he had the luxury of rates that went nowhere and inflation that was more abound.
I also think that Draghi had the chops to do that with his committee in a way that maybe Powell and Lagarde don't for different reasons, and we can talk about that another time. Mark McCormick at TD Securities coming up very shortly from New York. Was I diplomatic then?
That was really good.
I almost was.
You was on the verge of diplomacy.
Have some more pasta.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Nouriel Roubini is warning that talks to avoid a U.S. default could drag on, with failure to agree on a debt ceiling likely to hit markets and damage confidence in the dollar. In an exclusive conversation with Bloomberg's Francine Lacqua at the Qatar Economic Forum in Doha, Roubini also said he believes the U.S. and China are headed down a path of confrontation after a G7 summit in Japan.
After the G7 Hiroshima summit, I would say there's not going to be any thaw between U.S. and China. The Chinese reaction to this G7 summit is that European, U.S. and Japan and others are ganging up against China. So this Cold War between U.S. and China is going to get colder.
Roubini signaled out the threat of a geopolitical depression among the biggest risks facing markets, pointing to the fallout of Russia's invasion of Ukraine and the possibility of escalation between Iran and Israel. Florida Governor Ron DeSantis is set to make it official and announce his 2024 presidential campaign. Bloomberg has learned DeSantis will join a Twitter Spaces live stream with Elon Musk at 6 p.m. this evening, Wall Street time. The announcement would end months of anticipation and set up a bitter confrontation with GOP frontrunner Donald Trump for the party's nomination. The governor of Russia's Belgorod region is reporting that what he says was a large number of drone attacks overnight, causing damage to buildings, though he said most were intercepted by air defenses. He said repairs to gas, electricity, and water services were taking place following the border incursion by attackers who crossed from Ukraine. And he said more than 500 people fled their homes during the fighting. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Debt ceiling. Are we going to get through it without a credit event?
The honest answer, we don't know yet. They may get to the last hour before there's an agreement, or it's possible they don't reach an agreement. If that doesn't happen, then the market is going to crash, and that may force an agreement in the next few days.
Nouriel Roubini there with Francine Lacqua at the Qatar Economic Forum. As Bramo's about to say, very on brand, Lisa. Very on brand.
Well, I mean, and also, this is basically what everyone's been saying. I think it's, it works. It's a Nouriel Roubini assessment of the debt ceiling. If it doesn't happen, we do. If it doesn't happen, disaster.
We've got a message for you, Nouriel. He's a good friend of ours, by the way, so he would take this well. This was from Mitch McConnell. Everybody needs to relax. Everybody needs to relax. That's what Mitch McConnell's got to say. We got a headline a little bit earlier on this morning from Reuters suggesting that there will actually be some talks today between the White House negotiators and Republicans, Tom. Expected to reconvene a little bit later, perhaps, according to Reuters.
I don't have the ages in front of me. I'm assuming Mitch McConnell's a young guy, but he and the president are from a generation where Howard Baker and Sam Murphy said, let's relax. Barbara B. Conable said, let's relax. None of these younger people, both left and right, have any desire to relax at all.
I'm not sure that anyone's panicking, though, Tom. So I'm not
feel
sure.
That. I
do
do.
you
I
get
agree.
the sense that anyone's panicking right now?
No, actually, I wouldn't mind if there was a little more panic down in Washington, D.C., just to get something done. I mean, honestly, if you're debating, is it really June 1st? It probably is June 15th. You guys are pulling our leg. I mean, if that's the nature of the debate, that's not really freaking.
I was on the phone to Tom last night, and I said, it's June next week. Where's that gone?
Exactly.
It's June next week. If you are just tuning in, welcome. Equity futures a bit softer at the moment. Equities were softer yesterday, lower. Equity futures right now on Tom on the S&P 500 negative 0.3%. Big attention going into the FX market, I think, at the moment. Just this breakdown of the euro continues, 107.50 on that currency pair.
That's a big difference, folks, from 1.0770 to 107.51. Seems teensweeny and small, but nevertheless, the trend is in the right direction. Someone who's nailed this is Mark McCormick, Global Head of FX and EM Strategy at TD Securities, working with Priya Misra, among others, and it's really a perfect time to talk to Mark McCormick. Mark, I want to talk about the McCormick reset. You wrote a end of year research note that was codified as brilliant. Okay, that's ancient news. How do you write the May 31st research note? What do you say on dollar?
Yeah, so I think a big part of it is what we've seen is market positioning, especially the models that we track, don't match the current narrative. And the narrative has actually changed dramatically in the space of 3 weeks. I think a big part of it, there's a lot of focus on the debt ceiling and the impact that it has in the Fed. But I think the one thing the FX market cares a lot about, particularly the euro, is to China. We've seen data surprises in China go from 3 standard deviations positive to flat within 2 weeks. So essentially all of the tailwinds the euro had that came from the debt ceiling creating issues for the Fed, the banking stress in the U.S., the slowdown in the U.S. relative to other economies has basically not even paused. It's just sharply reversed and dramatically reversed in 3 weeks. So the emphasis is now on the debt ceiling maybe being allowed the Fed to tighten a little bit more if they get, through the brinksmanship and they get a last-minute resolution. And now what we're seeing again in the matter of a couple of weeks, U.S. data, just high-frequency data, not the trends in data, but high-frequency data is now showing U.S. outperforming both Euro and China, which reverses all the positioning that we've seen built up in the last couple of months.
Well, let's talk about that positioning. We sat around the table with some people in London a number of months ago, and we said to them, who's going to do more this year? Everyone was like the ECB versus the Fed. I don't think that's changed so much, Mark. What has changed, to your point, is the data, and it's taken a euro from 110.95 at the end of April all the way down to 107.50 on the screen right now. Mark, can you talk to me about positioning? We're just taking a bite every single day against this big short position that was building up in the US dollar. What's left of it?
So Euro still tracks high on our models in terms of being overbought. It's not at extreme levels, where it was, but essentially a nice way to characterize is about 50% of the currencies we track in G10 and EM were long against the dollar, with about 40% of them having a magnitude of 1 to 2 standard deviations, meaning they're stretched. So Euro kind of sits in the first bucket where it's long, but there's now just a lot of wood to chop to take it, to get things realigned. Euro's trading a little bit cheap relative to what we call high frequency fair value. It should be about 109, basically how it trades relative to macro drivers. But a big part of it here is, as you mentioned, we do expect ECB to generally out-hike the Fed. But when you lose China, you lose the growth narrative. And basically what we saw with the industrial production data in China is imports were very weak. And that is a big part of what the euro needs to rebound. And at the exact same time, we're seeing slippage in European data. German ZEW was weak. So essentially, there's conflicting stories for the euro. The terms of trade shock is still important. It's still providing tailwinds. The current account surplus is coming back, which is also good for capital flows into the Eurozone. ECB is better placed, I think, than the Fed. If we track the speeches, the Fed has been more dovish than the ECB in that context. So I think the Euro's in a bit of tug of war, but the more focus we get on the US being in a better position, and the more we get focused on China being in a bad position, that pulls the euro a little bit lower.
Meanwhile, a lot of people are coming around to this idea that perhaps they underplayed or underestimated the dollar. Goldman Sachs yesterday came out and said that they believe the dollar has more room to strengthen. Michael Cahill and Lexi Cantor came out and said dollar depreciation is typically associated with strong growth in the rest of the world, not weak growth in the U.S. We are still waiting for a challenger, and the euro is not stepping up just yet. Are you thinking perhaps the story of dollar losing its hegemony has basically been overplayed and that it will continue to strengthen at least, or at least be range-bound into year-end?
I don't think it's year-end. I think this is a summer play. I think a lot of it, again, is we match the narrative that we were talking about for a couple of months has been overplayed by positioning. So for me, what we see in our models in terms of how markets are trading strategies and trading ideas, positioning is actually quite important. We don't have, the thing is too, is last year we had dominant macro factors like inflation in terms of trade that generated solid performance in FX. This year we have a whole array. We look at equities, we look at growth, we look at inflation, we look at rates. Those things are all kind of making money, but they're making less money than those key drivers last year. So to me, the one thing that's happening is all of our positioning models are really extremely elevated. So to me, the other thing that people are missing is we could move into a trade where bad news in China is good news for markets. We're getting to the point now if the renminbi weakens too much or growth stumbles too much, we get a policy response. And so if we get a policy response from China where we see one part of the world that's easing and basically we see most central banks moving to the sidelines, we get the RBNZ overnight and essentially they're done. We're limiting the surprises from central banks, and inflation surprises are moving in a better direction as well. So on the whole, I find this a bit more of a consolidation. It's maybe a 1 month move. We're essentially a Fed pause in June and a poor, or I guess you could call it good inflation number away from kind of resetting the boundaries of where data surprises are moving and where the markets want to find that new narrative. So I would say we're actually still quite bearish the dollar into the second half of the year, but I'd be a little bit more focused on the consolidation and turbulence in markets right now.
Interesting. Mark, thank you, sir. Mark McCormick there of TD Securities. I see that a lot, Tom. There's an unwillingness right now to call this a longer-term story. There seems to be a willingness to embrace what's happened on the screen, because it's happened on the screen, and to say that tactically over the next month maybe this can continue. But we are taking away a big leg of this, and Mark mentioned it, the growth side of the narrative around the single currency against the US dollar, and more broadly the dollar weakness people were looking for.
And long term, is that to get out past Labor Day? I mean, that's how silly this whole thing is. I don't think people are 1 year, 3 years, 2 years, whatever. I don't think we can get to Labor Day. This key thing I heard there, which I really agree with, is they talk about corporations adapt. Well, guess what? Central banks and governments adapt. And the Chinese government, I don't care what the politics is, has an ancient history of adapting and adapting aggressively late Sunday or evening.
Well, I think this is an interesting one, TK. I think that's the outstanding question at the moment. Just how willing are they, Lisa, to adapt and to do more to support this economy? Because this is not the reopening that many people imagined several months ago. Especially if they are able to ignite internal growth, even if it doesn't become external growth, with respect to how much China interacts with the global economy, because there are different spheres here. You see sometimes the domestic consumption picking up, but they're not necessarily investing in the manufacturing side of things. So it's just tricky to understand the policy response in a China that has dramatically changed with respect to the Chinese Communist Party over the past 4 years.
I'm wicked old school on this. I think it's a lot about social, not unrest, but the social dynamics of China far more than it is about a macroeconomic debate.
Can we say hello to someone? Can we do a shout out? Can we say hello to Lindsay? Your husband's written in. He says, my wife says, quote, can we watch something else? These numbers are making me nauseous.
They're making us nauseous too. Thank
Lindsay,
you for
how about this? We'll take a break. No numbers for 2 or 3 minutes. And then we'll come back and we'll go light on numbers.
Pro tip, Tang Mimosa. Tang Mimosa.
Lindsay, give it a chance. All right, it'll grow on you. If you don't like Tom, you might like me. You might like Lisa. You know, there's something for everyone here. From New York, this is Bloomberg.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. From the world of politics,
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power, the
balance of power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but, you know, we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power.
This is Bloomberg. Moment News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
We're in a challenging period right now, an anticipatory period.
The Fed is very, very keen on getting inflation down from 5% to 2%. And as long as that's the case, the Fed will continue to step on the brakes.
We're at a point where we're probably peaked rates.
This whole rate cut talk, forget about it.
This is another setup for a cyclical rally. You know, 4,300 isn't that far away from where we are today.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It's one of those weeks. Is it only Wednesday? Only Wednesday?
100%.
Is it only Wednesday?
It's so bad it's March, not May.
From New York City this morning, good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures just about negative on the S&P 500, down by 0.3%. The debt ceiling negotiations, Tom, set to resume a little bit later down in Washington.
Yeah, and the story's moving forward. We had the Reuters headline earlier, and I don't know what's going to happen. What I got here, the number one number I want to know right now, John, is the good people with Secretary Yellen. What's her calculation of the cash in the account in the cash room at the Treasury?
Follow the money. Follow the numbers. Don't listen to the mood music down in Washington. That is going from one point to another, back and forth, back and forth. And Bramo, yesterday, impasse this morning, talks again.
It's very difficult to get any conviction from the mood music. I mean, honestly, I do like your suggestion from yesterday, da 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 da, or da 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 da, da like happy things. Yeah, exactly. To basically give a sense of what we can expect. People are ignoring it all. Basically, what is the X date? How close are we? And can we get any consensus? Or are we risking some sort of technical default?
Every time a politician in Washington speaks, they should have music playing, you know, like violins and stuff like that. And when it's happy, it's happy. Clown music sometimes might be appropriate too, as this continues.
You could DJ this. I think that would be a
sure,
big hit.
I'd do my best. I'm sure everyone would love that, or maybe not. Let's talk about the broader price action too, because what we've got today is a bit of a breakdown in some of these cyclical stories. Copper, south of 8,000, new low for 2023. Luxury names performed in a monster way over in Europe, breaking down yesterday, breaking down a little bit today as well. And Tom, China wiping out all the gains in the equity market on the benchmark for 2023.
I still say China's there, and as we mentioned the last hour, you do have an acceleration in weaker renminbi, obviously managed by the government. There's no question about that. But I thought the Mark McCormick interview 10 minutes ago was really critical, where he says, look, these central banks, these governments are going to react to events. How does a government in Beijing react to what is clearly a bloom off the 6% rose?
Starting to question this growth narrative abroad. Not at home here in America. We've been doing that for 12 months, waiting for this recession that still hasn't happened, Bramo, but starting to question it internationally.
And this is actually going to really draw some questions around the euro and how long it can really strengthen versus the dollar. And I think this is actually a pretty big trade. If you get a stronger dollar, how much does that disrupt the entire narrative of the first 5 months of this year in a way that people are underappreciating the, developing markets, go into that, go into risk. I mean, if you get an upset of that, that could really catch people off sides.
As if the NASDAQ move wasn't enough yet today, absolutely flying. Shown some weakness the last couple of days, though, included this morning. Let's get that up on screen. Equity futures right now on the S&P 500, negative by 0.3%. Similar move on the NASDAQ. Yesterday, decent day of losses. Biggest one-day drop, I think, on the S&P going back about 3 weeks. In the FX market, this is the one to look at, Lisa. Euro against the dollar, euro-dollar, 107.50.
To me, this is actually one of the more fascinating trades. And if it does gain steam with more persistent euro weakness, dollar strength, that could be a real macro driver. 10:05 a.m., another macro driver, U.S. Treasury Secretary Janet Yellen. She's going to be speaking in London at the Wall Street Journal CEO Summit. Does she push back against questions around the X date? Does she give us something more concrete about when the U.S. will actually be unable to pay their bills? And could that expedite some drama that people say is already there and other people seem to disagree? Today, we do get Fed meeting minutes at 2 p.m. Tom, that's that's just for you. You can parse through them and get a sense of a skip, pause, coffee break, whatever you want. We get also former Fed Vice Chair Rich Clarida at 11 a.m. He's going to be speaking in Cleveland, and Fed Governor Chris Waller at 12:10 p.m. at UC Santa Barbara. Do they lean into this idea that a pause is just a pause? It's not an end or some sort of beginning of rate cuts. And retail earnings, I do want to bring you this. We're getting some Kohl's earnings. We're expecting Abercrombie and Fitch in about a half an hour, American Eagle Outfitters after the bell. And we do expect NVIDIA, which will be key to a lot of the market drivers. Kohl's coming out, beating estimates. Their first quarter earnings per share, that came in at 13 cents. The estimate was a loss per share of 40 cents, and those shares spiking up about 10% in pre-market trading, perhaps because that company got so beaten up before.
Never been. What's it like there?
Well, I used to go in Milwaukee when I would go visit family there.
Right.
And it's got some really good deals.
Okay. Thanks for that. If you want an endorsement deal, Coles, with Bramo, that'll work.
I mean, it's like, one of these all-purpose malls that caters to, people on a budget, and it's not, it's like the lower end of that kind of store. I'm doing a
10-year
crazy awesome job.
10-year total return annualized and negative 4% per year.
Do you want to share your zip code and address so they can send the check?
Yeah.
That was
Maybe
impressive.
they'll send a fruit
Was that, do you think that was worth a check?
Daryl Cronk joins us now, Chief Investment Officer at Wells Fargo Wealth and Investment Management. Daryl, good morning to you, mate.
Good morning,
It's good to see you.
You too.
Should I be trading on really robust services PMIs or dreadful manufacturing PMIs? What world am I in right now?
I think it's more the latter, probably. I mean, there's all this narrative about kind of a rolling recession, right? That it happens in phases. It's housing, it's manufacturing, it's the consumer, it's services, and people think it's different this time, and that's what's going to save us and get us to a soft landing. The reality is, you go back to every recession since the 1970s, they're always rolling, right? They always happen at moments in time where you're going to have different pieces of the economy. Right now, it's hard pressed to look at manufacturing and think anything is not in outright recession right there. The services and the consumer, obviously, well, is held up. I think what's interesting there, and speaking of some of the retailers, the retail stock activity has been dreadful, right? I mean, if you look under the surface, retail companies' stock performance, you look at energy performance, you look at REITs, all the cyclicals underneath, below the tech side of the skew to the index, is just driving things in the ground and telling you the economy is slowing unconditionally.
You have so been here before. You've got a guy, Ed Kelly, you stole him from Credit Suisse about 8 years ago. He follows big box retail, #1 ranked on Bloomberg on Walmart. Walmart's trading at 24 times earning, and the Wells Fargo clientele, I assume, is scared stiff. What do you tell them in a hotel in St. Louis?
I think you have to fade those at that price level. There's just no way you can pay that kind of earnings multiple in a slow and contracting economy. I mean, you're basically paying for earnings 3 to 4 years ahead.
You're extending out your hope.
Yeah, and I just don't see that at this point. Now, the interesting thing is, everybody is banking on the consumer, right? Last year, we know big drawdown in savings. On the national savings rate, we drew it all the way down to 2.7%, which, as they drew that down, it bolstered consumer spending, right? If you look at the national savings rate right now, it's back up to 5.1%, right? It's actually gone back up. Now, you can say, well, that's a good thing, it's a bad thing. It gives dry powder, right, to extend the consumer spend. But the problem is, if the consumer doesn't spend that money, which I don't think they will, right, you start to lose that engine, right, of the consumer into the back half of this year.
You said something I want to pick up on, that when you take a look at retail stocks, they've done terribly. When you take a look at energy stocks, they've struggled. In light of the bifurcation of the index with big tech, basically NVIDIA and Apple and everybody else sort of flat on their backs, do you see a Savita Subramanian kind of world where you could see, tech kind of range bound and some of these other shares catch up even in the midst of some sort of slowdown or recession?
I doubt it, right? Because, I mean, if you look at the valuations, they're still not where risk reward is compelling to me. I mean, I've got my equity risk premium sub 200 right now. Usually I need that 350, 400 to get paid to take risk in that equity market. If you lose tech, I mean, think about it this way. So take what I just said, retail, energy, REITs, right? All your cyclical stocks. Throw in small caps, right? The Russell 2 is gone from being earlier this year 800 over the S&P and outperformance to now 400 to 500 under, right? Which is a huge swing. if you just take Apple and Microsoft's market cap alone, they're more than the entire Russell 2000 index. More than the entire Russell 2000 index. Let's repeat that for a second, right? Think about that. Two companies, right? So everybody knows the narrowness of the market, the skew of the big 5 or 6 names, right? So I'm not going to repeat that, but just to put it into perspective, it's, you know, those top 5, 6 names are 53% of the NASDAQ 100.
We're talking about this phrase, breadth. I think it is important. It keeps coming up. If you are in a market cap weighted S&P 500 index right now, a lot of people are. A lot of people listen to this program. They are too. Does breadth matter when it's this narrow? Mike Wilson of Morgan Stanley is pointing out the flaws of this rally. And Lisa, he brought up breadth, the narrowness that you describe. Right. Savita Subramaniam sat in your seat yesterday over at Bank of America and said that was a false negative, that it wasn't that important. Is it important?
It's important because I think it's not only is it important from a technical standpoint, right? Technicals versus fundamentals, but I think it's a real good fingers on the pulse of liquidity. And I think what people miss in this year-to-date kind of back and forth of this market is we all know with the banking crisis, the Fed's balance sheet expanded $400 billion. Liquidity was pumped into the engine. We've now taken 300 of that 400 back out. And through the summer months, right, assuming you don't get another crisis that forces an emergency injection of liquidity, you're going to keep drying up liquidity. When you dry up liquidity, you dry up breadth. When you dry up breadth, you dry up support. And the technical indices just roll over on themselves, basically.
How much more difficult is it getting from a psychological perspective to stay cautious?
Look, we talk about this at our strategy committee all the time, right? We went bearish in February of 2022, right? It's now May of 23, right? Our clients are tired, right? They're wanting to put money back to work, right? And I understand that. Bear markets are exhausting, as we all know. But I think it would be so just like a market heading into a recession or contraction to suck investors in at the last moment, right? And give them a bunch of false positives and a bunch of false narratives. That happens every recession, right? Go back and track it. Every recession, you'll find investors find a reason to jump in. Let me make one more point here. So think about 2008, right? On the precipice of going into the what was the trough in March of 09. The 3 back quarters of 2008 were like 2.5%, 2.6%, 2.7% GDP growth. And everybody looked at it and said, the world's fine, right? We're growing 2.5%, right? The data was supporting it. So investors just have to be careful. I know it's psychologically hard, but you got to look at the underlying fundamentals and signals and say, where am I getting paid to take risk and where am I not getting paid to take risk? And today you're just not getting paid to take risk.
Michael Hartnett of Bank of America saying almost exactly the same thing going into last weekend, saying it's one of those moments where you get sucked in just before it goes whack. The psychology of this, I always find it fascinating. You need to become therapists and get therapists around the table with us.
That's why Lisa's here.
She's a market therapist.
Everyone's going to basically run off a cliff. No, but I will say
you should see the bills
for
Darryl,
them.
It's good to see you, mate. Thank you.
You should name your dog Zell. The money's coming in so fast.
Coming up in the next hour, Liz Young of SoFi. Looking forward to that. About 45 minutes away from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A complete U.S.-China decoupling is not possible. However, a selective decoupling is taking place. That today from former CIA Director David Petraeus, who spoke exclusively with Bloomberg Editor-in-Chief John Micklethwaite at the Qatar Economic Forum in Doha.
It is certainly not a partnership without limits, as it was declared. We've seen very distinct limits. I really don't think that China, President Xi, doesn't see Russia as an equal. When President Xi went to Moscow, had his summit with Putin, he didn't get what he wanted. China, this is a very transactional relationship at heart. It's not a relationship between two equals.
And we should note the government of the state of Qatar is the underwriter of the Qatar Economic Forum, powered by Bloomberg. Hong Kong's leader is joining state media in blasting Cathay Pacific Airways over an incident where flight attendants were recorded making disparaging remarks about mainland Chinese passengers. John Lee said today he was, quote, outraged and disappointed. Hong Kong's flagship airline said it would investigate the incident before quickly announcing it had fired 3 flight attendants. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
London and Sydney.
From Washington.
Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep rain World Cup.
This is a 3 as the economic picture does. The OK is getting ready to make a decision.
The debt ceiling deadline closes
Back
in.
and forth on the debt ceiling debate.
Kevin McCarthy says it's going to be on the floor next week.
Keep it tuned to Bloomberg for up-to-the-minute reporting
Movement from the White House walked out of this meeting saying the White House was being unreasonable.
and first-hand analysis from the political and business leaders who matter.
The debt ceiling is potentially catastrophic.
We will not pass a clean debt ceiling. They should just simply do their job.
Both political parties are guilty.
For continuing coverage of the debt ceiling standoff, keep it tuned to Bloomberg, your global business authority.
We'll be interviewing Ron DeSantis, and he has quite an announcement to make. And it'll be the first time that something like this is happening on social media, and with real-time questions and answers, not scripted. So it's going to be live, and let her up. Let's see what happens.
Campaign manager Elon Musk, Twitter CEO, announcing effectively that Ron DeSantis may well be announcing a little bit later on Twitter. In all seriousness, looking forward to this a little bit later. 6 p.m. Eastern Time, we're going to see Governor DeSantis alongside David Sachs, entrepreneur, venture capitalist, and Elon Musk.
Did you mention David Sachs? Who's David Sachs?
Entrepreneur, venture capitalist, longtime friend, I believe, of Elon Musk as well.
Okay, so they're going to climb on board.
Conservative voice, really interesting podcast if you ever want to listen to it, Tom. Available on Spotify and all other streaming platforms.
I'm fascinated by this in the sense...
I sound like his promotion.
I know, I was about to say, what check is he going to send you?
There's all history, John, in our forever-ending campaign of being a governor in running, like Governor Bush of Texas, granted he was from a very well-known family, or being a senator in running, rarely being from the House in running. But, you know, it's interesting. This guy's a governor, and as I said earlier, boy, did he win big last time around.
Big time.
Why is he doing Elon Musk at a presser at 6 p.m.? I think it's an important question.
These are individuals that conservative voices gravitate to on a platform, as Lisa indicated in the last hour, that the former President Donald Trump is no longer on. I think there are plenty of reasons that line up in the direction of doing something like this a little bit later. You've got to bear in mind also that it's a primary. And then once you get to the broader election, if you go in that direction, then of course you need to go way beyond the individuals that may consume this content in about 12 hours' time. I also think we should put out there, and I said it in the last hour as well, Lisa, that ultimately the first steps, are they that important? I mean, how many How many campaigns do we remember the start of and say, that was it, that was where the magic was? What a brilliant move.
Well, some of them have resonance for other reasons. I do think, though, that this particular one will generate a tremendous amount of media for Ron DeSantis in a way that perhaps if you were to announce on Fox or ABC or CBS, it might have less resonance because, A, you have Elon Musk, who always generates a lot of headlines helping to get this going. Twitter is a first. You know, all of these reasons to sort of amplify the message.
We'll see what happens, Tom. Look out for it a little bit later. I'll be watching it. I'm sure many other people will be too.
We know what's happening right now. Symptoms of jet lag, daytime fatigue, insomnia, nausea, stomach issues, mental fatigue, dehydration, and appearing too early in the morning. Our chief Japan correspondent, Anne-Marie Horton, back from the G7 meetings, and we welcome her back in Washington right now. Coming back, Anne-Marie, is the hardest thing to do. The jet lag the president has, he doesn't have much time for jet lag, does he? How's he doing in the first hours of getting back?
Well, the president didn't have a lot of time to really work this off because obviously he had a really important meeting on the debt negotiations with Speaker McCarthy. He had told me before he left Japan that he hopes that meeting in person that can get it over the finish line. Obviously, there was an impasse as of last night. We didn't even know if there'd be a meeting today, but Reuters is reporting that the White House negotiating team with the Republican negotiating team will meet today. But we are 8 days out from what Treasury Secretary Janet Yellen has described as the start of a potential date that we could see a default, that Treasury would start to run out of funds. So time is of the essence. And at the moment, there still is no deal. Patrick McHenry said he's even unsure what to expect next, although he did say that his phone is literally blowing up with text messages from angsty Wall Streeters. And he says his text messages right now, his phone is a dumpster fire. So obviously there's a lot of pressure on Washington at the moment to find an agreement, but it's just not there yet. There are still major issues at play.
Well, let's get to some of the issues and get away from the rhetoric and the mood music. I think that we have established a red line here with Speaker McCarthy. He wants to cut spending. In fact, you asked the president directly about this in the news conference, Anne-Marie, over the weekend. You have seen a shift from Democrats, from leadership, who are saying that perhaps maybe a compromise could be to keep spending flat. We are going somewhere, aren't we?
Yes, I would say it's a baby step forward, though, because what you heard, especially yesterday, not just from the president, but Hakeem Jeffries says what he thinks potentially is more reasonable is to keep spending at 2023 levels. And this is what the president was trying to talk about. At what base do you cut from? And then this gets into a host of a ton of other issues because Speaker McCarthy doesn't want to keep spending flat. He wants to cut spending next year. What the president also said is he's willing to cut spending, but he wants to see revenue raises. Speaker McCarthy has said directly to me he will not raise taxes. He will also not pass a clean debt ceiling bill. So there's clearly a negotiation right now and a standoff on the caps of spending for next year. But then also a little bit more into the details is work requirements is becoming an incredibly important issue in this negotiation. We do know the president has said before he left for Japan, he said, I will not be on board with work requirements for health, to access to health care. But he didn't talk about some of the other programs, but this will pin the White House directly against the progressives in their party. I'm talking about work requirements for things like access to food and groceries and items like that. So this is becoming another major point, and we're not really seeing movement there just yet.
I'm wondering, Anne-Marie, what you make of House Majority Leader Steve Scalise coming out and saying, we'd like to see a little bit more transparency around the X date. Why this discussion around whether it's June 1st, June 15th, or June 23rd?
There's a lot of talk amongst the Republicans that they just, quite frankly, do not believe Treasury Secretary Janet Yellen's June 1st, which she talked over the weekend about a hard deadline. They think they have a lot more wiggle room, at least a week or two. You had Chip Roy from Texas talking about that he calls this a manufactured crisis because of how much the administration is putting on that June 1st date. And then you also had Matt Gaetz telling reporters to go ask the Treasury Secretary about her, quote, Ouija board. So in McCarthy's camp on the hard right, they think they have a lot more time, and they really do not believe the timeline that the Treasury Department is putting out.
This is how accidents happen. This is how accidents happen. Now, I have to say, Anne-Marie, just to squeeze one in, do you get the sense that that's a game that the Treasury Secretary would be willing to play?
I get the sense that the Treasury Department is quite concerned. They do not want to see a default, especially on Janet Yellen's watch. This is someone that is beloved at the Treasury Department. She's a former Fed chair. They think she's incredibly brilliant. Many Republicans also think this is someone who is a safe pair of hands, and they do not want to see a default on her watch. And if you're the Treasury Secretary, I think it's fair to say if you're in that position, you're going to want to be as conservative as possible, because you aren't sure how the politicians are going to be able to get across the finish line. But if you look at what Goldman Sachs, Morgan Stanley are talking about, I mean, you have analysts on Wall Street talking about maybe not June 1st, but maybe June 8th or 9th. So it's a little bit of wiggle room, but it's not a ton.
What's a week between friends? Anne-Marie, wonderful to have you back down in Washington. Great work over at the G7 in Japan. Thank you. Thank you very much. AMH down in D.C.
It's way underestimated. The Treasury is not a politician. It's not a political base. They have far greater restraints than what's in the zeitgeist right now. Far greater restraints.
You know how when you have a friend who's always late, like chronically late?
You lie about the time.
You lie about the time. You say, 15 minutes earlier, half an hour, depending on how they are. It could be an hour. And if they were to say to you, I question whether that's actually the time.
I don't.
At a certain point, you're like, well, you're going to get here late anyway, and now we're actually dealing with the deadline. I kind of understand why, if they move it back a week.
There's a statue out front of Albert Gallatin. Since Albert Gallatin's time and what Hamilton invented, these guys are the straight guys. They're not the politicians, and they're hugely constrained.
I think even if you are, Tom, a prudent policymaker, the prudent thing to do is to bake in a cushion, because you don't know the date either. And I think that's really, really important.
No, they don't know the date now, but
the Treasury Secretary doesn't know the date either.
Yeah, fair.
They know that tax receipts are incredibly lumpy. Yeah. They know that in the middle of June they might get another big load of tax receipts, but ultimately, can they make it to the middle of June? I think initially when she came out with early June, it was conservative. It had a decent cushion. But based on how the Treasury cash balance has evolved over the last couple of weeks, I think we can all acknowledge that that risk seems to have come in just a little bit. We'll see how it evolves. From New York, equities down just a touch. Greg Peters of PGIM coming up next.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Welcome to the program, live from New York City. Equities just about negative on the S&P 500. Similar move on the Nasdaq through most of today. Down yesterday on the S&P. Biggest one-day drop in about 3 weeks on the S&P. We add to that, take some more away from the rally year today. In the bond market, big moves in a 2-year. 8 consecutive days without a down day on a 2-year yield. Down today by 3 basis points, 428.29, just sub 430 on a 10-year, 467.85. I'm just saying the more interesting move might actually be in the very, very long end of the curve. The fact the 30-year went through 4% briefly yesterday. For all this recession talk, for all this talk of rates going back to pre-pandemic norms, what's the 30-year doing up by 4%? We'll build on that in a moment if you want to. In the FX market, really interesting stuff out of China. Equity market breaks down, wipes out the gains for the year. Interesting stuff reflected in the commodity market. Copper sub 8,000 new low for 2023. And interesting stuff in European luxury that we can discuss through this morning as well. All of that means a weaker euro over the last couple of weeks, just losing some of that enthusiasm around the global economic story. The euro against the dollar trying to stage a bounce right now in the last 30 minutes or so, Lisa, getting back to about 107.69 from down near 107.50.
Interesting to see the macro story. The micro story arguably is more interesting even now, especially as we get some of these retailer earnings, and they're inconsistent. I will just say that. We just got some numbers from Abercrombie and Fitch seeming to follow in line with what we saw from Kohl's coming out with first quarter net sales of $836 million, the estimate $814 million, also upgrading their forecast. Their first quarter adjusted earnings per share, 39 cents versus an estimate of basically being flat. A very different story at Children's Place, where you can talk about inflation potentially taking a bite out of people's purchasing power. We talked about Kohl's earlier, how they also raised their forecast and seem to be really working down their inventory problems, and those shares up almost 12%. With Children's Place, I do want to just point out, new parents who have constrained incomes and are facing inflationary pressures perhaps are going to be less willing to shell out for a pair of pants that their kids are going to outgrow quickly. And I will just say, I do think that's interesting.
Are they going to price down on the strollers? Everything I see in New York of these strollers, they cost like $3,000 or whatever. They got, they're like.
What strollers are you looking at? $3,000.
I don't know. I'm looking. They're running these babies around in really fancy hardware.
Just to be clear, Children's Place, have you ever been in one?
No.
Okay. They don't really typically sell strollers as much as the actual physical clothes. And I'm just saying, I mean, it was you buy 10 pants or whatever.
You said the clothes are expensive.
No, actually, they're not that expensive. They cater to a lower end kind of quick use turnover, which is really what I perused when my children were younger. But here's the issue. Those are people who typically will experience and push back on pricing pressure more. So you do see signs of this in different places. And then we're also watching.
You know what's great? Aisle 7, Tuition Place. It's a great store.
Do they sell strollers there?
They don't sell strollers. They sell walkers for the grandparents. They sell walkers for the grandparents. It's a good, John, you should try it out, Tuition Place.
Yeah, thanks for that.
Thank you.
Did you want to talk about NVIDIA?
Well, I do think it's going to be interesting to see after the bell, because they have accounted for such a significant portion of all the gains so far year to date in equities. Do they deliver? Right now they're down 1.2%. What's the China risk? given some of the tit for tat with Micron? What's the potential demand for semiconductors? Is this really going to be a bellwether of the whole artificial intelligence craze?
Down 1%, the stock's doubled this year. It's something
Shocking.
else.
I feel for them.
Something else. Debt limit talks stalling. Greg Peters of PGIM Fixed Income saying investors are paying for default protection in the near term. We went out the curve somewhat as our sneaking suspicion is that it will continue year after year. The congressional disruption in D.C. is not going away anytime soon. TK, is this the old normal, the new normal? What do you want to call it?
I'm so glad you picked this paragraph from his research note. John, this is the fixed income note I've seen in 10 days, maybe 2 weeks. Greg Peters at PGIM right now on where we are and where we're moving forward, joining us. Greg, it's a really complex thing. I think we need to talk for an hour with you this morning. But I want you to set up what the market reaction is going to be if we get PGIM persistency and yield, or dare I say we go to a higher 5.6, 5.8, and then the dreaded 6% yield. What happens when we get there?
Well, I think we're a long way to 6%, but at the end of the day, we do think yields are too low. If you look at the move that we've seen, particularly in the front end around the banking crisis of March, there was a really, steep move lower, and that doesn't make a lot of sense to us. And so, when we're looking at the curve, we feel like it's mispriced. We feel like it's already pricing in a recession. And then when you look at risk reward, even if you do get a recession, which is still, probable, of course, will you be rewarded for it? And the question on the table, I think, suggests no.
Let's go pro here. There's a thing, Greg, called credit default swaps. Bramo talks about this all the time. You say there's a real efficacy to follow the CDS market. For mere mortals listening and watching, explain the linkage of their yield world with the CDS world.
Well, it just is a measure of credit risk of the U.S. sovereign, right? And so, what we've seen over the past couple months or so is that that risk is elevated, of course, right? So this debt ceiling debate, let's call it, is creeping into the risk of the market. You're seeing that in the CDS curves. And so what you've seen is investors really pay up for short-dated protection in the event of a default or some type of disruption. What we decided to do, and to be clear, this is very much of a drop in the ocean type of trade, but what we've decided to do is actually not pay up for the couple months or even 1 year, because we do think it's a persistent problem. So, I really worry about at PGIM that this political debate around spending and using the debt ceiling as a prop will be a common occurrence. And with that, we think it's good to have a little protection on it.
So, Greg, can we go out further along the curve, away from the front end? Let's go all the way to the back end. What's the 30-year doing up near 4%?
Yeah, so the 30-year has different characteristics than the intermediate part of the curve, and definitely the front end part of the curve. What you have in the back end is this very much need for duration. Investors have to go out and hedge, or pension funds and LDI accounts have to be out in the back end of the curve. So there's different characteristics there. So I think the informational content that comes out of the 30-year is a lot less kind of worthy than the intermediate and the front end. So for me, I look at more at the intermediate part of the curve and more in the front end of the curve than I do the 30-year. I mean, it's important, but it's not nearly as important from an informational content standpoint.
Greg, at a time when you do expect this turmoil to continue in Washington, do you consider corporate debt of very highly rated companies to essentially be more creditworthy right now than the U.S. government itself?
Oh, I think that's a tenuous argument. I've heard that argument. That doesn't make a lot of sense to me. That crops up, every several years or so. I really push back on that. So, everything feeds off U.S. Treasuries, U.S. rates. So if the risk-free gets repriced, everything gets repriced off of it. So, hiding out in high-quality credit seems like a fool's errand to me. And you're not going to protect yourself in a way that you think you will be protected.
Do you think that people who are going into credit, in particular riskier credit right now, are also engaging in a fool's errand just simply because of the risk that you're seeing down the line of perhaps some of the defaults or at least the Washington turmoil continuing and this idea of some sort of recession getting priced in to the curve?
Well, if you're definitely going down in quality in credit, you are basically and essentially betting that there will be no recession, there will be a soft landing. And so I think that is, also a kind of a difficult case to make. So to me, there's much more value being up in quality and not going deep down and, deeper cyclical type of companies. So I don't know, being down in quality doesn't make a lot of sense to me. I'm not sure you're getting paid for it either. I think it's too early. Very simple premise. I have yet to see credit spreads tighten into a recession. So if you have a high probability of a recession, you're leaning against that narrative. So I don't know. To me, it's more of a high quality gain. Dispersion is super high, though, so there are lots of relative value opportunities. And we see a lot more value in structured products, as an example, than we do corporate credit.
Greg, can we try and make this really simple just to wrap things up? There were some headlines yesterday about a security that came to market with a yield of 6%, and it has one of those at-risk maturities early next month. Greg, can you explain to people what is the actual risk there? What is the risk there with that security? Because ultimately, surely, doesn't it get paid?
Well, hopefully it gets paid. This is the debate on the table, Jonathan. But the question for an investor is like, why would you actually target yourself for that particular maturity? So, if you do the math around it, it's a much higher yield divided by 365, times 10 days. Is it really worth the risk? So it's somewhat of an anomalous math equation. And so I wouldn't be so worried about the 6% because that's not really what you're going to earn. So, from most investors' perspective, it's just not worth targeting yourself and getting thrown into the potential default pool.
Greg Peters,
and hopefully that doesn't happen.
We all hope that doesn't happen. Greg Peters, a page in fixed income. Thank you, Greg. Appreciate it. Just explaining some of the bond math there, which is important because we flash these headlines, but sometimes they don't mean what it looks like they mean.
This was the 21-day maturity, right? That they came out with a north of 6% yield. I thought this was interesting, too, because how do some financial firms use this as a liquidity instrument if there is that risk baked in, right? So there could be a whole swath of buyers who just can't come to the table at that point.
Oh, it's a whole banking issue. This can get so messy so quickly. A lot of these securities used as collateral. Then if they go into default, what on earth is going on? Can they still be used as that? This can get so messy so quickly. It is unbelievable. And I think we're all just sitting here assuming that it doesn't get messy and it gets dealt with.
Which is the reason why I got to really kind of shrug my shoulders when someone says, well, is the date exactly right? Maybe it's 8 days later, because we don't know. It is lumpy and the risks are pretty high if they misstep and accidentally go into default.
I'm with Greg Peters in that you have to wonder what the government's going to do beyond all this theater and soap opera. Why do we think this is going to go away? We've got a huge amount of debt. Growth is coming in. I get you R* minus G and all that. But I think people are looking at this as a one-off challenge. I don't buy it for a minute.
Oh, not at all. We're going to do this again and again and again. What's clear to me and what's developed over the last however many years is we don't negotiate budgets in Washington. We negotiate budgets through debt ceiling debates.
That's the modern day, yes.
That's how we do it now.
Because it's political suicide if you try to cut benefits on any level ever.
So you have a debt ceiling crisis, and you do it this way. It's not ideal, is it?
No, not ideal.
Not ideal. Oliver Chen's going to drop by from Cowen on the slump in luxury retail. Take a look at the likes of Richemont, the likes of LVMH, Hermes, what's been developing over the last couple of days. That's coming up.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Traders at 5 major banks allegedly colluded in chat rooms to swap sensitive information on UK bonds in the wake of the 2008 financial crisis. Britain's antitrust agency says Citigroup, Deutsche Bank, HSBC Holdings, Morgan Stanley, and Royal Bank of Canada each unlawfully shared details on pricing and trading strategies between 2009 and 2013. The Competition and Markets Authority says HSBC, Morgan Stanley, and Royal Bank of Canada have not admitted any wrongdoing. Many large European banks are emerging from early rounds of a key stress test in robust financial health. That's prompting some regulators to question whether to push harder. The European Banking Authority's assessment is a key exam for lenders because it gives insight into their preparedness to weather shocks and also feeds into their capital requirements. Pakistan is considering banning Imran Khan's political party. That would deepen the already tense standoff between the former premier and the country's government and powerful military. Violence erupted in the country earlier this month when Khan was briefly arrested by the country's graft agency, and some angry protesters attacked military offices and buildings. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
We still need some more time before that excess savings has been worked down to a lower level. We've seen some of the credit card data showing some signs of weakness. You're also seeing on my Bloomberg screen, restaurant performance index also beginning to roll over a bit. So there are some early signs of maybe consumers are beginning to hold back. So yes, there's some early signs of cracks for the U.S. consumer.
Torsten Slog, the chief economist at Apollo Global Management. I'm sure he wasn't talking about the US luxury consumer. There was a conference yesterday in Paris hosted by Morgan Stanley. Some indication coming out of that maybe we've got a softening of demand from the US consumer on some of these aspirational luxury goods. Hermes, LVMH, trading softer in French trading. LVMH was down 5% yesterday, down another 1.9% this morning. TK, a lot of talk about this, not just what's happening in the US, but maybe the China factor in this as well, although I'm not sure how much that's reflected by actual numbers behind some of these names, because demand in their last earnings season looked pretty decent.
I looked at one company where it pulled back to early April maybe, but that's just how on fire it's been. And I don't have any wisdom on this at all, other than to say my theme for the year is governments will step in, corporations will adapt. Those corporations will adapt, John, but I really think the Chinese government will adapt.
Will government start buying LVMH goods, Tom?
I don't know about that, but they always go back to the property portion of the Chinese economy.
Sure, some officials might.
I'm sure, maybe. Although, it's not a really good look for them.
No, that's where we are. Right now we're going to get a brief on this, and there's no one better in New York City to do this than Oliver Chen, senior equity research analyst at Cowen, who's just totally plugged into our aspirations as well. Mr. Arnault has done this 45 times at LVMH. John has mentioned this. John's really followed this story. He brings his sons over to an American icon, Tiffany. And is it right to say they blew it up?
Yeah, it's been tremendous in terms of the innovation there. And luxury is about magic and logic and bringing new, younger customers to the table as well. Tiffany is an iconic brand. The partnerships with Nike, really elevating the assortment. And this flagship is one of the best stores in the world right now in terms of what they're doing. Experiential retail art, this unique experience. LVMH is definitely one of our top ideas. China's about 25% of revenue, so it's quite material, and we're really watching these near-term changes. The mRNA will be important.
You've coined a phrase that I love. It's stealth wealth. And if you know, you know. I can spot Brunello. I can spot the MS Orange poking out of your pocket right now. And then there are branding, the aspirational stuff. The people who line up outside the Gucci stores and they do the buy now, pay later. $50 a month, get whatever you want. Get a hoodie, it's got a big brand in front of it. Lisa and I were talking about this before we came on air. We're trying to work out, has the latter started to crack? Have you noticed that at all? Because we used to see all these lines around these luxury stores. And when you used to speak to people in the store, the consumer was changing. They were moving away from dropping $5,000 on a handbag, and maybe they were thinking about it through a monthly payment. Has that started to fade, started to break in this country?
For sure, John, you bring up a great point. In terms of aspirational, more entry point luxury, logos as well as sunglasses and footwear can be gateways to luxury, and that's been softer. We've seen inventory levels that are too high at Nordstrom, Saks, Neiman Marcus for that reason. At the same time, when you think about stealth wealth, it's about materials, it's about touch and feel, it's about looking great at work too. That's been a trend that's been working too, as the consumers become more cautious and we've seen many shocks.
How much are we really parsing through the K-shaped recovery that we used to talk about that we seem to have forgotten, where basically people with the most spending power are spending it on luxury and able to do so in bulk, and you're seeing the others kind of fall off as the price increases really catch up more broadly in the economy?
We're definitely seeing a consumer discretionary recession in terms of those products and that market as a whole facing negative trends. We're also still seeing shifts where dollars are spent on travel and services, hotels. At the high end, that customer is very strong and robust. So we're still seeing strength at the high end. It's more that area right below the high end, the aspirational, where there's lots of pressure. At the high end, the wealthy consumer always has money. It's more about sentiment and emotions too. Certainly some of the financial shocks have been disturbing in terms of putting that customer on pause. Consumer confidence has been volatile as a whole, so it's definitely something we're watching.
The overlay here of China and what's going on there, is there a sense based on the luxury players that are more exposed to the Chinese consumer and less exposed of where that trend is? Is it falling off? Are people really seeing a shift there?
Well, structurally, long-term, China is the biggest deal in luxury. It's 30% plus of the market, plus even more growth. So great luxury retailers. And Louis Vuitton's the largest market cap company in Europe. So it spends about $10 billion on advertising and promotion, and Tiffany renovation is well over $250 million just here in New York. China will be important for the long term, but it'll be fairly volatile as we watch these issues unfold. The name of the game in luxury is flagship stores, and stores that really make you forget about price. So being there physically is important. As well as a modern, upgraded, rethinking the metaverse, a digital experience that's connected as well.
Are department stores then dead? If I'm at the corner of 57th and 5th Avenue and I'm looking from Tiffany's waving over at Bergdorf, hi, what's the future of Bergdorf? And you mentioned Nordstrom earlier.
Well, Bergdorf is very exciting. It's right there, too, in these magic corners.
Really? I didn't know that.
Bergdorf is an iconic institution. Our recommendation is Macy's. Department stores are not dead, but they're transforming very rapidly and really needing to offer service, differentiated product. They really need to get the younger customer in, and that's been a constant, interesting, epic struggle. We're following Kohl's this morning. The gross margins were better than expected. Back to the basics for retail, as well as inventory management and supply chain, but I teach at Columbia. Don't forget, it's about magic and logic and really bringing things you didn't know existed that you wanted in retail, too.
He's the only one I know on the sell side that could conflate Kohl's and Tiffany. in one conversation.
Throw in Macy's as well. Just quickly, what is it about Macy's that you like?
Inventory management, CFO really focused on it, an agile CEO, rethinking the loyalty program, using data. Artificial intelligence will play a huge role in personalization, the data sets, as we think about the future of retail. And Macy's has a loyal customer, too. Needs a younger customer, for sure.
We're not doing a giveaway on Succession because Farrell's got to watch season 3 and 4, top to bottom.
I've got one episode left.
What's a Succession for Arnaud at LVMH?
Listen, the family is doing a really modern job rethinking brands and captivating a younger customer, elevating brands. It's a company that manages for the very long term.
You didn't answer my question. There's like 3 sons, 2 daughters, the whole thing. What happens in season 3 of the LVMH story?
Well, I think it's going to be intensity, competition, and a real interesting battle for the best of the best. And that's what happens. You really need this competitive spirit to be culturally relevant. Retail's awesome. Luxury's awesome because it's always changing. You got to be in touch with how music is moving, how TV is moving to be relevant.
I hope Mrs. Keena's not watching this.
Love this. Oliver, this is great. Thank you. Oliver Chen-Cowan. Such a stylish dude. Double-breasted suit. Pete Lapel.
He's like iconic.
Just absolutely awesome.
I'm going to just postulate that if he had a meeting at the White House, he would not be wearing casual sneaker shoes, hybrids. I'm just guessing that wouldn't happen.
I've got a word on the hybrids. The hybrid shoe. Is it Cole
I'm kind of in the churches. This is Brooks Brothers, so it's back to the basics, rethinking and double-breasted. Look, fashion's about old and new and bringing traditional mix and matching, but I'm also versatile. I'll do anything.
What do they call the understated thing? Like you on the weekends, the understated thing?
Stealth wealth.
Stealth
That's
wealth.
what Oliver was talking about, yeah.
Materials, craftsmanship. Well, materials and heritage and how something is made, and if it feels great, I mean, cashmere's here forever, yes, and stitching and craftsmanship. So you want that against your skin, for sure.
Beautiful shoe. Beautiful shoe. Half brogue, churches.
British?
British.
It is.
Nottingham.
There's a great tradition of that. So a little painful in the beginning, but it's worth it.
You break them in.
Yeah.
I agree.
I just would kill to get at a larger desk Oliver Chen, Michael Burke, who ran Bergdorf's for years,
and Antoine
and the great Vanessa Friedman of the New York Times.
Yeah, that would
all in together, bring in from London. About it, he takes it so seriously. I mean,
as he should.
As he should. It's a multi-billion-dollar business.
What do you do if you put a sweatshirt in the dryer and shrink it?
Oh,
I mean,
you asked about this before. It really depends on the material, but I've done it a few times, and sometimes you want to shrink it. And sometimes you don't, but most of the time
it's not the style.
Have you seen Lagerfeld?
Sometimes one wants to shrink it, and one doesn't want to shrink it.
He reinvented, rethinking a real stature in the industry.
Yeah, okay.
I think we're done, aren't we? We are. Okay, good. Oliver, thank you.
Thank you.
We're out of time.
I've been ordered to go see Lagerfeld at the Met.
Have you?
Yeah, I've been ordered.
Okay.
It's spectacular. It's supposed to be spectacular.
Cool.
Spectacular.
Liz Younger, SoFi, up next. On the market, not on fashion.
On the market.
Equities on the S&P 500, negative 0.4%. Debt ceiling talks will resume between negotiators on both sides of the debate down in Washington, D.C. a little bit later today.
New York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a 6-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So $1 there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. it's not always just about dollars and cents.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think investors certainly have worked themselves up into a frenzy.
The capital markets are open. Companies are moving forward.
The signal and the noise are incredibly difficult to parse.
Narrow breath is not a precursor for doom and gloom.
It is coming. No one should doubt that a recession is on the horizon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Debt ceiling headlines coming out by the every 10 minutes. We'll give you an update on this, but far more importantly, what do you do in the market as you stagger to June and into the rest of 2023? We'll look at that here immediately. Futures, John, negative 17. There's like 8 cross currents today.
I can tell you, Tom, there are people itching to put capital to work who have missed out on this rally year today on the S&P 500, on the NASDAQ. Stuart Kaiser of Citi, I think, nailed it in his note yesterday evening, so I'll quote him directly. The story is that the Fed will pause, money will move back into equities, and underweight and or defensive positions will be pressured to the upside, i.e., a FOMO trade will fuel a breakout and a rotation trade. There are people itching, Tom, to play that rotation because they do not believe in what has performed so well year to date, and that is big tech.
And the arch question is, earlier in the week, the Bears, rode over the weekend and reset where they are. There's a huge divide here. I mean, the VIX, yes, is backed up 15 back to the near 20 level, 19.64, but what a tension right now.
Well, take your pick. Mike Wilson, Morgan Stanley, mentioned him a few times. Mike's come out and said, look at the narrow breadth. Look at the leadership. It's all just a handful of names. Big tech. Savita Subramaniam sat over there, Bank of America, said that's a false negative. She thinks the equity market can keep going higher. But Savita adds an extra level of detail. She likes the equal weight S&P. She likes the idea of playing the cyclicals. Playing the cyclicals at the same time everyone's talking about what? The potential for recession. That just gives you an idea of the tension out there. The tension out there.
Range of views. Voya talking, Barbara from Voya the other day talking about Buy American and really lose the international story. To me, Lisa, what we heard, I think in the last hour, maybe 70 minutes ago, is the idea of still an elevated savings rate. We depleted our pandemic savings, and it's built back up. And we're going to talk to Liz Story about this. What's the firepower right now that John alluded to in the opening?
the uncertainty here is the reason why you have on one side Savita Subramanian, and then on the other side you have Daryl Cronk, who earlier said, don't get sucked in right before your face gets ripped off. And basically that's what he was saying at a time when this is what happens pretty much by the textbook ahead of recession. So at what point are we looking at a this time is different kind of moment with the crosswinds of tech and the rest of the universe that haven't done as well?
I'm going to Segui right now and conflate two ideas. John, I see the 30-year bank rate mortgage break out to a new high. Today, we went 7.04, 7.03 out to 7.06, not out to a recovery high of like a 7.1, whatever. And Ira Jersey and his team, Anthony Feld Publishing, they're watching the U.S. real yield breaking through resistance is their language. And could you see this yield structure come up, as Greg Peters alluded to earlier?
The fact that we haven't touched on in a big way is something you mentioned, alluded to moments ago. The international story. That's front and center this morning. These consensus trades have been breaking down a little bit. Seen it in FX, short dollar trade, gets long now, stronger dollar, euro dollar breaking down. Copper, that's broke below 8K. Luxury names, something like 30% year to date, showing some weakness in Europe. Some doubts about demand in the United States yesterday at a conference hosted by Morgan Stanley, and some doubts about demand coming out of China. The China demand, I think, disappointing at the epicenter of the breakdown of some of these calls, Tom. And pushing that through foreign exchanges meant a stronger dollar.
Let's get the data started this morning, 19.67. We've backed up a little bit. I'm going to use the phrase little bit, from a 15 VIX back to near 20.
Equity's a bit softer. Negative yesterday, biggest one-day drop in about 3 weeks. We add to it, take away some more weight, take another bite out of the year-to-date gain on the S&P 500, negative 0.4%. Yields in a bit as well. We've had 8 days or something like that. The front end of yields just higher, up, and away. 10-year back down, Tom, to about 366.51.
What's great about Liz Young is she writes these brutally direct notes as head of investment strategy at SoFi. She loses the ratio mumbo-jumbo and talks about the mood and emotion that's out there. You're speaking of housing, Liz, but I think just talking to Oliver Chen of Cowen about the persistence of luxury, I'm going to steal a phrase from you. We're in a milieu of bulletproof demand. We just keep seeming to continue to prosper here amid all the gloom. How do you see that?
Well, I think there's a difference between the demand that we're still seeing from certain sets of consumers, and especially in the housing market, in the face of rising mortgage rates again, mortgage rates that are higher than they've been in 40 years. And there just continues to be this appetite to spend. I think when you look at what's happening signal-wise, both in the economy and in many parts of the market, this is pretty classic late cycle behavior. The challenging part for many investors, myself included, is that late cycle can last a very, very long time. It can last up to 18 months, maybe even longer. So we could continue to say it's clear that we're in late cycle. At some point, there's probably a contraction to bring us back into early cycle that would soften that demand. But could it be another 6 months? Perhaps. And I think that's the frustrating part in the meantime, to try to make money in the market.
John, brain freeze, surveillance correction. Liz Young is with us, and I was thinking of the day I first heard Liz Story, the piano player, when she fell on the scene of singer-songwriter.
I don't know Liz Story.
Liz Story was
What's Liz Story like?
Spectacular.
She's good?
Spectacular voicings.
Was she as good on the piano as Liz Young is at the
And
market?
Liz Young on piano is a sight to behold.
I don't
Excuse
play the
me,
piano.
Liz.
That
I
would
am
be-
so
that would be
sorry.
something.
Well, Liz, you said something I want to pick up on, this idea that late cycle can last a very long time. How do you know when you're getting to the end of a late cycle that can last for 18 months?
Well, it's difficult to know exactly what those signals are. I think if we all knew exactly what it was supposed to look like right before a recession came, we'd not have all of this consternation about what's happening. One of the things that I watch, and I continue to watch this every single day, is the yield curve inversion. Now, we know that the inversion itself, especially at the 2s, 10s, is more of a signal pre-recession or a warning sign of, hey, there could be some bumps ahead. We don't know when, we don't know how big. And then you hear that old adage of, the yield curve has predicted 9 of the last 5 recessions or something. So it's not a foolproof indicator, but when that inversion starts to re-steepen, meaning the inversion becomes more shallow, that tends to be the time when your ears should perk up and you start to listen for indicators that the Fed may pause, the Fed may have to cut. And that's what we're looking at in the market right now. The market still believes that the Fed is going to have to cut before the end of the year. The Fed holding steady and saying that absolutely not. We are not talking about that yet. Also, their own projections of inflation are still above target, both at a core and a headline level by the end of this year. So if things go the way that they expect, no cuts on the horizon in 2023, the market is sending a different signal saying, hey, we think that things could weaken. It's possible that we see cuts. So when you start to see those yield curve inversions get more shallow, you start to see the expectation that the Fed may have to pivot, may have to change policy at some point in the next 12 to 18 months. That's usually the time when you feel like the clock is really ticking on when we're going to find out whether or not this recession actually occurs.
Given that the music is still playing, do you play? Do you invest in stocks? I mean, are you basically in the Savita Subramanian camp and not on the Darryl Cronk camp of staying cautious amid an end cycle that could last for another year?
I'm cautious on the market, and I admit I did not see this rally in tech stocks coming this year. I mean, up 20 to 26%, depending on what part of the NASDAQ you're looking at, is pretty astonishing. But if you're a long-term investor, and this constantly is a theme that I think everybody should think about, if you're a long-term investor, you should be invested in stocks on some level at all times, because there's really no other place to generate capital growth in that way. However, if you're a long-term investor that doesn't have a stomach for volatility in the short term, you do have to position defensively in this environment, especially at a time when we've got yields back up again. I know that you talked about that earlier in the program. As yields rise again in this environment, valuations really do matter, and you're paying a lot for some of those names that have done really well so far in 2023. So if you're not somebody that has a ton of stomach for short-term volatility, and when I say short-term, I mean 6 months or less, then you have to have defensive positions in the portfolio. But if you're a long-term investor, let's say beyond 3 to 5 years, you do still have to have equities.
Hey, Liz, thank you. Liz Young there of SoFi on the market and some of those top-performing names. One of those names, Meta. Reuters just reporting that Facebook has started carrying out the last batch of a 3-part round of layoffs on Wednesday, today. This according to a source familiar with the matter as part of a plan announced in March to eliminate 10,000 roles. That directly from Reuters just now, Tom. So the final round, the last batch of a 3-part effort to reduce headcount.
End of March, 77,000 employees. And I guess the tone I get here, and this is from Bloomberg Technology and Ed Ludlow, is are the managers, the founders of these companies, all the people that get the media, are they feeling successful with these layoffs? Are they feeling not happy about it? No one's happy about layoffs. I don't mean to make light of it, but they're like, oh, these has uncommon benefits, uncommon effects. That would be a new religion.
Depends how you judge success. If you're an investor, then I imagine you see this as successful. One of those laid off? Of course not. Facebook has ripped this year. I mean, a monster wave. You go back to late last year.
Edge of NVIDIA, right?
Right up there.
Yeah.
Late last year, we were talking about the metaverse and throwing money at it and being wasteful. Things bottomed, and it's just ripped ever since.
There's a question longer term about what this means for the tech universe's ability to attract the best and the brightest. And I say this because there was a story that came out about how more college graduates who are at the highest end are now reconsidering finance jobs rather than tech jobs because of all of these layoffs and because of the certainty that in finance, you work hard, you do well, you get paid. In the tech world, it's getting more fuzzy, especially with some of these layoffs that are much more high profile. So again, just from a recruitment standpoint, what do some of these cutbacks do?
Look at that move, 105%.
Yeah.
Look at that move. Just unbelievable. Just note on the White House, GOP negotiations, just confirming the White House and Republican negotiators are set to resume debt limit talks later on this morning, according to a person familiar with the matter. Another political event worth watching a little bit later, Governor DeSantis of Florida sitting down with David Sachs, Elon Musk on Twitter. Really interesting piece just out on Axios, Tom, on Elon Musk displacing Rupert Murdoch and Fox News as the king of conservative media in the last few weeks.
I wonder if the kid that tracks the airlines is going to have a joint tracking of the DeSantis and Musk airline.
Following the planes?
Following the planes into Miami.
Is that still happening on Twitter, or is that stopped?
I think I'm guessing it's still
What happened to Jet TV? Big Jet TV.
Watched it the other day.
Did you?
It's fabulous.
Did you? Is it still
I
good?
actually signed up as a...
Oh, you're a subscriber.
I'm like a charter
have you
member.
Have you expensed that?
Yes. Red Oak, keeper of the Amex, thank you. I did expense that. It's very important. And it was great. It was Heathrow with a lot of wind.
Okay.
It was scary.
I know. Mike Dowder of MKM Partners is coming up a little bit later from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Nouriel Roubini is warning that talks to avoid a U.S. default could drag on, with a failure to agree on a debt ceiling likely to hit markets and damage confidence in the dollar. In an exclusive conversation with Bloomberg's Francine Lacqua at the Qatar Economic Forum in Doha, Roubini also said he believes the U.S. and China are headed down a path of confrontation after a G7 summit in Japan.
After the G7 Hiroshima summit, I would say there's not going to be any thaw between U.S. and China. The Chinese reaction to this G7 summit is that European, U.S. and Japan and others are ganging up against China. So this Cold War between U.S. and China is going to get colder.
Roubini singled out the threat of a geopolitical depression among the biggest risks facing markets, pointing to the fallout of Russia's invasion of Ukraine and the possibility of escalation between Iran and Israel. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
At the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg. The moment news breaks, no one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The debt ceiling deadline closes
Back and forth on the debt ceiling debate.
Kevin McCarthy says it's going to be on the floor next week.
Keep it tuned to Bloomberg for up-to-the-minute reporting.
Movement from the White House walked out of this meeting saying the White House was being unreasonable.
And first-hand analysis from the political and business leaders who matter.
The debt ceiling is potentially catastrophic.
We will not pass a clean debt ceiling.
They should just simply do their job.
Both political parties are guilty.
For continuing coverage of the debt ceiling standoff, keep it tuned to Bloomberg, your global business authority.
We'll be interviewing Ron DeSantis, and he has quite an announcement to make. And it'll be the first time that something like this is happening on social media, and with real-time questions and answers, not scripted. So it's going to be live, and let her rip. Let's see what happens.
Let her rip. We'll see what happens. Exciting stuff. Looking forward to this a little bit later on this afternoon, this evening, 6 p.m. Eastern Time. Elon Musk, the Twitter CEO, amongst other things. SpaceX, Tesla, sitting down. David Sachs, Governor DeSantis coming up later.
Team coverage on balance of power.
Very cool.
I mean, it'll be
looking forward to
right
this,
in the
Tom.
thick of it.
Genuinely.
Yeah, absolutely, right into the thick of it. John, let's do a quick data check here, just because I think the markets are moving. I'm going to go back to renminbi, which we've underplayed here. We're rounded up to a 7.05. Getting to 7 was a huge deal in weaker renminbi just in 48 hours.
I'm with you. Look out, dollar strength has been building over the last couple of weeks. The euro breaking down to about 107.50 earlier on. Looking at it now, just a turnaround in the last, I'd say, 45 minutes or so. That currency pair now positive on the session from 107.50 back up to 107.85. And yields, Tom, retracing some of the move higher that we've seen over the last 1 week plus. You're seeing yields come back down by a couple of basis points, 366.71.
Two big stories here to talk to Jim Lucier about. Senior political analyst at Capital Alpha Partners barely describes the decades of experience. We've got the theater in Florida. We've got the theater in Washington. Jim, in your research note, which I thought was a really calming note, you talk about 3 subsets: the people that will bless this, the blessed, the people that will say the deal is acceptable, and I would suggest I'd add the furious as well. Who's going to win out here in the next 10 days among the blessed, the acceptable, and the furious to move on from this crisis?
I think the blessed and the acceptable are going to outnumber the furious. If you look at the way these negotiations proceeded, they've gone from hell no, we're not budging, to what kind of freeze do you want, to okay, who's going to deliver the votes for this? So I think that despite what you see on television about a standoff, they're actually fairly close.
James, I've got to turn to what's going to take place a little bit later on this afternoon. This talk on Twitter for Governor DeSantis, what do you make of this as a first step potentially towards a run for the big role in the White House?
Well, I think it's an unlikely match of personalities. The thing about Ron DeSantis is he's not exactly the most warm and fuzzy guy out there, even though he is a terrific administrator and terrific governor, terrific giver of press conferences. To have an unscripted moment with Elon Musk suggests that either he's prepared to roll the dice and try something very different, or else he just doesn't know what he's in for.
Do you think the first steps are important, or do you think in a couple of months' time we'll forget this?
I think that in a couple of months' time we'll forget this. We have forgotten Elon Musk throwing the iron ball through the window of the Tesla truck. We've already forgotten the stealth video in which President Biden announced his re-election campaign early in the morning 2 or 3 weeks ago. I don't think the announcement makes that big a deal, but it is important as we go into Memorial Day that we start that 1-year countdown to the presidential campaign beginning in earnest, which is really going to be next Memorial Day.
How interesting is it to you, James, that Twitter, a social media platform, is not so much tiptoeing as in, screaming, running into the whole media kind of sphere in Elon Musk hosting this conversation? I mean, what is the distinction at this point between social media? And from a regulator standpoint, does this muddy the waters?
Well, Elon Musk likes to say that Twitter is the app for everything. And how do you better prove that you're the app for everything than by entertaining Tucker Carlson? So he's demonstrating you can do a lot of things on Twitter. I think Elon has a great commercial incentive to show that Twitter's a very effective platform, right up there with Amazon or Netflix. I'm not sure the regulators know how to do this yet. The regulators are fighting a retroactive war, I think, battling bigness, trying to fight bigness by breaking up and deterring large mergers. But I think Elon is far ahead of them at this point.
Well, and to that point, James, I mean, to John's point earlier, he was saying some are speculating that Twitter and Elon Musk is becoming the main competitor to Fox in sort of this alternative conservative universe, especially if you have Tucker Carlson launching his own Twitter space or Twitter platform. And you also have sort of initiation of Ron DeSantis' campaign all on the same site.
Well, you've got no shortage of people who've tried to launch alternative platforms. For instance, there's Glenn Beck. Megyn Kelly has her podcast. I guess O'Reilly is still out there. What's happening, though, is that as you see conservative media moving into this new video platform with Twitter, the old form, the AM media, the AM radio that was the home turf of Rush Limbaugh, that is slowly dying off. So in other words, the old forest is dying and the forest animals are looking for a new environment.
Jim, you got such a study of history on this. I'm going to go back to the legit World War II hero, Robert Dole of Kansas. He'd be 100 here in July. Senator Dole ran for president, came out of Kansas in the Midwest, and really never related with the American public. Translate that over to the governor of Florida. How does he come out of Florida, where he won big, and translate over to a Republican and independent America?
Well, Bob Dole was a marvelously funny, warm, and empathetic guy. Everybody who knew him in person loved him. He was famous for cracking jokes nonstop in the Senate cloakroom. He was famous after he retired for sending donuts to the cloakroom every day. You know, the memory of Bob Dole is just incredible in that way. But he did have, I think, a bit of awkwardness with large audiences. DeSantis, though, nobody's ever really said that DeSantis is warm and fuzzy in that way. They're impressed with his smarts. They're impressed with his ability to lead as a former military officer. They're impressed with lots of things about him. But you don't hear people talking about DeSantis inspiring the deep personal loyalty among his constituents, among his base, among friends that Bob Dole certainly did. I knew Bob Dole. My father knew Bob Dole very well.
James, wonderful to get your perspective on things, particularly with that in mind. James Lucia there of Capital Alpha Partners. This is something that's been coming up with Governor DeSantis.
It's a huge deal.
He's very sharp, really well educated, deeply intelligent. If you ever see him operate a news conference, which is what James was alluding to there, if you slip up, if you haven't researched, he's going to take you down really, really quickly. He's the kind of guy that you'd sit in front of for an interview, and you'd have to be really, really well researched, really well prepared. But as for the charisma, the humor that you might get from someone like the former President Donald Trump, there's a big question mark over that at the moment, and we'll see whether he can be engaging a little bit later.
It's 8:24 a.m. Wall Street time. Joe Matthew's still in bed. I mean, but Matthew's going to eat this up on Balance of Power tonight, because for the Republican and then the movement over from a smaller Republican Party to the broader independents, including the suburban independents, how will he attach to them? And I have no clue.
And how will he deal with the former President Trump, who has such a loyal following? Will he go after him? Will he mention him? Will he try to get... Well, but that becomes really tricky, because how do you lure people over to you who have complete, conviction in the former president and who are, really...
VP candidate?
Oh, I doubt it.
Trump DeSantis?
At the moment, based on this?
No.
This will get pretty nasty going into the primaries.
I agree.
But things change so quickly. Do you remember Edwards in the race with Clinton and Obama? Yes. Do you remember that? And at the time, people were like, yeah, this guy. And then it was like, no. And I remember in the race with, I think it was McCain-Obama going into 2008, and it was all McCain, then financial crisis, economics, and all of a sudden, things change. And look, it's way, way too long. 18 months still to go. I'm not sure those polls right now count for a great deal. That's more about who do you know now, who would you vote for? Let's see what Governor DeSantis does in the coming months.
I'm more interested to see how the messages get shaped. Are they going to go after social issues? Is it going to be economic? How are really the messages going to form as they try to attract certain constituents?
12 months later, we'll be having very different conversations. You sort of like clip the news after this later on this evening. Take the news clips and compare them to what they're saying in about a year. It could be totally different.
As I've said before, John, you guys do it better.
Because it's shorter.
That's all I gotta say.
Because it's shorter. From New York City, this is Bloomberg.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Bloomberg Surveillance. Good morning, everyone. Michael Darter coming up in a moment with MKM Roth. Really looking forward to talking to him about the path forward, linking economics. And the markets, futures negative 14, Dow futures negative 96, the VIX up near 20, 19.52. We're watching a plethora. What are you watching today? What's a single thing you're watching, Lisa?
Honestly, probably euro dollar. That's actually the most interesting thing to me today, given the fact that we did see that break, and that would upend a lot of the trading that we've seen so far this year with this idea of a weaker dollar and strength elsewhere in the world.
What I'm watching is a time to get up from the surveillance nap this afternoon to get to the minutes that we will see. Michael McKee. Usually we tie McKee right to 83001 because he's got breaking news. This morning he breaks out the minutes. Several. Are they going to talk about pause and skip Michael McKee and the minutes?
Well, that's what everybody on Wall Street wants to know, Tom. Do they talk about a pause? Do they talk about the possibility that they might raise rates again? Because we've certainly heard from a number of Fed officials that they are leaning in that direction. And, you know, this morning Fed Fund futures now have the odds of another rate increase by July, up about 50% or so. So they'll be looking for a lot of clues in it. The trouble is, as always, it's 3 weeks old.
And this also comes at a time where there's increasing dispersion among Fed members. How much do you expect to hear that reflected in these meeting minutes? Just how much, perhaps not headline dissent, but under the radar dissent there really is?
I think that'll be a key thing to look for, Lisa, because minutes won't tell us who. We have names now from their speeches, but we'll see how many people, the references Tom was making, many, several, few, how many were arguing against the idea that inflation is going to come down very rapidly and that the Fed has moved into restrictive enough territory.
What data are you watching to really understand the new tea leaf for forward-looking, not backward-looking information for the Fed?
Well, we're obviously going to be looking at the price indexes, and we do get that tomorrow, the PCE index. It's hard to separate out a lot of this stuff from the noise because things do go up and down. But you look at what happened in the United Kingdom today with the prices going up much more than people anticipated in the core. And that was largely services. And so we're going to keep an eye on service price inflation. And that's what the Fed has been worried about. So the ISM non-services number is going to be ISM services, rather, non-manufacturing number is going to be something that you want to pay attention to going forward.
Michael, thank you so much. Michael McKee in Washington awaiting some and several minutes to come out here at the 2 p.m. Level. This is a personal note for me. Breaking now, Jenny Surain for Bloomberg writing here on Citigroup. Long ago and far away, Lisa, I was wrapped up in this directly. I had family members working for Banamex in Mexico, and they had the modest issue of an earthquake in Mexico City, and it was really something to see. Citigroup is still involved in a bank in Mexico, number 2 bank there, that they really, really want to unload. Jane Fraser has said, we got to dump this thing. They spent a year negotiating for its sale, and here's a bombshell from Jenny Surain this morning.
Yeah, basically saying that they are not going to attempt to sell this particular unit, instead holding an IPO in 2025. This, Jane Fraser said in the statement, we concluded the optimal path to maximizing the value of Banamex for our shareholders and advancing our goal to simplify our firm is to pivot from our dual path approach to focus solely on the IPO of the business. How much, Tom, is this just pushing it out because valuations aren't very good right now, pushing out to 2025 without having to ice it completely?
I'm going to let our team nail this over the coming days into a red herring where we really figure out how you value this thing. But again, this comes down to all banks aren't the same. We look at Fortress Diamond with a price to book of 1.45 on the Bloomberg. Citigroup is 1/3 of that, just under 0.50. I can't say enough how we conflate. I'm as guilty of this, folks, as anyone. We conflate these banks together, and that is absolutely wrong.
Banamex has 38,000 staff employees, and their art collection is one of the largest collections of Mexican art in the world.
Sure.
And that will remain a part of the unit. So just if you think about the valuations and the idiosyncrasy of some of these firms.
The heritage of Mr. Riston and Mr. Reed back years and years, and others at Citigroup. And this is a big deal, folks, worth watching. I'm sure our Sonali Basak will be all over this through the day. Right now, we digress to Michael Darda, Chief Economist, Macro Strategist, Roth MKM Partners. Michael, I want to look at the sum of the parts now, the cacophony that's out there, maybe to get beyond the debt ceiling. And let me just start as a center tendency. Can you acquire shares this morning? Do you want to, with your economic analysis, be in the market?
I think investors should be a bit cautious here, Tom. We have pretty high valuations in the equity market. The S&P 500 this year has been driven by a handful of mostly growth stocks with high valuations. So the S&P 500 Infotech Index is above 6 times sales, which prior to this cycle was only seen in 1999-2000. And even if you're looking at a forward PE for the infotech sector, 25 times isn't far away from the 28 times peak in 2021 that preceded a more than 30% collapse. And because interest rates are higher now, the 10-year Treasury yield, the stock to bond valuation metrics look even worse. So this is an environment, I think, where we're getting close to a recession. Obviously, you all have been talking about the debt ceiling shenanigans that are going on, and you have high stock market valuations at the same time. So in my mind here, it makes sense to be a bit more cautious.
People have been cautious for about a year, and they're getting very tired of being cautious. We keep hearing that. They're sick of waiting. They want to start investing. They have cash. They want to put it to work. How do you push back against this and say that's not enough of a technical driver, that's not enough of some sort of force to get stocks higher from here?
Yeah, I think it comes down to, are you being compensated to take that risk? And with the short end of the Treasury curve up at current levels, 5% plus, almost 6% recently on the 1-month T-bill, you're getting paid to wait. You're getting paid to be cautious. You're getting paid to hoard instead of spend or invest. And that's exactly what the Federal Reserve wants to do in order to vanquish inflation and reduce aggregate demand. And I think that is working, but the consequence could be a recession and a continuation of the equity bear market. It's been a very narrow market. If you just look at the S&P 500, it's done quite well this year, but it's, the breadth, the advanced decline line, if you look at that for the NASDAQ, record lows with valuations at quite high levels. It is just not a healthy development if you want to be a confident buyer of risk assets.
And we hear that debate from day to day, just in terms of what that narrow breadth really means, Mike. On a broader level, though, your expertise lies with the question that everybody wants to know. When will people stop spending so much on services? Will that happen? Or will we see just that, expenditures just completely bolster economic growth? Are we truly seeing softening in eating out, in flying around the world, in the experience side of our economy?
Yeah, it's a great question. The service sector has been quite robust. And, you're talking about 2/3 of spending and 4/5 of jobs and income. So it really is the vast majority of the U.S. economy. And so that's really what matters, whether we're going to fall into recession or not. But it doesn't move first. The service sector tends to lag at turning points, and I think we've had a big head of steam here in services industries that could come to a sudden stop and surprise people. We're obviously not quite there yet, but let's see what happens as we move further into the summer and the fall. We've had some very successful recession indicators flashing red for quite some time. So, you guys have covered the yield curve inversion. We're 10 months into a yield curve inversion. Money growth has collapsed at historic rates. And so thinking about the timing there, what's typical in a business cycle is really 12 to 14 months after those signals start to flash, and that would put us right into the summer or fall. So yes, we're resilient on the services sector for now, but that could change fairly quickly in the months ahead.
Michael, in your research note for Roth MKM, you really focus on the high-frequency claims data. You do a rate of change study there. So I want you to discuss what claims is telling you now, but then I want you to bring the claims study, and I want to link it into, say, Irving Fisher 101, a Fisherian analysis of if we finally get labor to pop to a greater unemployment, link that into the interest rate dynamic, the inflation rate dynamic, and then on to the market.
Absolutely, Tom. So if we look at continuing jobless claims, those are people that are filing over and over again for unemployment insurance. That number is up 25% year over year. And if you look at the whole history of the series on a weekly basis, we've never risen more than about 9-10% year over year without a recession occurring. Typically you're either in the early part of it or a couple months away, without any exceptions to the rule. And first-time claims are now picking up as well, but that series is actually a little bit more noisy. So what that tells me is, on a rate of change basis, all of these macro variables that have been super robust are slowing down from nominal GDP to jobs. Now, what does this mean to your question in terms of Irving Fisher and the neutral interest rate in the Federal Reserve? We have a problem here with a boom and bust cycle. So the Fed, the first mistake was putting a lot of inertia into the policy rate. There was a tremendous amount of monetary and fiscal stimulus. And then the Fed did not react to a super rapid V-shaped recovery, and they fell way behind the curve. When they did start to react, then they had to move much more aggressively than anticipated. And now, some of the indicators we've been talking about suggest that we're well into overreaction here, where the Fed has now gotten into a restrictive stance. If there's inertia in the funds rate again as the economy tips into recession, that's how you get a deep downturn. So boom to bust, and then question mark in terms of what follows.
Okay, this is really important, folks. We're talking to Michael Daugherty here about the meat and potatoes of what's going on. James Tobin of Yale and Milton Friedman of Chicago worshipped Irving Fisher. They couldn't have been farther apart in economics. And what Fisher was talking about in the 20s and 30s is what you can't see out there. What's the mystery for you right now, Michael Daugherty, when you give a Fisherian treatment to finally unemployment goes up?
Yeah, once that happens, Tom, then we know we're in it, right? If you look at the unemployment rate, once it starts to move, it doesn't have to move that much. It's only about a half percentage point from year earlier levels. When you see that, the recession has started. Usually you're, a month or a couple months into a recession. Right. And that will tell us for sure that the Fed has gotten the policy rate above neutral. But prior to that, it's guesswork. It's estimates. And that's how we use the yield curve and money growth and claims and some of these other indicators.
What a treatise. Michael Daugherty, thank you so much. Lisa, that's like goosebumps. I mean, that's like when you say to yourself, how do we get to Labor Day? Those are the linkages if claims continue to elevate.
Which is a reason why tomorrow will be interesting, even though it is just frequent data that we get out every 8:30.
The minutes this afternoon will be interesting as well at 2 p.m. as well. This is Bloomberg Futures at -17. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The governor of Russia's Belgorod region is reporting what he says was a large number of drone attacks overnight, causing damage to buildings, though he said most were intercepted by air defenses. He said repairs to gas, electricity, and water services were taking place following the border incursion by attackers who crossed from Ukraine. And he said more than 500 people fled their homes during the fighting. Citigroup is abandoning its attempt to sell Banamex and will instead hold an initial public offering for its Mexican unit in 2025. The company says the decision allows it to restart stock buybacks this quarter. Citigroup had been holding off on share repurchases because the sale was expected to temporarily hurt capital levels. The bank was unable to reach a deal with Banamex despite more than a year of talks with a long list of suitors. In the UK, the push to return to the office stalled in 2023. New research from the Centre for Cities found London employees were in their offices less than half of the week in April, about 2.3 days down from 3.9 days before the COVID pandemic. Older workers are leading a shift toward remote jobs, which the group says risks stunting the development of young staff and hurting city centers. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Still releasing that pent-up demand, and from the pandemic, there's built-up savings which are still being unleashed as well. But crucially, labour markets, they are strengthening, and I think Europe is starting to realise this could be pro-cyclical. You give people higher wages, they start to spend, they generate new jobs, new economies, which begets further wage gains. But that is self-sustaining. I think that's healthy for the likes of Germany over the medium to longer term.
Jeffrey Yu of BNY Mellon, brilliant there, and also on China as well. It's a China with a weaker renminbi and a lot of doubt about the China recovery today. Renminbi out to 7.05 yuan per dollar. What the show is about is a guess. That's all it's about, ever has been. And to have Michael Darda on, that was absolutely brilliant, linking it into Irving Fisher from decades ago. And to go from Michael Darda into Paul Sankey, founder and lead analyst, Sankey Research, iconic at Deutsche Bank years ago and other shops along the way. To have Paul in our studios, Lisa, is great. And of course, the reason we booked this is I went back to Amy and I said, who had the worst call to Memorial Day? And Amy, she didn't even have to look at the surveillance. She didn't even look at the surveillance Rolodex. Folks, this is what it's about. Okay, Sankey has to go from $78 to $100 a barrel, and he's got like 3 or 8 days to do it.
And Paul Sankey is walking out right now, and he's not going to be joining us anymore. No, I'm kidding. Paul, thank you so much for joining us, you and everybody else. Let's be honest. A lot of people thought that oil prices were going to go a lot higher, and here we are at $74 a barrel on WTI from a high of 122 if you go back to June of last year.
Right.
What's been the main disrupting feature here?
Yeah, I mean, if you look back at your chart there, we hit a low of 71 in December 22. We got all the way down to 71, and we really haven't done anything since that. And so there were three things, basically. Winter came in warm. We couldn't call that. It's probably smart to call for warmer winters, but there was always the shot. And we certainly had a very cold late December, so it looked like it could be a big deal. It wasn't. The second thing is clearly that Russia has continued to export oil. So while Russia production may be down, the exports have kept coming, and I think they will, actually, as long as the Russians can maintain the exports, they will. So production could be falling, but we could still see relatively high, much higher than expected Russian oil exports. And then finally, China, as you know, the recovery has been service-led. So there's been weakness, relative weakness. I mean, it's growing, but not growing much in the industrial side of the economy. And the jet fuel side of the China argument has worked, but the industrial side hasn't really showed up. So those are the big things. And then just to throw in there that the SPR has become irrelevant. So that's been a bit of a help. We haven't had the million barrel a day drawdown that we had last year at times. But it's become a non-event because the rebuild that they've talked about is relatively tiny.
And it's going to begin later. I don't think it's even begun yet, right? I believe it's going to start in August. Yeah. We're looking right now also, though, at a scenario where Saudi Arabia is getting a little concerned about how low prices are, right? And they're starting to push back a little bit in the idea of OPEC maybe challenging pricing where it is with another production cut. How much does that factor into your calculus?
Well, they've been crying wolf a bit, right? I mean, this is the third time that they've tried to squeeze speculators. And frankly, I don't know why they're so obsessed with speculators. I mean, you can squeeze speculators on a short-term basis, but the real problem is the overall oil balance, right? Speculation waxes and wanes. It's not a fundamental argument. So while speculation is very low, extremely low right now in terms of speculative longs, you see the Saudi oil minister coming out this week saying, we're going to squeeze you again. The real issue is, can the Saudis corral Russia? And Russia's a threat to Saudi, right? Because what Russia's doing is it's sending its oil to Asia, and it's cutting the traditional long-term Saudi premium for selling oil to Asia. So there's a much bigger deal than people appreciate between Russia and Saudi here in terms of market share and competition. And that's an awkward conversation because while we know that there's a good relationship between MBS, last time we checked, and Putin, it's not so obvious there's a good relationship between the Russian oil minister and the Saudi oil minister at all. So we'll see how this plays out because, as you know, next week we have an OPEC meeting. What they say, and I was in the room in Vienna in October when they announced the 2 million barrel a day cut, everyone was agape that you would be cutting at such a time, and guys like me were calling for $120 oil by Memorial Day. Those cuts never showed up. They never showed up from Russia. They never showed up from Saudi.
I want to go domestic with you here, and I'm going to think of Ben Dell at Sanford Bernstein while you and Adam are working at Deutsche Bank on the cost of getting the barrel out of the ground. And you say it's $50 to deliver a barrel right now, the lifting cost. It's just there's a certain expense to getting this done. And I want to bring it over to an actual oil company, say Occidental Petroleum, which I believe you've got an affinity for. I am thunderstruck how they've not deployed their burgeoning free cash flow to shareholders. Am I wrong on that?
Well, they've got to pay down debt first, right? I mean, Oxy's just had a higher debt burden, but the free cash flow has been going to debt pay down. But you've seen other companies probably over-return. I mean, we've had companies, the major E&Ps such as Devon and Pioneer, have paid specials through the peak environment. Is that a new permanent
fixture? Are they like the airline industry where they finally have permanent religion?
I believe they do. I believe they do now realize. And I was actually with the CEO of Valero yesterday, and, that industry changed. That industry used to spend money for growth. We were mocking him for the previous CEO's spending acquisition tendency, Bill Clessy as in charge of Valero. Joe Gorder came in at Valero and pretty much doubled the dividend immediately and has maintained a very high cash return strategy. So we've seen the refiners change and then maintain, and it took a long time. It took another decade until really COVID before the US E&Ps got the memo, and I now think they've got it. They would have to be stupid to change tack.
Well, they've been stupid before. I mean, there's been, I look at the drilling, and you wonder where they deployed all that capital to. Help me with Europe versus U.S. big oil. Which is the best 3 to 5 year total return?
The problem with European oils is that naturally European investors are overweight European oils, so they can't move those stocks. Everyone in the UK, Europe has as much oil as they want, so you need US buyers of those stocks in order to make them work. And US buyers, I can't persuade US buyers to buy US oils right now. And of course, you have a tremendous range of US oils. You know, you can buy Schlumberger, you can buy Valero, you can buy Exxon. Why would you then go outside your benchmark and buy a company with an awful track record, such as some of these do, in terms of their capital discipline? Now, there's a very interesting thing coming up, which people are talking a lot about, which is Shell is having a solo analyst meeting here in New York, which is notable. You know, you would expect them maybe to do a Europe-US meeting, but June the 14th, we'll get the new CEO of Shell, and he can transform the performance of Shell if he gets it right. I want them to split the company. I want them to make a Shell LNG, a Shell downstream, a Shell deep water, and release value. And so does a major activist, Third Point, has been out publicly saying that they would want to see the same thing. So there's the potential for them to make strategy changes. In the case of BP, they're in a U-turn situation, right? They overcooked it on going down the renewables route, which I was just talking to Alex about what a huge mistake that was in terms of misunderstanding the cost of capital. But ultimately, I think over time, the US investors, if they come back to oil in a strong oil environment, will have a tendency to buy the E&Ps and US companies first. So the answer is Tom, US.
Just real quick here. Why are OPEC Plus meetings so short?
Well, if you remember, at the point of the maximum crisis, the meeting lasted. Well, if you remember, at the point of the maximum crisis, the meeting lasted a week, right? In March.
All right, fair enough.
2020.
Is this one next week? Just quickly, is it going to last 8 minutes or 11 minutes?
I think they'll probably prearrange. I think Saudi does want to squeeze the speculators, so I think you want to be long here, oil. I just don't know how long it's going to last. I mean, that's more like a week or two trade, which is what we saw out of the last Saudi announcement. And then I think we'll probably be going back to worrying about the economy.
Paul Sankey, thank you so much. Sankey Research, just wonderful to have you in this half hour with Michael Darda.
Appreciate it.
As well. We have another debt headline. I think they're like on a 20-minute basis here this morning.
Yep, they're going to get together. That's what
it's like
House
a Three
Speaker
Stooges
McCarthy is saying. They're going to get together this morning. Honestly, I think that the bigger market-moving event right now would be if they didn't get together and they weren't talking, right? I mean, basically, people, if there is not a sense of some progress, that will be more unnerving than a sense that the tick by tick by tick is actually happening.
I don't know what to make of it other than how many times have I seen this before, and it's a ballet. And I go back to the reality that Senator McConnell and President Biden have been down this road 4,000 times. And I do think Speaker McCarthy understands that.
Well, but to Greg Peters' point, at what point does that become a real risk? Because we're going to be down this road again. We have been down this road before. At a certain point, it has a consequence. There is some sort of longer-term sort of trenchant response.
If they wait later in the evening, we can hear the results as we're getting up to do surveillance. I mean, if they do it at 3 a.m. or 4 a.m., we can have breaking news, team coverage.
I think people are sick of it, and this is really the question is there a feeling of urgency enough to avoid a mistake kind of technical default? This
has been an extraordinary day. Thank you for our team with some really important conversations here on the events of the moment. The 2-year yield, 4.30%, near 4.40% yesterday. Please stay with us on radio and television. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
The best question I get all night.
Bloomberg, top experts, great questions.
It's beginning to crack just a little bit. Live from New York City this morning. Good morning, good morning. Equity futures just a little softer. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
From New York, coming up, global economic optimism beginning to crack as Chinese stocks wipe out gains for 2023 and debt ceiling talks are going nowhere fast. We begin with the big issue. Everybody needs to relax, apparently. Senate Republican leader Mitch McConnell saying, quote, regardless of what may be said about the talks, the president and the speaker will reach an agreement. As Congressman Chip Roy of Texas called default warnings a manufactured crisis, Republican House Majority Leader Steve Scalise is questioning how they even came up with the X date in the first place.
We'd like to see more transparency on how they come to that date, but Janet Yellen herself actually left the door open to delaying that in her tweets yesterday. The comments that she sent out yesterday implied that it's June 1st or later, giving some openness to the idea that June 1st may not be the so-called X date. So, haven't really been able to see a lot of transparency, but it looks like they're hedging now and opening up the door to move that date back.
Republicans then are doing their best to play it cool, as analysts at Goldman pencil in early June as a potential danger zone, and Morgan Stanley say June 8th is its base case for when Treasury runs out of cash. So what's left to address? Speaker McCarthy telling reporters that Democrats, quote, still want to spend more money this year than they did last year. He says that's a red line. Hakeem Jeffries, the top Democrat in the House, telling reporters that a freeze of 23 spending levels could well be a reasonable compromise. Joining us now to discuss is Bloomberg's Anne-Marie. Kelly Lyons down in Washington, D.C. AMH, where's the president on this?
Well, the president at the moment does not have any debt negotiations officially scheduled for the day, but his team does. And what we've learned, and this is one positive development, Jonathan, from where they left off yesterday. When they left yesterday, there was no plan to meet today. We do know this morning that the negotiators from the White House and the Republicans will meet today. McCarthy's also talking about that. So it's another day of big high drama debt talks on Capitol Hill. The issue remains, we are 8 days away from when Secretary of the Treasury, Janet Yellen, said could be the start of a potential default. She's calling this a hard line, even though a lot of Republicans are taking aim at that and they think there's a little bit more wiggle room.
Well, let's build on that. Kayleigh, Speaker McCarthy is saying, don't worry, we'll get it done in time. But apparently we don't know what time it needs to get done by.
Yeah, exactly. And we've been hearing this on the Republican side for some time now. Senator Mike Rounds was suggesting to me that he didn't think June 1st was a hard date as early as a week ago. It's worth noting, though, that when you look at the text of the letter that Treasury Secretary Yellen sent out, she specifically says potentially as early as June 1st. So, yes, she did acknowledge that there is some murkiness in this timeline because it really is about the inflows to the Treasury, what receipts look like, and then what they have to pay. There is a great story out on the Bloomberg terminal that shows date by date from June 1st onward what the Treasury's obligations are and what money they expect to come in. So the math isn't perfect here. I think everyone acknowledges it, and those on the side of those negotiating in the House, specifically on the Republican side, are maybe hoping that does leave a little bit of wiggle room considering this is a very tight timeline and just considering the number of days it would take for any deal, which has not yet formed, to actually move through Congress, get passed by both the House and Senate, and make it to the president's desk. It's a question of whether or not they could actually get it done by June 1. They may need more time.
Let's talk about a substance. Get away from the rhetoric. Anne-Marie, you talked to the president over the weekend in that news conference about spending. What are the red lines?
So the president said he agrees that they can cut spending, but the president says he also wants to see revenue raises. That was his direct answer when I said, listen, Speaker McCarthy says they cannot spend next year what they spent this year. They actually want to spend less. So this is one of the biggest issues they have on the top line spending figures. We heard from Hakeem Jeffries, the leader on the Democratic side in the House, and he's saying he thinks that 2023 should be where they're starting from. The president talked about this. Where's their base case they're starting from to cut this spending? Then next, Jonathan, the other big substantive discussion is around work requirements. The president made it very clear before he left for Japan, his red line is no work requirements for those that need access to health care. But now what the discussions are really starting to coalesce around is work requirements for access to things like food help and food security. The president didn't draw a red line on this, but this is going to be very difficult for him to walk because he is going to get a ton of blowback from the progressives in his party if he caves on this.
Looking out for more headlines through the hour and through this morning. Anne-Marie, AMH, alongside Katie Lyons. To the two of you, thank you. Joining us now is New Edge Wealth's Cameron Dawson, Brian Whitestein and Morgan Stanley. To the both of you, thanks for being with us. You heard the words there from Leader McConnell. He says relax. Cameron, any sign that anyone's panicking?
Well, certainly it looks like there is some sign of panic being priced into the T-bill market as you've seen the T-bills expiring around the X-date surge. But at the end of the day, we really just have to follow the Treasury General account. We know that it's been whittled down to a measly about $60 billion. So you can debate all you want how much time there is left, but we can watch in real time how much money there is left. And so we know that whether it's June 1st or June 8th, a deal has to get done in order to avoid nearing that zero lower bound on the TGA.
Brian, with that in mind, is there any risk outside of these so-called at-risk maturities?
Jonathan, I think the risk is that we move beyond the date and shut down the government, right? I think the real risk is here you stop writing checks, you stop money flowing. T-bills being cheap is fine, right? Life goes on. But I think if you push it too far, and we've seen it before, you get downgrades, you get real panic, you get real hits to GDP. I don't think we're there yet in the markets or in the rhetoric, but it's a risk.
You said the most contrarian trade may well be that treasuries don't rally on this mess. Is that your base case?
Yeah, I've been a big believer that we saw the highs for the year in rates. I'm starting to question that. I think when you look on the other side of this and you assume we're going to get some deal in the next few weeks, I think you can highlight how much debt there is and how little is being done about it. And then we went and priced in all those eases at a time where inflation seems sticky, growth actually seems sticky, we still have stimulus money out there. And so I think what would surprise people on the other side of this is that Treasury rates actually retest those highs from October, November. And so, yeah, I'm a little bit more worried that we're going to get new highs in interest rates again.
Brian, as you look across the curve, on what maturity specifically?
I think we've seen the local highs in twos. I mean, those 5% levels I think would be bought greedily, at least for now. So I worry more out the curve, right? You could wonder if it's risk premium, right? Do you really want a 10-year note at 3.30 where it was a few weeks ago, or should you be charged more for a government that doesn't know how to pay its debt all the time? And also, again, if inflation is sticky, 3.5% seems not as great as maybe it did if inflation was easily falling back to 2. So I would think the curve ends up a little bit steeper, and the 10-year maturities get hit the most.
Cameron, this is the #1 question right now for so many people. We tried to talk about it earlier this week with Jared Woodard of Bank of America. Should I be investing for a world of 5% rates, 5% inflation, or a future of 3%, 2%?
Well, I think that eventually we will move down to the 3% level. Our base case is that you don't get back to the 2% pre-COVID level of inflation really anytime soon on a sustained basis, simply because of the disconnections and the imbalances you see in U.S. labor market, wage growth remaining elevated. But what's interesting is that the bond market is still pricing in with a great deal of confidence that the Fed will be successful in getting back to 2%. You can look at those five-year forward inflation expectations, and they really haven't moved up substantially despite this whole inflation episode. So that could be an area where there is a mispricing in the longer end of the curve, that if you see inflation stick around, and maybe it's not 5, but even closer to 3, that should push up the inflation portion of the interest rate and really get us into a world where interest rates are higher for longer.
Cameron, you wonder what that would mean for equity market leadership, which has been dominated by a handful of tech names on the S&P 500 so far year to date. You can just feel the itch here right now of people wanting to buy this equity market and wanting to buy cyclicals and any relief off the back of debt ceiling talks, etc. Stuart Kaiser of Citi wrote about this yesterday evening. He said the story is that the Fed will pause, money will move into stocks, and underweight and/or defensive positions will be pressured to the upside. A FOMO trade will fuel a breakout and rotation trade. What's your advice right now, Cameron, to people who missed this move year to date and want to allocate fresh capital to equities?
Patience. I think that we've also seen, it's interesting, Citi came out this morning and showed that there was $21 billion of inflows into equities last week, and that's one of the highest levels in recent years on a weekly basis. So we already saw the FOMO trade in action as we pushed up towards that 4,200 level. But if you take a step back and move beyond positioning, which can move markets in the short term, what you look at is an equity market that is trading near the high end of prior valuation ranges pre-COVID, which means you've already priced in a lot of liquidity support, a lot of potential Fed easing into current valuations. And then on the earnings front, you have a big rebound already priced in to earnings in 2023 and in 24. So you really don't have any sign of recession in current earnings forecasts, which just means that it's a high bar for markets to jump over, really to get past sustainably that 42 or 4,300 level. So we think that in the near term, you likely get a better price in order to get access to this market. And we really do prefer things like equal weight indices, which don't have stretch valuations trading at just about 15.5 times if you really want to get exposure to the market today.
Savita Subramanian of Bank of America told you about the same thing. Wants to allocate to the equal weight S&P 500, strip out the muscle of big tech. Brian, on the credit risk side of things, what's the potential for a risk rally, a relief risk rally off the back of some of this?
You know, there's not a huge sign of it in the fixed income markets. What you're seeing in credit is actually a very interesting trade, a bifurcation between the better credits in any sector and the worst. So if you look at high yield, the CCC part of the market's done really badly, right? There's a lot of dispersion of weaker companies trading high double digits or mid, and better companies trading well. So I don't think you're going to see a flight toward, to the bad stuff. I think you'll see a flight to the front end of people locking in yield. But I agree with what was said a moment ago. I think, the 5% T-bill, you don't have as much FOMO. So yeah, I wish I had all my money in stocks that went up 3x this year, but that's generally not how it works. But if you're earning 5% instead of 0, you have staying power. And this is a hard part of the cycle. You have to be patient, and you have to believe. If you believe this is the beginning of a new upswing, by all means, you should own risk. But that's not what the bond market's telling us.
Hey, Brian, you're not alone. I think we all wish we just sat there in two names, NVIDIA and Meta, and did nothing else. Brian Weinstein, Cameron Dawson, going to be sticking with us. Just getting a headline now that House Speaker Kevin McCarthy is speaking to reporters at the moment on debt limit talks. Any headlines from that, I'll bring them to you. The only piece of information I have for you right now is that McCarthy said he spoke to White House negotiators earlier on today. So that exchange did happen. They are engaging in talks, and we expect more of the same through today. Going into the opening bell, about 20 minutes out from the opening bell, from the cash open, equities are just a little bit softer. Let's get you some movers. Here's Abby.
And interestingly enough, John, we are heading into the worst 2 days in about 3 weeks. But nonetheless, let's start out with some gainers on the day. Kohl's absolutely soaring. This as the company put up a surprise profit of 13 cents in adjusted earnings versus an estimated loss of 43 cents. The new CEO, Tom Kingsbury, is focused on fixing bloated inventories. Importantly, gross margins came in around 39% versus the estimate of about 37%. So things turning around around there, perhaps. Amazon off of its highs, but up 0.4%. Mizuho naming it a top pick on its AI boost to the cloud. Speaking of AI, NVIDIA, AI all around it. This Bionic stock, John, into today up 110%, taking some chips off the table ahead of earnings tonight. Will it prove that perfection that it's priced to? Tesla also down 1.7%. A Chinese Tesla rival has forecasted a plunge in car deliveries, perhaps putting some pressure on its competitor, Tesla.
Abby, thank you. Much more from Abigail around the opening bell. Coming up on this program, as Chinese equities wipe out gains for the year, and copper hits a new low for 2023, some aren't ready to throw the towel in just yet.
The last 4 or 5 months, people have been so underinvested, lack of conviction, they just still need to put some money to work. So it's nothing fundamental.
A conversation up next.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
This is Bloomberg. Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Is the enthusiasm for the global economy beginning to buckle? Last week, there was this warning from JP Morgan's Mislav Matejka. The activity upswing seen around the turn of the year, which was helped by the falling gas prices in Europe and by China reopening, is unlikely to transition into an acceleration in the second half. This morning, China's benchmark stock index wiping out all of the gains for 2023, and copper making a new low for the year, breaking below 8K. Even Europe's luxury players have hit a bit of an air pocket. Today, worries about China. Yesterday, attendees at a luxury conference in Paris organized by Morgan Stanley flagging worries about performance in the United States. Bloomberg's Mike McKee joins us now for more. Morning, Mike.
Morning, John. It's an ongoing worry, but it's basically based around inflation. And we did have the Reserve Bank of New Zealand today signaling it's ready to pause. They think they have done enough to get inflation down, and they're a bit worried about the consumer as well. Here's what they had to say. The committee is confident with interest rates remaining at a restrictive level for some time, consumer price inflation will return to within its target range of 1 to 3% per annum. Now, we do see signs of consumers cracking around the world. If you look at retail sales in China and retail sales in Europe, China is the orange one there, and you can see after they came out of lockups, there were big jumps higher in spending, but they came out of this lockup and the jump isn't as high, and it has started to come back down. Meanwhile, retail sales have been tepid in Europe. They're barely moving, and they have fallen as well. Why? Well, it seems to come down to inflation and the shift in consumer preferences. Take a look at what happened in the UK in April. Their inflation rose on a core basis much more than anybody anticipated, but you can see it was all services spending. Goods spending actually saw some deflation. And so that's the problem for central banks everywhere, is that we have shifted our spending away from retail sales, away from goods to services, and that doesn't show yet any type of slippage. So while we're watching people like the European luxury retailers see sales drop, we're still seeing strong sales elsewhere that are pushing up on inflation and keeping most central banks still active.
Mike McKee, thank you, sir. Cameron Dawson, I wanted to come straight to you on all of this. Are you seeing signs of the enthusiasm for the global economy, China, Europe, is starting to crack?
When we see the untouchable, kind of imperceptible names get hit with big volatility alerts, it usually is a sign of a sea change. We had this unbridled optimism going into the year about Europe being better, global growth being better, China being better, really lifting European stocks. And now to see them react so sharply shows that people were probably pricing in too rosy of a future. Then when you start layering in things like copper, they call it Dr. Copper for a reason. And really it's a sign of global growth and global demand for heavy industry, manufacturing type of things. And as that starts to break down further, that really is a sign that possibly the big leadership we saw of cyclical names coming out of the October low has started to fade. And what we've seen is that even though cyclical names are telling you that they're raising guidance and the market is still strong for what they're producing, stocks are reacting really poorly. And that's usually a sign that they've gone too far too fast, and you're in a period where estimates likely start to move lower, not higher.
This has been building now for a number of weeks, Brian. We've been following it on this program. Brian, if you look at the manufacturing data, dreadful. You might make the case for rate cuts. You look at the services data, pretty resilient. You make the case for a pause and maybe even another hike in certain places. Brian, I'm trying to work out, and it goes back to a question I asked earlier on this morning. Should I be investing based on the manufacturing data or based on the services data?
I think the answer is the services data until such time that the market cares about the other. I mean, it's a bigger part of the economy. It's where the inflation is. It's certainly where the spending is going. And I think if you're the Fed, the problem they have is every time they pause, and by the way, you throw in the occasional run out of bank and their balance sheet expands, the market eases, right? The equities go up, financial conditions get easier, and they're forced, I think, to hike again. They may be forced again in a couple of weeks here. So I think the service data is actually the more important data for now. It's stickier. It's going to keep the Fed on hold, even if a recession is coming, because to get that inflation down, they need to lower demand, and so they have to be tough here. Eventually, the other data will matter, but that's not today.
What's your best guess then, Brian? Next move, a cut or a hike?
I think it's another hike. Again, listen, I think what the Fed wants is to be done. I think it's pretty clear. Jay Powell said it. They've done a lot. They don't know where they're supposed to be. They don't know exactly where restrictive is, but they're closer than they were. But I think the market pricing in eases and equities making, certain equities making new highs puts pressure on them to hike rates. So I think they want to stay. The market is going to force them to see if they will hike again.
Cameron, would you say the same thing?
Yes, we do think that it is a hike and not a cut. And even a pause, this market is seeing pauses as effectively a gateway drug to cuts. And that's not what this Fed wants. They're pushing back very hard against the notion of cuts in the back half of the year, simply because it does have the potential to ease financial conditions and further exacerbate their inflation problem. And I think at the end of the day, data in certain pockets of this market is starting to reaccelerate. Look at housing data. Look at that services data. All of this points to a Fed that really does not have the room to dial back its hiking. And so we think that we'll continue to see upward pressure on the probability of a hike either in June or July. It's moved up rather significantly in just the last week alone. And we do think that it's a hike and not a cut that comes next.
This is why they're so reluctant to discuss a pause. They do not want conditions to ease again with inflation as high as it still is at the moment. Cameron, Brian, two of the best. Always appreciate it. Thank you. Going into the opening bell, about 8 minutes away on the S&P 500. Just a word through the price action briefly. Equity futures negative 0.5% on the S&P. Yields have been higher for 8 consecutive sessions. A bit lower this morning at the front end, sub 430 at about 428. Looking into the FX market, the euro against the dollar. The euro was weaker earlier on. The dollar was stronger. Got down to about 107.50 at the low, 107.48. We're back above that level to about 107.90, getting close to 108 and through it very briefly in the last 10, 20 minutes or so. The latest update on the debt ceiling debate, Kevin McCarthy, the House Speaker, speaking to reporters a little bit early this morning, saying that he did speak to White House debt limit negotiators and others, he said, whoever those others might be, a little bit early this morning. Those talks will continue through today, and we'll bring you some more headlines a little bit later from Anne-Marie and the team down in Washington, D.C. when we get them. Coming up on this programme, the morning calls, and later, stick with tech or rotate to cyclicals. Keith Lerner of Truist says there's little incentive to chase stocks here. We'll catch up with Keith in about 8 minutes. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Softer, negative this morning, about 5 minutes out from the opening bell. Equities down by 0.5% on the S&P. On the Nasdaq right now, negative by 0.7%. Yields have been climbing relentlessly for 8 straight sessions. We come back in just a bit. We're down 2 or 3 basis points on a 2-year, just sub 430 at the moment, 428.91. That's the price action. Let's get some morning calls. First up, Exane downgrading Shopify to underperform, saying there's better opportunities elsewhere given the company's valuation. That stock negative 1.25%. Goldman downgrading Southwestern Energy to sell, $5 price target, warning of further downside due to the company's weakening balance sheet. We're negative there by 0.75%. And finally, Mizuho naming Amazon a top pick for the rest of the year, seeing strong potential for its cloud business given the addition of, guess what, AI services. Amazon just about unchanged in early trading. Coming up, Keith Lerner of Truist making a case for remaining underweight stocks. That conversation just around the corner. Your market open up next with equity futures near session lows.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
25 seconds away from the opening bow this morning. Good morning. Let's get this trading session underway officially, with futures negative at the moment by 0.5%, there and thereabouts. Moving to the downside on the Nasdaq, negative by 0.6% yesterday. Biggest one-day drop on the S&P 500 in about 3 weeks. There's the opening bell. Switch on the board and get to the bond market. Yields higher, up and away over the last week or so. They come back in this morning by about a single basis point on a 10-year, 368.43. The euro was showing some more weakness early this morning, makes a little bit of a comeback. The euro against the dollar, euro-dollar 107.86. We're positive here about 0.1%. The euro making a comeback. And crude up 2%. All this talk about OPEC Plus's next move, maybe flushing out some of those shorts. Maybe that's what's happening now. 74.33 on WTI at the moment. More broadly, about 25 seconds into the session, here's the equity market on the S&P 500. We are negative by 0.4%. One stock to watch at the open, Urban Outfitters. The retailer reporting better than expected Q1 results and delivering an upbeat outlook. The CEO saying, quote, "We currently see no signs of change in customer behavior, no indication that customers are shopping less frequently or trading down. We believe Q2 could look very similar to Q1. Abby has more. Hey, Abby.
Hey, John. And the stock is absolutely soaring, up about 19%. Its best day since August of 2020 on the results that they reported, but also that outlook, really in contrast to other retailers. Now, relative to the quarter that they just reported, a huge bottom line beat by 60%, 56 cents on $1.1 billion. That revenue was also a beat of 2.23%. The street is wildly bullish. We have Barclays upgrading shares to an overweight from an equal weight, raising their price target to $38, suggesting that there's more upside potential ahead. We also have Jefferies, Wells Fargo, Citi, BMO, other banks raising their price targets. And apparently the strength really has to do with the Anthropology and the Free People offering. But again, best in class to some degree. Some of these analysts very, very bullish here. And also Barclays saying that the sales to inventory growth is positive, positions them for positive to accelerating trends in regular price selling. So it sounds like they are fashion right. They have items that folks are willing to buy without a discount. Again, this stock absolutely on fire, up 19%, John.
Wow, what a move, and really interesting. Abby, thanks for that. In retail, you can get just about anything you want right now. You're looking for a signal to confirm your price, whatever it says at the moment. You can basically say Foot Locker, things are terrible, or you can say Urban Outfitters, things are okay. For Kohl's, reporting a surprise first quarter profit thanks to recent efficiency measures. The CEO saying this: "We're making progress in each of our key priorities, enhancing our customer experience, simplifying our value strategies, managing inventory, and strengthening our balance sheet." Katie Lyons, so far so good.
Yeah, and the stock is showing it, John, up more than 14% here in the first few minutes of trading, heading for the best day since March of last year. Really, frankly, blew it out of the water when it comes to the bottom line. Analysts were braced for a loss per share of 40 cents, and instead what Kohl's was able to deliver was a profit of 13 cents. And there's other noteworthy positives in the report as well. Gross margin of 39% topped expectations, and importantly, inventories dropped 6%. So that shows some progress in working down some of that bloat. It's not to say that all of it was all rosy. You did have a bigger than expected drop in comparable sales, the 5th consecutive quarter of decline, which shows they still have some work to do in getting people in the door, but still a sign that some of those early efforts on efficiency are starting to pay off. One thing I would note, though, is that Kohl's did leave its outlook steady for the rest of the year, despite delivering this big beat in the first quarter. The company's CEO in the statement also noting that the macroeconomic environment remains challenging. Certainly, though, not challenging for the stock this morning. Those gains are just getting bigger as we go, John.
Seeing some big gains this morning, up 17% on that name. Katie, thank you for that. Here's another retailer seeing continued strength. VF Corp, the company topping Q4 earnings estimates thanks to momentum at its North Face brand and product launches at Vans. Simone Foxman has more. Hey, Simone.
Yeah, VF Corp, also the owner of Dickies, and a bit more mixed picture here. Modestly beating estimates, EPS coming in at 17 cents rather than the 14 cents that analysts had expected. Revenue also a little bit higher. Was successful at, as Kayla was talking about, cutting some of the excess inventory that it had, supply chain improvements. But what bulls are really going to be most tied to is some of the performance that it saw out of North Face, particularly in China, where sales of North Face were up nearly 40% in the quarter. But there's not so great news, too, and we were hearing pretty sour mood about the consumer looking ahead to declines, single-digit declines in terms of revenue for the next quarter. Jury's still out as well whether it can turn that struggling Vans brand around. Shares lost more than 50% of its value in the past year. And just this morning, we saw half a dozen analysts across the street cut their price targets for this company.
Just about positive on the session so far, 5 minutes in. Simone, thank you for that. Here's a name I want to talk about. I want to turn to the financials and talk about PacWest. The good news is we're talking about PacWest for the right reasons. Monday, the stock was up almost 20%. Tuesday, up almost 8%. This morning, this Wednesday morning, up 2.6%. Leading the regional banks higher yet again, running for a third consecutive session after agreeing to sell its Civic Financial Services unit to real estate lending firm Rock 360. Just more encouraging signs they're making steps forward every single day so far this week. That stock getting back up to about 750. Not great, but an improvement, that's for sure, on that name. PacWest up by almost 2% this morning. More broadly, we're down by 0.5% on the S&P 500. On the NASDAQ, we're down by about 0.4%, continuing to pull back from 9-month highs on the S&P, with strategists remaining divided over the next move. Morgan Stanley's Mike Wilson delivering a warning this week, starting the week saying this: there are many technical signals that conflict with the idea that this is the beginning of a new cyclical bull market, including poor breadth and broad cyclical underperformance. Bank of America's Savita Subramaniam pushing back.
Narrow breadth is not a precursor for doom and gloom. I think it's kind of a false negative. And then when you look at valuations right now, they look high, which is another reason nobody wants to buy stocks. But valuations generally look high when you're in an earnings recession, which we are in right now.
Keith Lerner of Truist joins us now. Keith, always great to catch up with you, sir. Is narrow breadth the so-called false negative?
Jonathan, great to be with you. So the way I look at breadth is you'd rather have a broader market. When you historically test this, often breadth does catch up to the market. But I think our point of view is right now is that we have this leadership, and we all know the story on these top-heavy stocks, that you really want to see things broaden out. But the challenge we have, and I know there's this whole debate about the S&P 500 versus the equal weight. We're overweight the S&P 500. We do have a position in the equal weight, but it's much smaller, and we would stick more with the larger cap ones. The way to think about that, John, is if we have 4 or 5 stocks leading the market, you need things to kind of rotate into these other areas of the market like energy, financials, industrials. The challenge that we see is we still think the economy is going to slow down. So these other areas of the market are cheap, but the business cycle is working against them. And as we think about the overall market, we just think it's uncompelling at current levels relative to these relatively high macro risks that remain.
Keith, how frustrating is this market for you at the moment?
But it is frustrating because if you look back over the last year, really, the Bulls are frustrated, the Bears are frustrated, and we've been more on defense. We're waiting for a time to move on offense, but we're being patient because we don't think investors today are adequately compensated for taking on undue risk. So the back and forth for over a year, it's tiring. People are ready to move, but the fundamentals don't support a big shift. So we're just being patient. We do think there will be opportunities this year, but right now, you just came off the 4,200 level. The overall market is trading pretty full as far as valuations. And then even the credit markets. I mean, it's remarkable how stable the credit markets have been. So they haven't provided much of an opportunity. So again, frustrated but patient.
Keith, you can feel the edge. I hear people, they talk about it out loud, making that rotation to the cyclical part of the equity market. You alluded to it. Stuart Kaiser nailed it over a city yesterday evening. There's this story out there, and he writes the following. The story is that the Fed will pause, money will move back into equities, and underweight or defensive positions will be pressured to the upside. A FOMO trade will fuel a breakout and a rotation trade. Keith, if you've missed the rally this year, and you hear people say things like that, what do you tell them?
Well, so one of the things that even in our view, and we over the last month we laid out the bull versus bear case as far as where we are in this cycle. One of the more positive aspects, but this note has alluded to, is that position is relatively short. If you have a more decisive move above 4,200, you bring in technical buying. But John, even if we do see that, we still think the upside is likely capped maybe around 4,300 to 4,325. That's about 3% upside, and partly on how we get there is, let's just say earnings are bottoming this year, right, at this level. Again, we think there's more downside, but let's just say that earnings are bottoming, and next year earnings rise about 8 or 9%. You put an 18 multiple on that, which is also pretty generous, and you get to about 43.25. So is that those are optimistic assumptions. Is that enough to go risk on it? And to be fair, Jonathan, in an overall portfolio, we have equities just relative to those long-term targets we're below. And actually right now, Jonathan, as there's a lot of discussion on equities, the 10-year Treasury's moved up to close to 370. We actually think that's becoming more attractive again, and why we are overweight bonds and also overweight cash right now.
So Keith, any reason to believe the leadership story changes, given the threats to growth that you still see, given the fact that you're willing to take on some duration risk as well, based on what you just told me in the bond market? Any reason to believe that leadership of this equity market is going to change anytime soon?
I think you could see a short-term move. Don't forget, we have NVIDIA earnings coming after the bell. And a lot of these tech stocks on a short-term basis are pretty stretched. They're approaching the 2021 highs. If you look at Microsoft, Apple, and NVIDIA. So that would be a natural place for a pause. I just don't think that if we do see a short-term move to some of these other being up areas, I just don't think it's going to be that long. So it may be a mean reversion trade. But I will also say, as you look out more, 6 to 12 months, we think tech will continue to be leadership. If you look at the technology sector relative to the S&P 500, it just broke out of a 3-year range that it's been since after COVID. So we still think that's leadership in a slowing economy.
Where does that leave the cyclical story abroad, Keith? Because at the same time tech has ripped, there was all this enthusiasm to buy the luxury names in Europe, try and play the reopening theme in China. You seen threats to that now?
Well, I think some of the, what you just saw there overnight on some of these luxury brands is kind of the short-term risk to tech, since it's a bit extended. But I will also say, based on what you've discussed earlier in this program, you're seeing, copper come down, energy materials underperform. I think one of the things that's helped Europe out quite a bit is the European banks. If the economy, slows down, and we're seeing that impulse from China start to slow down, we think that Europe's unlikely to remain leadership. And if you go into a slowing economy, normally the U.S. outperforms, so we would stick there.
That would mean a big shift in the dollar as well, even more so, based on what we've already seen. Keith, thanks for this, mate. As always, Keith Lerner there of Truist on this market. Just looking at the FX market at the moment, the euro against the dollar, rebounding, but fading again, 107.80 on that currency pair. LVMH still negative in trading over in Europe. Year to date, still higher, though, by about 20%. The luxury names took a bit of a hit. There was a conference yesterday in Paris, hosted by Morgan Stanley, which indicated that perhaps some softening of demand over in the United States. And overnight, the difficulties with China, you all witnessed that, and the equity market wiping out the gains for 23. We had some renewed weakness again in the luxury players, LVMH MS, etc. These big consensus positions that have been built up on the reopening of China, some enthusiasm around Europe, has been pushed through the FX market as well. We've seen that breakdown in the currency market too, with the euro just weakening, really close to 111 at the back end of April, 110.95, and all the way back down to about 107.50 this morning, 107.48. to be precise. The broader equity market at the moment, about 12 minutes into the session, really no drama here. We're down about 0.5% on the S&P. On the Nasdaq, we're down by 0.4. Coming up, looking ahead to this one, Ron DeSantis, the governor of Florida, expected to launch his presidential campaign tonight.
We'll be interviewing Ron DeSantis, and he has quite an announcement to make.
That conversation up next.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very carefully.
Nobody covers business like Bloomberg, your global business authority.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to